हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। आज है 12th ऑफ मार्च 2025। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। फिलहाल के लिए मार्केट को देखोगे, मार्केट क्रूड ऑयल नेचुरल गैस हल्का सा गैप डाउन ओपन हुआ है। कल एक सेलिंग का ट्रेड बनाया था, याद होगा। सेलिंग करते वक्त मार्केट में मैंने बताया था नीचे बाइंग मत करना, उसमें एक अच्छा मूव आ गया डाउन साइड पे। क्रूड ऑयल कल टारगेट मिल गया था, वहां से एक बाउंस बैक किया था। फॉरेक्स में ऊपर भी सपोर्ट है। मार्केट बहुत ही फंसा हुआ है यहाँ पर, ये ऊपर रेजिस्टेंस नीचे सपोर्ट। मुझे लग रहा है कि से एक साइड का एसएल जरूर जाएगा इसमें, या तो ऊपर ही निकलने वाला है या फिर ये नीचे का एसएल उड़ाएगा। किसी एक साइड पर अगर निकल जाए तो फिर रेंज थोड़ी बड़ी बन जाएगी, क्योंकि फिर थोड़ा सा मार्केट का मूड बदल जाएगा। अभी देखोगे तो सिनेरियो ऐसा चल रहा है, ऊपर रेजिस्टेंस था, ठीक है, वहां से सेलिंग आई, नीचे मार्केट में सपोर्ट था, बाइंग आई, फिर से रेजिस्टेंस से सेलिंग आई, एंड मार्केट में फिर से सपोर्ट से बाइंग आई, फिर से बीच में एक और रेजिस्टेंस बन गया, फिर से सेलिंग आई है और फिर से बाइंग आई है। तो ये कुछ इस तरह का पैटर्न बना रहा है, इक्वल सपोर्ट और लोअर हाईस क्रिएट हो रहे हैं। तो मुझे लग रहा है एक ना एक साइड बड़ा ब्रेकआउट या ब्रेकडाउन होने के चांसेस हैं। क्रूड ऑयल में बहुत जल्दी ही ब्रेकडाउन हुआ तो फिर बहुत बुरा गिरेगा। फंस गए हैं सेलर्स और बायर्स दोनों के दोनों। नेचुरल गैस में देखो क्या कर सकते हैं। डेटा की बात करें तो मुंबई सेशन ओपन है, लंदन सेशन ओपन होने वाला है 12:30, न्यूयॉर्क सेशन 5:30 और यूएस मार्केट 7 पीएम। सबसे पहले तो नेचुरल गैस में बीच का लेवल रिमूव कर दो, इसकी ज़रूरत नहीं है अब, ठीक है, क्योंकि ये हो चुका है क्या, ब्रेक डाउन। सो इसकी अब ज़रूरत नहीं पड़ेगी। देखो आता है प्राइस यहाँ पर, थोड़ा बहुत रुकना चाहिए प्राइस को। तो ये 374, या फिर अगर नीचे आ जाता है 356, 57 के आसपास, यहाँ पर एक बाइंग का प्लान रख सकते हो नेचुरल गैस में। ये ब्लू कलर की लाइन भी है जहाँ पर थोड़ा बहुत रुकना चाहिए प्राइस को। कैंडल का ध्यान रखना, ओपन इक्वल टू हाई, ओपन इक्वल टू लो पे बाई सेल मत कर देना। ओके। क्रूड ऑयल ये मान के चलो ये रेंज है, ये ऊपर जो लेवल लगा रखा है और नीचे ये, दिस इज द रेंज। किसी ना किसी एक साइड के अगर एसएल चले जाए, मार्केट ब्रेकआउट या ब्रेकडाउन कर जाए, तब थोड़े हाई चांसेस रहेंगे मार्केट के मूव करने के, रेंज के बाहर। अदरवाइज तो फिर साइड ब्रेक करेगा वो तो नहीं बता सकते एग्जैक्टली कोई भी। बाकी कल क्रूड ऑयल के लिए न्यूज़ जरूर आई थी, दो तीन न्यूज़ आई थी कि 30 डेज के ट्रूस के लिए रेडी हो गया है यूक्रेन। तो देखना पड़ेगा वो 30 डेज का जो ट्रूस है वो कब से इम्प्लीमेंट होता है। पॉजिटिव न्यूज़ थी, क्रूड के लिए कह सकते हो नेगेटिव न्यूज़ थी। नीड टू सी क्या सिग्निफिकेंट इम्पैक्ट मार्केट में देखने के लिए मिलता है इस न्यूज़ का। बाकी टैरिफ वाली न्यूज़ तो मैंने आपको बताई दी थी। हाई टैरिफ लगा दिए हैं, 25% एक्स्ट्रा और भी लगा सकते हैं, कम्प्लीटली सट हो सकता है, वो भी एक न्यूज़ थी। और उसके अलावा यूरोपियन ट्रेड कमीशन की ओर से ही बताया गया है कि अगर जो टैरिफ लगाते हैं ट्रम्प यूरोप पे, तो लगभग 26 बिलियन यूरो वर्थ के ये टैरिफ होंगे, जिसको वो भी फिर से क्या कर सकते हैं, रिटेलिएट कर सकते हैं। यूएस मार्केट के लिए तो अच्छी न्यूज़ थी वैसे ही, कल थोड़ा बहुत रिकवरी किया। बाकी आज सीपीआई का डेटा है, बहुत इंपॉर्टेंट है, तो थोड़ा सा ध्यान रखना सीपीआई के डेटा के लिए। मेजरली इम्पैक्ट करता है, आप लोगों को पता ही है, सीपीआई का डेटा मार्केट को। आप मुझे सुबह कॉल कर रहे थे गोपाल दास जी। कॉल मत कीजिए, ये मॉर्निंग पे कॉल अगर करनी है इवनिंग पे कर सकते हैं, मॉर्निंग पे मैसेज छोड़ सकते हैं, ठीक है। कोई मैसेज हो तो आप व्हाट्सएप पे छोड़ दिया कीजिए, मॉर्निंग पे मैं कॉल लेता नहीं हूँ। हाँ, अगर सेल किया हुआ है तो बिल्कुल होल्ड कर लो, वापस आए तो वापस करना, बट बाकी मैंने बता दिया, ये रेंज बना दी है मार्केट ने फिलहाल के लिए। अब किसी ना किसी साइड तो मार्केट को, लाइक, क्या कह सकते हैं उसको, ऐसा उड़ाने पड़ेंगे। अब कहाँ उड़ाएगा वो नहीं कह सकते। बाकी जैसा प्राइस एक्शन मैंने आपको दिखाया, कोई न्यूज़ नहीं आती है तो प्राइस एक्शन तो सपोर्ट बिल्कुल नहीं कर रहा है बाइंग को। ये देखो, ये जो स्ट्रक्चर है ना, ये नॉर्मली ब्रेक डाउन ही करता है। अगर ये ब्रेक डाउन करा तो इतना मोमेंटम आप एक्सपेक्ट कर सकते हो डाउन साइड पे मिलता है। अभी ब्रेक नहीं किया है, वी डोंट नो, समटाइम्स डब्ल्यू भी बना देता है प्राइस। तो इसको हम थोड़ा सा अब लिख सकते हैं नीचे डाउन साइड लेवल पे, ठीक है। एज पर द प्राइस एक्शन वीक सपोर्ट लेवल है, सपोर्ट जरूर है बट थोड़ा सा वीकर साइड पे रहेगा, ठीक है। तो जितना नीचे लोगे, जितनी कम क्वांटिटी में लोगे उतना बेटर। यहाँ पर अब रिस्क है नीचे डाउन साइड पे, ठीक है। नेचुरल गैस में हाँ, यहाँ पर ये नीचे लगा रखा है लेवल 374, और फिर नीचे 361। इन एरियाज पे ट्राई कर सकते हो बाइंग। अपर लेवल पे आएगा तो वापस 392, या फिर जो कल का हाई बना था, वैसे वहाँ तो अब नहीं आनी चाहिए बाइंग। फिर भी 399, ये सारे के सारे लेवल अभी भी रेजिस्टेंस की तरह काम करेंगे। फिर वो मेजर रेजिस्टेंस 2 आवर वाला तो है ही है, ये 2 आवर टाइम फ्रेम का लेवल है, ध्यान रखना, ये 15 मिनट का नहीं है। कई लोग कंफ्यूज हो जाते हैं फिर उसमें। बाकी 6 PM पे सीपीआई का डेटा, 8 PM पे क्रूड ऑयल की इन्वेंट्री।
Don't miss the 5th Qatar Economic Forum powered by Bloomberg this May 20th to 22nd live in Doha. Programmed by Bloomberg News, the Qatar Economic Forum will convene the world leaders and international CEOs who are providing unique perspectives on the critical issues facing the global economy. Join us in Doha and be there as it happens. Request an invitation today at QatarEconomicForum.com.
News when you want it with Bloomberg News Now. I'm Doug Krisner. Blanket U.S. tariffs of 25% on all imported steel and aluminum are now in effect with no exceptions. These levies have caused nervousness right across financial markets. President Trump spoke earlier outside the White House.
You're going to have drops and markets are going to go up and they're going to go down. Yeah. But you know what? We have to rebuild our country. Our country has been stripped of its jobs, of its factories. And I'm tired of seeing where they build apartments, cheap apartments in an old broken down factory. But you have factories all over the place that are empty from many decades ago. And we're going to change it around.
Trump walked back plans to double tariffs on Canadian steel and aluminum to 50%. This is after Ontario Premier Doug Ford suspended a 25% surcharge on electricity sent to the U.S.
So we spend $200 billion a year subsidizing Canada. We don't have to do that. And frankly, the way that gets solved is Canada should honestly become our 51st state. We wouldn't have a northern border problem. We wouldn't have a tariff problem.
Earlier Tuesday, Trump threatened to increase tariffs on Canadian auto parts and to shut down auto manufacturing in Canada if Ottawa does not drop tariffs on dairy products and other U.S. goods. Canada, by the way, is the main source of aluminum for the U.S. auto industry, and the plants Trump is threatening to shut down are owned by American automakers. Canadian Energy Minister Jonathan Wilkinson is calling for a restoration of normalcy. He spoke earlier to Bloomberg from the CERAWeek conference in Houston.
First of all, I think this tariff conversation is really unfortunate. We've been long partners, friends, allies, and our economic relationship has benefited both parties. So these tariffs are actually going to create pain on both sides of the border.
Jonathan Wilkinson there. He is Canada's energy minister, speaking to Bloomberg earlier today. Now, the trade dispute between the U.S. and Canada has rocked markets while casting a cloud of uncertainty across major North American industries. The House of Representatives has passed a stopgap funding bill. Republicans approved the measure with a 217 to 213 vote, putting them one step closer to averting a government shutdown. Now the bill goes to the Senate, where it will likely need the support of at least 8 Democrats to become law. Here is Bloomberg's Billy House.
It does increase security spending by about $4.4 billion. That's according to the CBO. That's something the conservatives wanted, and it has $440 million or so for immigration enforcement, Internal Revenue Service money, and blocking the city of D.C. from spending about $1 billion of its own tax dollars. It does things like that, things that were demanded by GOP hawks, fiscal hawks.
That is Bloomberg's Billy House. To geopolitics next, Ukraine has accepted a U.S. proposal for a 30-day truce with Russia as part of a deal to lift a freeze on military aid and intelligence. Now, the agreement laid out in a joint statement follows 8 hours of talks in Saudi Arabia on Tuesday. Nick Wadhams covers national security for Bloomberg News.
Ukraine, apparently they gave the U.S. what it wanted, gave President Trump what he wanted, which was just essentially a commitment to the idea of peace. So Ukraine says, yes, we are willing to agree to a ceasefire. Now the ball is in Russia's court. So, in some ways, a pretty canny move by Ukraine. They're not giving any concessions at the moment beyond just saying, yes, we want peace.
That is Bloomberg's Nick Wadhams. Now, American officials will present this proposal to Moscow for a final agreement. By the way, U.S. Mideast envoy Steve Witkoff is due to meet with Russian President Vladimir Putin later this week. Adobe will be among the names reporting earnings after the bell Wednesday. We have a preview from Bloomberg's Charlie Pellet.
Analysts at Bloomberg Intelligence say Adobe may hold off on raising its outlook amid economic uncertainty, despite impressive traction for its artificial intelligence tools. Anurag Rana is a senior tech analyst with Bloomberg Intelligence.
There is a lot of emphasis right now on Adobe to showcase their GenAI capabilities, because this is probably the most widely argued stock on Wall Street right now.
Consensus estimates are for the slowest quarterly revenue growth in 2 years in New York. I'm Charlie Pellet, Bloomberg Radio.
And that is news when you want it with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
on Ukraine in order to get them to the table. The question is, if Putin rejects this, if the Russians reject this, what is the U.S. prepared to do? We've heard from President Trump saying that basically they could ramp up banking sanctions, they could do more on fossil fuels potentially. And Marco Rubio was asked this in the press conference yesterday. I mean, what he said was that basically, and he kept continuously reiterated that they hope that Russia will sign this deal. If they don't, then we'll know who the impediment to peace is. Again, we do not know what the United States is willing to do to sort of ratchet up the pressure to Russia to drive them to the negotiating table. But again, I think that many of the people who have been critical of Trump's approach is not in his pragmatism, but in sort of giving ahead of time, basically no to NATO membership, giving these territorial concessions, basically doing those out in the open, though realistically a number of those will have to be concessions probably made by Ukraine. I think the hope was that that could be done and closed doors at the negotiating table and not in public ahead of any kind of negotiation.
Bloomberg's Oliver Crook on the ground in Berlin with the details. Thank you. Coming up, we will stay on that story, discuss the potential truce with Hannah Shelest from the think tank Ukrainian Prism. That analysis is coming up next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. Ukraine has accepted a US proposal for a 30-day truce with Russia in exchange for lifting a freeze on military aid. Let's get more with Hannah Shelest, director of the Security Studies Program at the think tank Ukrainian Prism, who joins us from Odessa. Hannah, thank you for joining us and for your time. What do you make then? What is your takeaway from the deal that has been agreed between the US and Ukraine?
I mean, that is just the proposal that two sides agreed. And as we see from the communique, Ukraine definitely demonstrated the readiness for the ceasefire. However, the first reaction we felt immediately here in Odessa, the same moment when the communique was posted online, Russia targeted heavily with the ballistic missile Odessa port and killed civilian sailors. So you understand that now it would be really important to see not only the first statements from Mr. Lavrov and others, but to understand how the U.S. side reacts on them, because previously Mr. Trump said that he sees the willingness of Mr. Putin for the ceasefire or for the peace. I cannot name the peace when you are targeting immediately such heavily different cities of Ukraine. And this morning, right now, we're also in the midst of the air raid. That's why I'm partially optimistic, because that's allowed these negotiations in Saudi Arabia to restore a little bit relations between Ukraine and the U.S. But if you would ask me, am I optimistic about the final results, let's say, about the possibility to the real ceasefire? Unfortunately, I'm much more realistic, and with the 10 years of the bad experience of Russia violating the ceasefire.
Okay, on that point then, Hannah, what do you think is the positioning of Putin right now? Is it your expectation that Russia will move on any of the lines it's drawn around this conflict?
Definitely No, because we see that their ambitions just increasing. Doesn't matter they are winning or they're losing at the battlefield, because we heard all these months of the pre-negotiations that they would like to control 4 regions of Ukraine, including those territories that they even never occupied in Kherson and Zaporizhia regions. Not speaking about all other demands that de facto would ruin the sovereignty and nationhood of Ukraine. Speaking about the language, church, and even the changing of the government of Ukraine. So just purely when you speak about the territories where they are now. And we need to understand that currently the Russian Federation thinks that they are winning on the battlefield. So they think that they're in the more beneficial position compared to Ukraine when the US is not backing us. But at the same time, it doesn't mean that Russian president would not agree to the certain ceasefire or at least negotiations about the ceasefire. Because first he can bargain about the sanctions that are a serious question for him and his inner circle. The second is because he can accumulate the forces. Now he is using missiles from North Korea or those missiles that are produced right this week, literally. So that means that he also needs a certain pause to accumulate the efforts for the next attacks against the neighbors.
Hannah, what are Ukraine's red lines at this point, and what should it be willing to give up?
First of all, the red line is definitely our territorial integrity. And here I would like viewers really to understand that Ukraine is not fighting for 3 kilometers of the territory. We are fighting for the people that are at these occupied territories, which are under this serious oppression, because Ukrainian books are burned proudly by Russians, military at the primary school, and you can be arrested just for wearing something yellow and blue. Just read what is happening at the occupied territories. That's why for us, that is one of the main red lines. Sanctions, reparations, probably some other stuff can be negotiated. NATO membership for Ukraine now is also quite a red line. The reason is that unfortunately we don't have any other security guarantees that can prevent the next attack from Russia. We had 2014, we had the ceasefire and some agreements, didn't work. 2022 happened with the full-fledged aggression against Ukraine. So Ukraine really would like to understand who would help us from the further attacks from the Russian Federation. Other stuff definitely can be discussed.
Is the minerals deal with the US, is that a security guarantee for Ukraine?
Definitely not, at least from my point of view, because if you look what Russia targeted at the first days of the war, there were a lot of the U.S. business there. Coca-Cola plant near Kyiv been heavily destroyed. I can name you plenty of the other companies that are less well known, but with the millions of investments in Ukraine. So in this case, for the Russian Federation, the business is nothing, they can attack it easily. For the United States, will they fight for the enterprise? And that is even not the U.S. business at the territory. Yeah, that is just the fund where the money will come, and part of this money should come to the United States. So that is not the real damage, or let's say the losses that they will have. That is just the potential losses that they can have. That's why I don't believe that that can be the point that really prevents Russia.
Okay. Hannah Shelest, really appreciate your time and your analysis. Director of the Security Studies Programme at Ukrainian Prism, joining us out of Odessa, Ukraine. Coming up, Europe's political upheaval continues as Portugal's government collapses. We bring you the details next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators.
Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
In case you missed it on Bloomberg Surveillance, Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now, all the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Don't miss Bloomberg Surveillance, live every weekday.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Portugal's parliament has toppled the country's centre-right minority government in a confidence vote, likely leading to a third set of early elections in just over 3 years. Portugal's premier requested the confidence vote last week, saying he wanted to clarify whether his government had, quote, all the conditions to carry out its programme. The socialist and far-right party Chega both voted against the government. House Republicans in the US have passed legislation to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If a shutdown does go ahead, the White House Budget Office would decide which federal workers are furloughed and which essential staff must continue without pay. Coming up, we'll discuss the impact of Trump's tariffs and a rocky few weeks, of course, for the markets with portfolio manager from Franklin Templeton Investment Solutions. That is coming up next. This is Bloomberg.
up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The EU fights back just an hour after the US imposes global tariffs on steel and aluminium imports. The EU retaliates with duties on 26 billion euros of American goods. Asian stocks gain, though, with futures pointing higher ahead of US inflation data. President Trump downplays the risk of a tariff-led recession.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom.
Plus, Ukraine accepts a US plan for a 30-day ceasefire after 8 hours of talks. The White House puts the pressure on Russia, saying it takes two to tango. And talking of Ukraine, talking of defence, we have lines crossing from the German defence company Rheinmetall, which of course has seen a huge run-up in its share price. Year-to-date, gains of 87% for this German defence company. It is crossing right now and sees 2025 operating margin of between 15.5% to 16.1% in terms of the outlook for 2025. Operating margin at the top end, estimates it's seeing 15.5%. That is below the estimates of 16.1%. So in terms of the margin outlook for Rheinmetall, that is below the estimates, 15.5% versus the estimates of 16.1%. Full year operating margin came in at 15.2% for the last financial year. The estimates had been for 14.8%. So for the full year, the previous full year, it's a beat on the operating margin, but the outlook for the 2025 operating margin story is slightly below the estimates. It sees sales up 25 to 30% in 2025. Let's get more reaction analysis and bring in Bloomberg's Oliver Crook in Berlin, who knows this company very well and is looking at the numbers as well for the details and the context. Ollie, walk us through what kind of stands out to you on the margin story, sales, and how we should be thinking about this crucial defence player.
Yeah, so listen, Tom, I mean, looking at it, I mean, I think overall, in terms of what we said, looking backwards overall, there's a sort of a miss on a couple of points, whether it's on sales and operating profit, very light. But again, as you mentioned, the margin there, they did better than anticipated last year, and that's really what the key is for many analysts looking at this, the operating margin coming in at 15.2%, the estimate for 14.8%. But looking ahead, again, they're guiding a little bit lower on the margin than I think many had anticipated. So they're looking at basically 15.5%. Looking into 2025, they're looking for something just north of about 16%, but that still beats what we got from it last year. And again, when you look at the sales volumes looking into 2025, we're talking about sales increases of 25 to 30%, right? And just to give you a little bit of context, the top 5 performing stocks since 2022, since the beginning of the war in Ukraine, they're all defense companies. The only one of those whose gains are in the 4 digits, that means 1,200% gains, is Rheinmetall. Again, when we also think about the outlook for this company, it's not just going to be the kind of general defense spending. There's a lot of unknowns here, right? There's that German fiscal plan. If they're talking about setting up a defense fund that could be hundreds and hundreds and hundreds of billions of euros, what we know is that originally the defense fund that was already set up by Scholz, the 100 billion fund, about 50% of that was already captured by Rheinmetall. And when we look at the defense spending that's going to go across from European allies of NATO and basically where they're going to spend that money, again, there's more and more pressure that they spend that within Europe. And we're expecting, according to some of the analysts, that right now Rheinmetall gets about 3% of European NATO defense spending. That could boost to about 7 to 9%. So again, this outlook is going to be somewhat dependent on what these spending plans are going to be going forward. But we're also looking at the backlog. We've got another record backlog. That's another one at 55 billion euros. That's a line that's just crossing. And again, Tom, just to mention quickly on the backlog, this is one of the big issues that we're having for these defense companies. For the defense companies, it's great that they have a huge backlog. What's not great are for those waiting to actually get delivery of all this stuff. And this brings us to the conversation of actually getting that capacity ramp up. And that is going to be the big challenge for this industry going forward.
OK, Bloomberg's Oliver Crook on the ground for us in Berlin, breaking down the Rheinmetall numbers. And we're going from one of the primes, so one of the key defence companies, of course, within Europe, to one of the smaller startups later in the show. So stay tuned for that interview. From the defence story now to what is happening in terms of the retailer, the fashion retailer, Inditex coming through with the earnings line. The Zara owner coming through with a beat in the fourth quarter. Earnings before interest and tax coming in at 1.88 billion euros, above the estimates of 1.81 billion. And for the full year, net income for this company also coming in essentially in line, net income coming in line, but the earnings story in the full year for Inditex is a beat at 7.55 billion euros. Let's get to the broader stock market, of course, given the losses that we saw yesterday again on the S&P, closing in on that correction territory, down a little over 9% since its record highs, dropping 0.8% yesterday. The futures picture looking brighter today, though. Watching, of course, the tariff story, but the broadening out of Trump's tariff and trade war seems seemingly not putting a stop to the upside that's coming through from the futures story so far. Maybe the focus a bit more on what Trump has been saying about recession risks and, of course, the deal between the US and Ukraine. But we'll see how long this lasts, given those concerns continue around the growth story in the US. European futures pointing higher by 1%. FTSE 100 futures looking to add 37 points. S&P futures pointed gains of 0.3%. But again, after the losses of 0.8% yesterday. NASDAQ 100 futures looking to add 61 points. So European stocks looking to snap 4 days of declines. Let's flip the board and have a look cross asset then. Euro dollar, the last time I checked, was still above the 109 level. We continue to focus, of course, on money moving into US Treasuries. Yields down again 2 basis points on the 10-year, 4.25 as we lead up to inflation data out of the US, 12:30 p.m. UK time. Euro dollar at 109. You're looking at aluminium, of course, on the back of the tariffs that are kicked in now, 25% on aluminium and steel. That metal is up 0.2%, and Brent still below $70 a barrel. Let's get more on the markets now with Marianne Hofrichter, Vice President and Portfolio Manager at Franklin Templeton Investment Solutions. Marianne, thank you for taking the time. How do you think about adjusting the portfolio in light of these tariff risks? What is your assessment as well of today's relatively benign reaction to what we've seen from the Trump administration and the EU response?
Good morning, Tom. Thank you for having me here. So first, let's take a step back. What we are seeing now in the U.S., we see that those tariffs will damage not only the U.S. but also world economy, right? When tariffs implemented, basically all of that as released before, we assess that the average US tariff will go up from 2.5% to, let's say, low double-digit number. And this is assuming full reciprocity, 10% on Chinese goods and 25% on critical imports like aluminum and steel. And this will be the highest since 1942. So basically what will happen, it will dampen the international growth. And we know that elevated uncertainty will have impact not only on consumption, but also on corporates when delaying investments and hiring. So now we are seeing already a slowdown in some economic data in the U.S., measured, for example, by Small Business Optimism Index on the mainstream or services PMI or consumer confidence. So how do we implement it on the portfolio? So well, we are still relatively upbeat and relatively risk-on. We still think that U.S. exceptionalism is not yet over. Of course, the recession risk, as you said, are somehow increasing, and Donald Trump has not ruled out some pain on the economy. But I think it's important to look actually how this U.S. exceptionalism is explained. And we see Marjana, the factors yes?
Marjana, sorry, you've touched on a lot there, so I just want to kind of unpack some of that. On the recession risks around the U.S., what is your expectation then around how growth unfolds through the year? Why are you pushing back on the concerns from some that we could be hurtling towards negative growth in the U.S.?
Well, I guess the fundamental data are still relatively strong in the U.S., right? We see a lot of noise, and it's really difficult to look through all of that. But the fundamental data on the economy, even if some slowdown, they are still good. Corporates have just reported the earnings season was good, and we have seen also some broadening to other sectors out of tech. And basically this U.S. exceptionalism is basically explained by, tech and, the structural trend on artificial intelligence. This has got some scratches, but it's still And it is questionable, the whole story on AI and the U.S. economy, U.S. corporates in that sector. Maybe there are some questions on the sustainability of the high capital expenditures, and we have seen some profit taking here. But we are still have in place the high fiscal policy, expansive fiscal policy.
Yeah.
So thinking about such programs like Inflation Reduction Act. And consumer is still strong.
Marjana, on Europe, does European outperformance continue? Does it have further to run, or is it derailed by tariffs?
Well, I guess the tariffs that on aluminium and steel, they will have rather smaller impact on Europe. But also, let's take a step back here. So this outperformance of European stocks that we have seen since the beginning of the year is actually because Europe became more attractive, and the U.S. on the other side is more of a concern. So the European stocks basically have very cheap valuations. And we also have seen some stabilization of cyclical data like M1 or manufacturing PMI. And as already mentioned before in a daybreak, there is a really big expectation of a big government spendings going forward in Germany, but also on defense in the European Union. And last but not least, there is little exposure to IT sector in the European index. So all of that has made European equities attractive as compared to the US, where valuations are high, and as mentioned, DeepSeek has raised some questions and caused some profit taking.
Okay, Marjana Hofrichter, Vice President and Portfolio Manager at Franklin Templeton Investment Solutions, does not see an imminent recession in the US. Further upside, potentially, for European stocks, maybe down to not having too much tech within the mix. Thank you for the market take this morning. Coming up, how tech startups, talking of tech, can help drive Europe's security push. I'm going to be speaking to the CEO of an Estonian defence tech company aiming to reinvent Europe's air defence system, someone with deep experience within the space. That conversation's coming up. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Україна сприймає цю пропозицію.
Ukraine accepts this proposal. We consider it positive. We are ready to take such a step, and the United States of America must convince Russia to do the same. That is, we agree, and if the Russians agree, silence will take effect at that very moment.
Ukrainian President, of course, Volodymyr Zelensky speaking there. European governments, of course, planning to spend hundreds of billions of dollars expanding and modernizing their militaries, but they won't only rely on the large defense companies, the primes that dominate the industry, but also startups that offer rapid innovation. Among them is Frankenberg Technologies, an Estonian-based missile startup. Kusti Salm, the firm's CEO and a former top-ranked civil servant in Estonia's defense ministry, joins me now. Kusti, thank you very much. You have deep experience, of course, in the defence space around Estonia, given your previous role in the government, an instrumental role, and now, of course, leading this startup. Are you getting the funds that you need to build the technology that Europe needs to defend itself from Russia? Are the lawmakers paying attention? Is the funds flowing? Are we feeling the urgency right now?
Good morning. Good morning, and thank you for having me here first. Of course, I think
Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe.
The risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday following the biggest one-day loss so far this year. Equity futures just about stabilizing after getting hammered in yesterday's session. The sentiment shift has been absolutely wild, and the cuts to corporate guidance begin. Delta Airlines first out of the gate. Big declines this morning after slashing its outlook for the first quarter. The airline pointing to, quote, recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. That stock is down. The other airlines are as well. The question we've got this morning, who's next?
And the question here is, how quickly is this moving? To your point, earlier this year, in January, Ed Bastian, the CEO of Delta, said the supply-demand balance is as good as I can ever recall it being as we look into 2025, saying they had visibility. And suddenly, something shifted dramatically, and they said, we really do believe this is a domestic issue. It's not just who's next. It's just how quickly this is moving and how much the sentiment data really is going to be the key driver.
And later this afternoon, President Trump will be sitting down with a number of executives, and he will get a grilling about what is going on in terms of why you have this uncertainty. When you look at what corporate executives are saying, when you look at some of the survey data, the write-in statements, people are concerned about the direction of travel when it comes to tariffs. Chuck Robbins, the Cisco CEO who leads the Business Roundtable, had this to say in January: we won't always agree, talking about the Trump administration, but I feel confident that we'll have an opportunity to have that discussion. Well, that dialogue, Jonathan, will happen tonight.
Coming into 2025, as you know, sentiment among corporate leaders was sky high, and we wanted to see that translate into better hiring, into better investment. Small business confidence rocketed higher. This morning, small business confidence drops to a 4-month low, and plans to expand move in the wrong direction.
And it's exactly the wrong mix. It goes back to this stagflationary light type of mix, because not only is confidence going down, but the share of firms in the NFIB Small Business Confidence survey say that they plan to raise prices. That level increased the most since April of 2021. So what you can see is price pressure increasing at the same time that they have less confidence that the customers are going to be spending as robustly. This is on the margins. This is fast moving. But right now, because it is so quickly moving, hard data is less important on some level than the soft data that indicates the speed and the direction.
If you're a CEO sitting down with the president today, your number one issue right now has got to be clarity. You just want clarity on policy. And at the moment, we're facing what looks like maximum uncertainty. At what point, as an investor, this is what you'd be asking, I think, as well at the same time, at what point do we pass peak, maximum policy uncertainty?
I wonder if Donald Trump sees this as maximum uncertainty. When he was in the interview over the weekend with Fox, he talked about how actually he's being very clear about his goals, and that his goals have been laid out in terms of how he wants to rearrange the U.S. economy. My question is, does he recognize the sort of in and out tariff strategy that he has and what the consequences could be on business? Or is this a feature, not a bug? And is he saying, this is part of what's going to happen in order to rearrange some of the structure?
Well, we're not at peak uncertainty yet, because we haven't even have the entire menu when it comes to tariffs. We're going to get that on April 2nd. We also have 25% on aluminum steel coming into play tomorrow. And guess what? Retaliatory measures already coming from Canada when it comes to Ontario and what they're putting on electricity coming into the United States. This story This is just the beginning. It is not the end.
Equity futures this morning just about positive. We are bouncing back by just 0.25% on the S&P 500. Coming up later on in the program, Brian Levitt of Invesco following the worst day for the Nasdaq 100 since 2022. Rob Casey of Signum Global Advisors ahead of Trump's meeting with bank CEOs, and Alistair Pinder of HSBC after downgrading US equities. We begin this hour with stocks looking to recover after growth fears drove the S&P 500 closer to correction territory. Brian Levitt of Invesco writing, tariffs are likely to lead to a more volatile investment environment rather than result in a bear market for equities. I would not expect a broad decline in risk assets or a recession in the economy. Brian joins us now for more. Brian, good morning. Good to see you.
Nice to see you too.
Where does that more optimistic view come from? What underpins that?
So what underpins it is ultimately a belief that we will start to see a move towards greater clarity, but that gets called into question the longer that this persists. So my view in writing it was ultimately the administration will provide greater clarity around this. Look, tariffs result in less optimal outcomes, but as long as we know the rules of the game, businesses will get through it. And of the belief that, the Federal Reserve, given the recent inversion in the yield curve, will start to sound a more dovish signal. But the longer it takes for us to get there, we're at greater risk of these things happening.
When things like this do happen, and they happen often, we have these growth scares, you're waiting for that cathartic moment. Peter Chi of Academy said, this is the first day that feels like a real washout has been occurring. Mr. Krinsky over at BTIG, Jonathan saying, if you were hoping for an entry point, this is your chance. Have we had that cathartic moment yet?
I'm not sure we've had the full cathartic moment. I mean, I went back yesterday, though, and I looked. Yesterday was the 93rd worst day of the NASDAQ in 30 years. So let's put it into some perspective. I went back. I'm not the best at Excel. I'm almost 50 years old. But I brought up my Excel spreadsheet, and I looked at the other 92 worst days and said, well, what if I added money on each of those days? What if I withdrew money on each of those days? And obviously, you were better off adding money on each of those bad days, right? So I think most investors don't think that way. So you don't necessarily need the cathartic moment. I don't think we're there yet. I think there's more to go in terms of a bottoming process. But even if you're investing and you're halfway through a correction, historically, that's been quite good for investors.
More to go. What needs to happen for that cathartic moment? And then, frankly, for a steady climb upward? What kind of information do people need to see?
Well, we need clarity. I think Jonathan said the exact right word, which is we need policy clarity. And I go back to 2018 thinking about what was going on then when we were dealing with the U.S.-China trade war. So what ultimately led to a bottoming in the market? The United States and China got together and said, okay, 90-day truce. Well, that doesn't fully eliminate uncertainty, but 90-day truce. Federal Reserve came forward and said, all right, we're done raising rates. We may even be lowering rates in 2019. And that type of policy clarity is how you start to move forward. So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
Right now, the bulls on the street are basically coming out and telling us it doesn't really matter if we have ongoing policy uncertainty. On the fiscal side, as long as the Fed comes out and rescues markets, as long as they cut rates by enough, then you end up with a rally and a supported market. Do you agree?
Well, it can't hurt, but I think you're going to need it beyond just the Federal Reserve this time. You can't be making the cuts that you're making on the fiscal side and creating the uncertainty you have on the trade side and think that the Fed or Reserve alone, just bringing rates to neutral, can solve this. I mean, the reality is most Americans have fixed rate mortgages anyway. Most Americans didn't recognize the move up in rates. They're not necessarily going to feel it on the move down either. So you're going to need more than that. You're going to need trade and fiscal policy get to a place where we understand where it's going.
When it comes to trade, though, that uncertainty is why Donald Trump thinks he can have this negotiating power. How long do you think the market could sustain this uncertain period? Because it could be months.
Well, it could be months. I mean, we can, I don't know. So the word sustain, I mean, we can fall further from here, right? I mean, we're used to 5 to 10% corrections. They happen every year. Greater than 10 are less frequent, but they're almost always the result of policy uncertainty. And so the market could continue to feel pressure from it until you finally understand what the rules were going to be.
Do you sense there's a pain threshold within this Trump 2.0?
We certainly hope so.
Right.
You know, I mean, the idea of the Trump put is being called into question right now, but ultimately, I don't think this is an administration that wants to see the markets moving the way they are. Now, they may have an ideology around trade that they want to pursue, and they're not going to move away from it. But let's get with it. Let's figure out what the tariff rates are going to be, and let's move on.
In 2018, they tolerated much more than this, didn't they?
Yeah, 2018 we were down 20%.
Is that what you're looking for now?
It seems like you're moving towards that. I mean, right now the S&P's down 8.5%. I mean, we were down 8% when the Bank of Japan raised interest rates once last year. So this seems a little bit more challenged of an environment than that. Again, I come back to the fact, though, if you're an investor and you invest halfway through a downturn, you should be okay. So let's not try and get too cute with this, but it doesn't feel like the bottom is in yet.
Consumer discretionary is down 20% from the recent highs, led by Tesla, of course, but the airlines have started to participate. Dow this morning, down by something like 11%. What do you do with consumer-exposed names? When you hear Ed Bastian, the Dow CEO, say things like mid-February, consumer, business, purchases, activity just started to stall. He says it's going to be transitory. Do you think it's going to be transitory?
I do think it'll be transitory because this was an economy that came in with fundamental strength. Right? The consumer, where household net worth was at all-time highs, where the unemployment rate was near all-time lows. So it's a consumer that's coming into this in good shape. It's a consumer that's not over-levered. It's an economy that's not over-levered. We were in a good backdrop. The consumer right now is tightening their belt a little bit because they don't know, if they work for the federal government, you're not sure what your employment picture is going to look like. If you're in the market, you're not entirely sure what your household net worth is going. So you tighten your belt a little bit, but it doesn't feel like a recessionary environment. Now, could you get there with a prolonged period of uncertainty? Sure, but when you look at the usual indicators on a path to a recession, big leverage, big excess, corporate bond spreads blowing out, none of that exists today. And until corporate spreads really start blowing out, I'm not ready to think of this as a much more meaningful downturn, a severe recession. It's just not what the picture is telling us right now.
Initially, a lot of Wall Street firms agreed with you, but the downgrades have started to pour in. We've seen it from HSBC. We've seen it from Goldman Sachs and JP Morgan. Citigroup coming out, downgrading the U.S. Equities to neutral and upgrading Chinese equities. Yeah. At what point would you agree with them and say that actually, at the very least, to quote Citigroup, U.S. exceptionalism is at least on pause?
Well, we're upgrading European equities as well. I mean, we've increased our exposure to European equities earlier this year. And why? It's not complicated. Leading indicators in Europe were climbing. The economic indices were surprising to the upside. The European Central Bank was easing. It was a better mix versus sentiment in the United States declining in a period where valuations were more heightened. So you're getting these cyclical bounces. I always say these markets, everyone's waiting for things to be good in Europe. No, markets move on better or worse. By the time you wait for good, it's already happened. The bigger question on Europe now is not just the cyclical bounce. Is this something more structural? And with the investment that you're seeing, the borrowing that you're likely to see out of Germany, is this more structural? They have a chance. Now, can we get 27 countries to agree on it? We'll find out. But there is certainly a chance. And yeah, I mean, sometimes it's real simple. If you're easing policy, it's a better backdrop. If you're pursuing tighter policies, it's a worse backdrop, and it behooves investors to think about those parts of the world that are being more stimulative right now.
Is Citi making the point that the better news will come from elsewhere over the next several months? It won't come from here.
What's interesting is that Citigroup thinks that better news is going to come from China, whereas HSBC thinks that better news is going to come from Europe. It's sort of like pick your poison. Where in the world you think that it could potentially have better information coming
on that call, that downgrade to U.S. equities, HSBC joining us a little bit later this hour, so look out for that. Small business confidence came in about 12 minutes ago, and small business confidence came in lower, 4-month low. There is a nugget in here, though, that got my attention, and I think it got Lisa's too. The share of owners who said it would be a good time to expand declined by the most since April 2020, and a gauge of capital spending plans matched an almost 5-year low. That is not what we want to see coming into 2025. Brian, thank you. It's good to see you as always, sir. Brian Levitt there of Invesco with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. First, I wanted to give you some of the details on that Citi downgrade you mentioned. So it did downgrade its view, as you said, on U.S. equities to neutral from overweight. At the same time, they upgraded China to overweight. They cited valuations, government support for the tech sector specifically, and more generally, a tech breakthrough. HSBC similarly cut U.S. stocks to neutral yesterday while upgrading Europe. Volkswagen shares surged after it reported a strong result and encouraging guidance, up 3.3%. The German automaker expects to maintain profitability this year, despite muted demand in Europe and rising trade tensions. Volkswagen is also under pressure to stabilize its performance in China, where local manufacturers like BYD are taking market share. Now to the downside, Delta shares plunging in the pre-market trade, down 10.6%. If it sticks, it would be its worst day since 2022. It cut its profit expectations for the first quarter roughly by half on weakening travel demand. Delta's CEO blamed a drop in consumer confidence for the decline, but believes that the impact will be temporary. And that's your brief. John.
Danny, thank you. That stock down double digits in the pre-market. One to watch going into the opening bell. Up next on the program, losing hope for the Trump put.
The strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets. And I think it's, sort of a deterioration in the data.
Rob Casey of Signum Global Advisors joins us next, live from New York City this morning. Good morning.
Youth unemployment is an issue in all labor markets. That's why it's one of the major pillars of the conference. One of the difficult things in dealing with labor market that if you change anything, it takes years for us to be reflected. That's the right thing to do, to look at the future and prepare from now. If you have the best practices, the right data, you will be able to overcome any difficulties or challenges. I'm hopeful about the future of the labor market.
Check out shares of Delta down 11% in the pre-market. The guidance was only 2 months old. They came out and slashed it by almost half. In mid-February, consumer spending, business spending stalled out, reinforced by some air safety events. They acknowledge that. They also say this is going to be transitory. That as we work our way through the rest of the year, at least we'll get a rebound.
We'll find out, of course, as the week policies start to get decided upon. They basically said that this is mostly a domestic issue and that uncertainty was creating a real paralysis when it came to travel, but their full year forecast stayed the same. We'll see. There is a sort of expiration date on how long paralysis can continue before there are potential consequences.
The first big company out of the gate on the S&P 500 to really slash expectations. Equity futures elsewhere bouncing back by 0.4%. Ugly session yesterday. We're up by 0.5 on the Nasdaq 100. Out of surveillance this morning, losing hope for the Trump put.
The Powell put, the strike price on that is lower than we thought, and we learned more about that last week. But also, I think the strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets. And I think it's, sort of a deterioration in the data and what that means for the outlook going forward.
So here's the latest this morning. President Trump meeting with top CEOs and Wall Street bank executives today as markets face uncertainty and recession fears. Bloomberg's Tyler Kendall joins us from the nation's capital for more. Tyler, this could be box office later this afternoon.
Right. Well, John, we are expecting those members of the Business Roundtable to try to seek some firmer guidance from President Trump as this White House continues to not give us any indication that they plan to change their policy rollout, which has been marked by so much uncertainty and contributed to this remarkable shift in market sentiment in only 50 days. We have to remember that is only how long President Trump has been in office. And just yesterday, a statement hit our inboxes right after the markets closed with a White House official appearing to blame this on emotion instead of fundamentals, writing, quote, "We want to emphasize that we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses. We've repeatedly been pushed towards by officials. Recent examples of investment under this new administration, such as last week, for example, TSMC pointing out $100 billion in new investment as sort of evidence that these plans that the White House is starting to put into will have longer term impacts. But at the same time, the question becomes, will the White House make any assurances of any kinds as we try to seek more certainty from this White House, or whether or not they will continue to double down that this is all part of a broader macroeconomic plan and consumers and investors alike need to be patient. I actually had the chance to catch up with NEC Director Kevin Hassett at the White House yesterday, who told me that until President Trump's full policy plans are implemented, there's actually only so much they can do to counter what this White House has been pushing as structural issues left behind by the Biden administration. But, John, how long that argument can go on for remains to be seen, and we could get some answers later on today. 5 p.m. Eastern is when President Trump is set to address the business roundtable. We're still chasing exactly who will be in that room, but no doubt they're going to want some firmer guidance.
Tyler Kendall of Bloomberg, looking forward to your coverage later on this afternoon. You know the cheat guide, Biden data, right? So it's Biden data.
Biden data, Biden mess. We need to come up with policies to fix it up. I think it's a stretch to suggest that the small business conference read this morning is Biden data. Which raises this question of how seriously is President Trump going to take it when he meets with his business roundtable later today. Rob Casey of Signum Global Advisors with us around the table. Rob, good morning. Good morning. It's good to see you. Chuck Robbins leads that business roundtable of Cisco. Reportedly, we could be expecting JP Morgan's Jamie Dimon, Citi's Jane Fraser a little bit later on. What do you think the message is going to be to those guys?
Well, I think the message is going to be have a little patience, have a little faith, right? And maybe look through a little bit of the uncertainty that we've seen over the past couple of weeks. Now, that's probably going to be the message. I'm not sure it lands.
When it comes to Chuck Robbins, in January, when he talked about the wild card, he called it, in terms of trade policy, he said he wanted to see a surgical approach. Are we seeing anything of a surgical approach when it comes to what they're doing right now on tariffs?
No, I think so far the threat of tariffs has been a blunt instrument, right? It's not the scalpel approach that Trump has talked about. Going forward, could it be, sectoral? Could it be pulled back a little bit? Yeah. Honestly, I think so. We don't think we're going to see universal tariffs. I think that's baked in. We also, frankly, don't think that on April 2nd we're going to see a snapback of 25% on Mexico and Canada. So maybe it gets, a little bit more targeted, or at least broadly targeted towards Europe, I think, generally speaking. But it's a blunt instrument, and we haven't seen the sort of, I think, very Scott Bessent preferred, very targeted approach that maybe we could have.
When it comes to the market sell-off, is that enough to push the administration to hold back on the 25% we're expected tomorrow on aluminum and steel?
On aluminum and steel, no, we don't think so. Frankly, that is a domestic industry that President Trump really wants to protect. It's a domestic industry that has asked for these tariffs. So unlike autos, et cetera, that have been pushing back on the threat of tariffs, aluminum and steel want to be protected, right? U.S. aluminum and steel want these tariffs on. So we expect that they will be on as of tomorrow.
To build on what Anne Marie was getting at there was this theory heading into 2025 that there was a Trump put, that ultimately that would be the ultimate check on the Trump presidency. If the market really did tumble, there would be a response. What are we saying now is the check?
Well, I think there still is a Trump put. It's just a little bit lower and maybe a little bit more painful than we would like, right? But when, as we go back over the course of the past 50 days, the vast majority of tariff threats that Trump has made, he either hasn't followed through on or he's reversed the next day in the case of Canada and Mexico.
Maybe so, but that hasn't given a boost to markets that are still grappling with a great deal of uncertainty. And we haven't even seen the bazooka, the big one that's coming on April 2nd. Some people have suggested that maybe it's the polls, and that right now polls are hanging in there. That, frankly, Donald Trump's support is a little bit lower than where it was at the beginning of the presidency, but it's still significantly above where it was the last time around. So do you agree with that idea?
Yeah, I agree with it, but not in the sense that Trump is looking at polls day to day, right? He's never going to run again. A couple of clients every once in a while will push back on the idea that maybe he will run again in 3.5 years. I would not expect that. But I think the mechanism for the Trump put, or at least the Trump concern around polls, is not Trump polls, they're congressional polls, right? If I'm running in a red or purple district in a year and a half, I'm going to President Trump and saying, please, please, please allow me to run on something positive, right? And we haven't seen that so far.
Well, he lashed out last night at one congressman saying, I'm going to primary you if you don't sign up for my continuing resolution that's going to hit the House floor today. Does it pass?
We think it passes the House. Or potentially could pass the House. We don't think it passes the Senate, frankly. I mean, Democrats have to take a stand somewhere. this is really the only place that they can take a stand, right? When it comes to reconciliation, they can't do anything to stop it. But when it comes to this CR, as much as Speaker Johnson wants to call it a clean CR, it's really not. And so we think, even if Republicans can get it over the line in the House, it doesn't pass the Senate later.
So they rather take the blame potentially for shutting down the government?
I think so, honestly. And we're hearing Democrats go back and forth. But yeah, I mean, listen, this is not a clean CR, right? And so I think Democrats will try and message that. We haven't seen much messaging from Democrats over the course of the past 50 days at all. But that's assuming that Republicans in the House can get this over the line. And frankly, it's not only Massey who is a no as of now, right? We've heard that Trump has made calls over the course of the past 24 hours to get Kat Kamik and others over the line. They have, obviously, I mean, we've said it every day, they have a very slim majority in the House, maybe a little bit wider because some Democrats are staying home, but it's going to be really tight.
Rob, good to see you. As always, thank you, sir. Rob Casey there of Signum Global Advisors. If you are just joining us, equity futures are bouncing back by a third of 1% on the S&P. Yesterday, the biggest one-day loss on the S&P 500 of the year so far. On the Nasdaq 100, the biggest one-day loss going back to 2022. There have been some downgrades out there, including this one. In just a moment, we'll catch up with Alistair Pinder of HSBC after downgrading US equities in the last 24 hours to neutral and upgrading the rest of the world. We need to talk about Europe with HSBC in just a moment. Live from New York City this morning. Good morning to you all. This is Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Let's check out the scores this morning. Equity futures on the S&P 500 bouncing back from yesterday's losses, but it's not much of a bounce. Up by 0.4% on the S&P. On the Nasdaq, up by 0.5. Yesterday, the biggest daily loss of the year so far for 2025, taking the losses to about 9%, almost 9% lower from the all-time highs of only a month ago. Those all-time highs feel like a lifetime ago.
Let's put that into market capitalization or perspective. Since February 19th, the Nasdaq is down $4.2 trillion worth of market capitalization. This is a massive amount of wealth that has been removed from this equity market.
It's not just tech either. Discretionary stocks, led by Tesla, of course, but beneath the surface, other names as well have been hammered. They're down 20% from the highs of December. The banks, the KBW Bank Index, wiping out the gains from the post-election rally.
Since February 18th, the KBW Bank Index is down almost 16%. That is traumatic. And you have to wonder how much this is reversing some of the trade from the end of last year and how much this is looking at exactly what the NFIB survey pointed to, which is stasis when it comes to investment and when it comes to deal making.
The only good news I've got for you from the last 24 hours is bonds did what bonds should do, and they rallied, particularly at the front end of the curve. Yields dropped by double digits, down by about 11 basis points on a 2-year this morning, up by 2. The 2-year at the moment, 390.60. 10s right now at 421.87. Lisa mentioned a small business survey coming through at a 4-month low. Plans to expand dropping as well. Everything just moving in the wrong direction at the moment in the survey data. Want to finish on foreign exchange and take a sneak peek of what's happening with the euro. Euro dollar shaping up as follows in the FX market. The euro at about 108.88 and positive by 0.5%, getting closer and closer to 109. On our radar this morning, shares of Delta Airlines falling in pre-market trading after the company delivered a disappointing forecast. Delta cutting its profit expectations for the first quarter roughly by half on weakening travel demand. That stock down 11%.
The problem here is the pace of the decline. The fact that in January, Ed Bastian, the CEO of Delta, came out and said that demand is about as strong as it's ever been and that, frankly, the demand-supply picture is very balanced and very good. All of a sudden, people aren't traveling anymore, and it was mid-February, and he said that this is a U.S. domestic issue. He does expect it to subside. But the speed of this is what's going to get people's concern. And the reason why soft data right now might be more important to people than backward-looking hard data that tracks an economy that might have looked very different, say, a month ago.
You can make up a lot of excuses for this. You can say that seasonally, the first quarter for the airlines is not great. It's difficult to predict. You can say this was reinforced by the air travel safety events of the last month as well that made people nervous. And maybe as the year progresses, we'll work our way through this. But I think there's some obvious things to point to that could stick around. If you're a federal worker right now, I wouldn't be booking a vacation. I'd probably be cancelling my vacations. And a whole load of people around those people, these things can unravel and bleed out through the rest of the economy pretty quickly.
It's not only the threat of potentially losing your job. If you have lack of conviction, how do you go out and pitch business? How do you go out and try to make deals? These are some of the things that we have seen trickle into the soft data. Delta's still seeing the same full-year forecast. At what point does that materially shift the trajectory versus just being a short-term uncertainty blip?
And let's see if the other airlines follow. We'll be looking out for them throughout the next couple of days, that's for sure. Let's turn to this story. Canada slapping a 25% surcharge on electricity it provides to Minnesota, Michigan and New York in retaliation for President Donald Trump's tariffs. The move coming ahead of fresh U.S. tariffs on steel and aluminum set to take effect tomorrow.
This is really the first blow of the whole tariff agenda. These retaliation in terms of energy Ontario provides to a number of states in the U.S. Donald Trump late last night came out and said, we don't need your cars, we don't need your lumber, we don't need your energy, and very soon you will find that out. Well, I think a lot of businesses, and even anecdotally, I spoke to a board member of a lumber company in Maine. Anecdotally, they'll tell you all of our energy is coming from Canada. We ship our product to Canada, and then they bring back the finished material to the United States. This is going to get tough, and Doug Ford yesterday spoke to Kaylee and Joe on Bloomberg TV and was saying Trump has created this chaos, and he says this has unleashed patriotism in Canada they have not seen.
Elisa talked about this a few times over the past weeks, the potential for that to start happening. It's very difficult to forecast to see the consequences of increased tariffs, primarily because of how others might respond to it, but also for how the market responds to it as well. One thing that surprised us all, tariffs up, dollar weaker, not stronger. The euro stronger again this morning, 108.83. We're up by 0.4%. I want to talk about the latest out of Germany. Germany's Greens saying they are ready to negotiate a defence spending deal and are hoping for an agreement this week. This coming after the party rejected a debt finance package that would unleash hundreds of billions of euros in spending. I want to stick with Europe. The EU looking to boost investment and prepare for expected tariffs from President Donald Trump. Bloomberg's Ollie Crook joined us from Germany in the heart of German business. Ollie, walk us through what you're hearing from the likes of VW about the latest push in Europe.
Yeah, so Jonathan, I mean, you talk about the sort of uncertainty that's been thrown up by the Trump administration on the question of tariffs. I mean, this is a sort of front and center for here, Wolfsburg, Germany. This is one of the biggest manufacturing sites in the world, probably the biggest factory in Germany. This is where Volkswagen really made all of its cars historically. This is, got huge assembly lines and absolutely massive in terms of generating output of cars. And this is sort of in the sort of center of the discussion here because Volkswagen has had to face the reality of a sort of much tighter squeeze in China. They've had to have a much slower situation here in Europe. They've had to cut down assembly lines. This used to put out 4 lines. They're moving this to 2. What they've had to focus on is their growth market, and that is the United States, right? And that is what is coming into complete sort of disarray now. I spoke to the CFO a little bit earlier. Nobody really wants to give you a sort of scenario of what 25% tariffs looks like. They all say wait and see. But have a listen to what Arno Antlitz, the chief financial officer of Volkswagen, had to say to me earlier.
We feel already like an American company. Mm-hmm. Look, we operate a huge factory in Chattanooga with thousands of people there. Volkswagen Group of America employs more than 20,000 plus people, create safe and well-paid jobs. We invest in South Carolina. So we think these should be taken into account when talking about tariffs and Volkswagen and talking about the U.S.
So you can hear it there from the executives, the kind of the pitch to Donald Trump of why they should be sort of exempt from tariffs. But it's not just about tariffs between Europe and the United States. A huge part of the Volkswagen strategy has been establishing a battery factory in Canada, establishing the VW Gulf factory over in Mexico. All of these things are being caught up. And listen, I spoke to a number of executives over the last 24 hours, really pressing them on what tariffs would mean. Nobody wants to give you a whole lot. But what I can tell you is that this is a market, the United States market, that they want to double their market share in. It is the only major market that grew last quarter, and they will hold on to it to the bitter end. So if that means augmented capacity in the United States, I suspect they're ready to do it.
Those plans have been totally upended in many ways over the last month or so. Ollie, appreciate the breakdown. Bloomberg's Ollie Crook there, the latest from VW and some of the automakers and some of the challenges they face right now. These are some of the challenges that investors face too. And what are they doing? They're fleeing into European markets and downgrading US equities. Alistair Pinder of HSBC writing, prior to the US elections, we assumed a Trump victory would reinforce US exceptionalism. We are upgrading Europe, excluding the UK to overweight. We are downgrading the US to neutral. Alistair joins us now for more. Alistair, good morning. Good to see you.
Thank you very much for having me.
Let's talk about the reasons behind that call. Start of the year, you were thinking what a lot of people were thinking, US exceptionalism. What changed?
So what did we underestimate? We underestimated the potential for governments to essentially retaliate to tariffs and, retaliate to the wavering support to Ukraine and also defense spending for NATO with their own fiscal stimulus. And we saw this in China with the NPC, and we're now seeing this in Europe with Germany embarking on what seems to be pretty sizable fiscal stimulus, almost 1 trillion euros split between defense spending and infrastructure spending. Again, for me, the real catalyst is the infrastructure spending here, because I think that's going to what has the real repercussions for economic growth. And we're starting at a place where actually Europe looks very cheap. It had been completely disowned by investors. It was trading at a significant discount to US markets. And we're now seeing the stars kind of align. And you mentioned the euro, it's 108. But, for the majority of the year, it had been depreciating. It's still below its highs. That's also a modest tailwind for earnings as well. So the backdrop, in my view, is turning very favorable for Europe at this point.
We've been talking about whether it's the U.S. pushing money out of the domestic market or if it's the rest of the world sucking money out of the United States market. Where do you fall on that question at a time where it's less, at least according to your note, about U.S. policy and more about better opportunities elsewhere?
I think it's definitely the latter, as you mentioned. I think, one of the things that we're seeing in what gets you excited into going to other markets internationally, you have to see investment opportunities. And I think, the two biggest conviction calls that we have at the moment has been China and has been Europe, and both of them have been driven by their own catalyst. In China, it has been fiscal policy and DeepSeek, and that's been driving the internet sector. In Europe, it has basically been the shift in mindset of governments, which is going to basically unleash fiscal spending and support, economic growth. And I think that, for me, is what's going to drive people into Europe rather than the other way around.
What's the risk that this is all good? You get this incredible rally, as we've seen in European equities, until April 2nd. And then Donald Trump comes out with the big one, and it's the reciprocal tariffs. And all of a sudden, people start thinking about what the financial repercussions are for places like Europe. And suddenly, the fairy tales are over, and you're dealing with fights in different legislative bodies over what kind of spending you could have. How big of a risk is that?
So let's put some numbers into context here. So 25% of European equity markets revenue comes from the US. That's a lot. But actually, a lot of that is not exposed to tariffs at all. So services, like software and services, don't get tariffed. And actually, there's a lot of companies that produce in the US and sell in the US. That's avoidant of tariffs. So actually, net, what do we think is, exposed to tariffs? Less than 10% of revenue. So much less than what people, I think, assume. And it's very specific in certain sectors. It's the consumer staples, some consumer discretionary, and also the autos, of course. But outside of that, I think in the industrials, I think in the tech, I think in the financials, I think they're going to be much more resilient to the tariff risks than people believe it.
So right now, would you advise avoiding those tariff vulnerable sectors?
Yeah, I think that's, that would be our policy, is 100%, be more sheltered into areas which are resilient to tariffs. And, that's, again, on a global basis. I think that's a theme that we see in the US, where, again, we would be more cautious on the consumer discretionary consumer staples sector, where they import a lot. And so, therefore, they're more vulnerable to tariffs from an earnings hit. But it's also the case, again, I keep highlighting China here, but China's equity market revenue from the US is just 3%. It's negligible. It doesn't make a difference. So again, I actually think China, despite all the tariff headlines, is actually more of a defensive play from an international context.
Do you think there's a point at which the administration steps in? The so-called Trump pill has been talked about a lot. Do you think there is a pain threshold for not just the Trump administration, but also for the Federal Reserve as well? And in your mind, I imagine we're not close right now, but how much closer are we?
I mean, I don't think we're at that point, but I do think we're getting to the point where if you look at what markets are pricing, we talk about a lot about these recession risks. I think we're pricing in a lot of recession risk at this point. We have a probability of what equity markets implying that's jumped up 10-15% over the last week alone. If you look at the typical equity market performance during recessions, it's around 10 to 15% downside. we're pretty much there. For me, I feel like we're pricing in a lot of downside. Can it go lower? Yes. But at that point, you're going to see bond yields start moving lower. You're going to see that Fed put come in. And so again, I think you're completely right. And then going to your point earlier, we do have this risk event on the 2nd of April. But beyond that, I actually think the outlook is much more favourable.
Just out of interest, do you think that view about the growth scare in equities is being confirmed by fixed income? We saw high yield spreads blow out just a little bit yesterday. Do you think it's being confirmed by what you're seeing in high yield?
I think it's being confirmed by what we're seeing in the 10-year bond yield, right? Which is that you're seeing that roll over pretty sharply. And again, that's seeing this underperformance of cyclical stocks versus defensives at this point. So yes, I think we're seeing that reflecting across most asset classes at this point.
Alistair Pindra of HSBC, thanks for joining us. Appreciate it. Downgrading US equities, saw something similar from Citi in the last 24 hours. Lisa, that view on a high yield's one to watch. Yes, spreads have started to widen out, but if you look at absolute levels of around 300 basis points, people might sit here and say that's still pretty tight.
Yeah, some people might also argue that it isn't necessarily the canary in the coal mine that it used to be because of the dampening effect of private credit, and that's the reason why Alistair went to the 10-year yields. There is this question, and the reason why I'm actually very curious to get CPI tomorrow, a question of if it comes in hotter than expected and inflationary pressures are still there, how much does that force the Fed's hand and actually raise the bar that much higher for them to really provide that relief valve on the other side with potential cuts?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
That's the fear, and that's the reason why, if there is an upside surprise in that CPI report, people might actually take notice. It's just one to watch at a time where that is one of the concerns out there.
So bearish, just kind of.
Okay, well, the market yesterday was pretty. Okay, what do you want to do?
Take a shower. Equity futures on the S&P. That's what I want to do. It's not a suggestion. We're up by 1/3 on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some breaking news earlier in the hour. Shares of Southwest down 2.7% in the pre-market. It is ending its free bag policy. Customers will be charged for their first and second checked bags unless they hold top-tier loyalty status or are traveling on a business fare. The changes apply to flights booked on or after May 28th. Oracle shares also lower in the pre-market, down by nearly 2%. It had disappointing quarterly results. Its sales and profit forecast for the current quarter also fell short of analyst estimates. Oracle did report a surge in bookings, though, and said its cloud infrastructure business will boost revenue over the next 2 fiscal years. Elon Musk has blamed what he calls a massive cyber attack for widespread disruptions on his social media platform X. Tens of thousands of users globally reported intermittent outages on the app, with new posts failing to load for users. Darkstorm, a pro-Palestinian so-called hacktivist group, took credit for the attack via its Telegram page without providing proof. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding. But I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
Tesla stock having great difficulty. Joanne Feeney of Advisors Capital Management joins us to talk about that and a whole lot more from New York City. This is Bloomberg. Equities a little bit firmer, up by 1/3 on the S&P. On the Nasdaq 100, terrible day yesterday, up by 0.4% this morning. Under surveillance this morning, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding. But I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
But there's no turning back, you're saying?
I'm just here trying to make government more efficient, eliminate waste and fraud, and so far we're making good progress.
So here's the latest this morning. Elon Musk Tesla facing its worst day in more than 4 years in the last 24 hours. The stock looking to recover this morning after tumbling 15% yesterday. The Nasdaq 100 posting its worst day since 2022 with more than $1 trillion in value wiped out. Joanne Feeney of Advisors Capital Management joins us now for more. Joanne, it's been too long. Welcome back to the program. Let's talk about this correction we've seen in big tech, how you view things, what's driving it, and whether now's the right time to step back in.
Yeah, good morning, John. There's obviously a lot of fear out there in the market. We've seen the VIX spike up, and the fear is centered on the uncertainty that investors and businesses now face because of the back and forth we're seeing on the potential tariffs that we're going to see not just on Canada and Mexico, but Europe, and then on specific industries, whether it's timber out of Canada or aluminum and steel. So that level of uncertainty creates a lot of challenges for businesses. They tend in these moments to want to pull back on things that have an irreversibility component to them, capital investments, and even hiring. It's not so easy to fire people once you've hired them. And so we see the businesses in some sense freezing in place. And I think the Delta results kind of, helped, confirm that. Business travelers are down, even consumer traveling is down. And I think that's a sign of businesses tightening their belts and saying, let's wait and see what happens.
Let's look on the bright side. Do you like that, John? Is that
nice.
Good? Yeah, let's look on the bright side. A lot of people were really optimistic about U.S. dynamism, and now you can get it at a discount. Why not go in now?
Well, there's good reason and good opportunities out there right now, Lisa, and that's because there are still pretty good growth drivers in some areas of the U.S. economy. And the U.S. as a whole doesn't have to be exceptional for there to be good opportunities. I mean, the AI revolution is still ongoing, and there's really not a lot that's happening now that's likely to disrupt that. We're still seeing major investments in data centers, and even after the DeepSeek scare, right? Companies that are putting their money where their mouths are saying there's still a lot we want to be able to do with AI, and we're going to continue to invest to make that happen. So those companies in the middle of that are still, in fact, better opportunities now than they were a few weeks ago.
So are you buying?
We have pretty full positions where we want to. We've owned NVIDIA for a long time. We've owned Broadcom for 10 years. And we've owned a few select others in the software space, in particular, like a ServiceNow, for example. We don't think that it's wise to try to time this market. We don't know when sentiment is going to change. Obviously, there's been a risk-off trade. Investors that weren't diversified are trying to get diversified. So we're seeing other stocks in the market do relatively well. But it's always tricky to try to say, well, uncertainty, we know there's a lot of it. Maybe we should back off of growth. But if you're a long-term investor, this might be a time, if you don't have a full position in names like the ones I just mentioned, it might be a good opportunity to get in there, even though these things could still go down for a while this uncertainty plays out.
Jonathan kicked off the conversation showing how bad of a day Tesla had yesterday. Do you think there's going to be political blowback, not just when it comes to Tesla and you see some of the registrations plummet when it comes to those cars being bought in places like Germany because Elon Musk and backing the AFD, but also places like Canada? Will there be a boycott of American goods?
Anne-Marie, we're starting to see that. In Canada, they're taking American liquor off the shelves. We've seen surveys that show that Canadians are buying less goods out of America, whether that's from Amazon or others. So, we're seeing that certainly. And if you look back historically, we've seen this sort of thing before. Whether it was the 2018 tariffs or all the way back to Smoot-Hawley, we did see other countries respond either with retaliatory tariffs or simply with protests. And that caused, in some cases, back in the Smoot-Hawley era, exports to those countries drop as much as 23%. So those are real concerns that one has to watch out for. That's why, you can position away from some of the products that are in the, squarely in the headlights of this sort of risk. I mean, invest in more domestic companies, McDonald's, Altria, things where demand is less elastic. These kinds of companies are likely to do better in this kind of an environment.
Joanne, you mentioned 2018. How useful is that period as a playbook? Because the drawdown back in 2018 was far more substantial than the one we've seen so far on the S&P 500.
Yeah, it's hard to tell, Jonathan. I mean, clearly the tariffs that are being bandied about now are much bigger than those in 2018. So if they were to go into effect, the economic effects would be larger. But, now we have something we didn't have back in 2018. We have this AI revolution. It's not just for the picks and shovels providers like NVIDIA and Broadcom, but it's also for those that could adopt AI to make their businesses more productive or to create new products. So we have a growth engine that's real, that's identifiable, and that's multi-sector that we didn't have back then.
Joanne, appreciate your time, as always. Breaking down some of our stock picks this morning. Joanne Finney there of Advisors Capital Management. One name that was mentioned, let's talk about Delta. Delta down in the pre-market by close to 10% at the moment after slashing their outlook for Q1. So much of the soft data is about feelings. I feel this way, I feel that way. This is more than that. They're telling you what consumers and businesses have actually been doing since mid-February. And those companies, those people have been pulling back.
What they've been doing is nothing, and nothing has a cost. Nothing is a choice, as you've pointed out. So there's a question of how long this can continue before it starts showing up in the hard data and has some lasting effects. Right now, Delta is saying there still is a reversibility to this. What does President Trump have to say today at that business roundtable to get the confidence of business CEOs?
He's going to get a bit of a grilling, you have to think. When you have the Delta executives coming out and saying consumer spending started to stall. They're saying they're not telling us they're going to do this. To your point, Jonathan, they aren't booking the flights. What I thought was interesting about Delta is they're seeing this more domestically. I wonder if this puts a cap on U.S. exceptionalism because they're still seeing people buy some flights when it comes to international travel.
The President and Secretary Besson have been pretty consistent. Is the message really going to change today? That we're going to end up in a better place? We're rebalancing the economy. There might be some disruption, but bear with us.
You know, you have to imagine they're going to stick with it.
It's the message so far. Let's see if it changes. Up next on the programme, we'll catch up with Scott Lincecum of the Cato Institute, Holly O'Neill of Bank of America, Kelsey Barrow of JP Morgan Asset Management. The second hour of Bloomberg Surveillance. Up next.
The focus has shifted dramatically to the downside growth risks for the U.S. economy.
We've had a weaker view of the economy, going into this year already, and I think we've seen that in the data.
High inflation is going to be what it becomes more problematic for the American psyche.
Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears.
I don't think it's a United States recession. I think it's a Washington, D.C. recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Horder.
Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now, and your day ahead looks a little something like this. 3 things to watch. Later on this morning, some more economic data. Look out for jolts. Job openings. Another read on the labour market coming later this morning. Look out for the press briefing from the White House later on this afternoon. And then this one, 5 p.m. Eastern Time. The President of the United States sitting down with business leaders for the Business Roundtable. Cisco's Chuck Robbins leading that, and reportedly we could see JP Morgan's Jamie Dimon, Citi's Jane Fraser in the room down in Washington, D.C. at the White House at a time when we came into 2025 with business confidence sky high, that business confidence slowly being eroded on the back of the policy uncertainty over the last month.
You asked last hour, is there any reason for them to change the stance that they've had already, which is essentially this is by design. Stick with us. Have faith. We are going to have a grand plan. It just is going to take some time. Is there any reason for them to change that tone right now within the Trump administration when they talk to business executives at a time where there is a wobble in the stock market? But they have said they're okay with that. There is a transition period. There is a detox period. And so that is really going to be the tension this afternoon.
It's coming at a time when we've seen a series of downgrades from economists and from investors alike. I'm thinking of Mike Gapin over at Morgan Stanley, who downgraded the growth outlook for America, upgraded his inflation forecast. Investors doing the same thing. We spoke to HSBC about 25 minutes ago. They've downgraded US equities. Citigroup has done exactly the same thing. Citi pointed to the idea that better news will come from elsewhere. That better news won't come from the United States, at least for the next several months. Why? Because we want some policy clarity around things like tariffs, and maybe for the next several weeks, we won't get it.
We might not get it, but that is the one question I think all of these executives that are going to have a chance to speak to the president today at 5 p.m. at this business roundtable are going to ask. They want to have a dialogue, and they want some sort of clarity when it comes to the tariffs and trade headlines. Also interesting, when you see advisors that are close to the president, maybe outside the administration, something else you see a lot of people pushing for now, and potentially this shows that the administration is concerned about the market downturn, even though they've doubled down on their language. They want to bring up the tax cuts. The sequencing is key here. And I imagine all these executives want to know when that bill might get signed.
Up until recently, this has just been talk and feelings. In the soft data, we feel like things aren't going so well. We feel a certain way. Now I think it's action. With the move from Delta Airlines over the last 24 hours, after the close yesterday, slashing its outlook, the stock down this morning by 9% in the pre-market, and the company coming out and saying this: a recent reduction in consumer and corporate confidence caused by increased macro uncertainty driving softness in domestic demand. Ed Bastian, the CEO, saying that in mid-February, companies, consumers, activity started to stall. Now, they're making the case that maybe that's transitory and it bounces back in the next several months. The fear is it won't.
And the fear is it is happening so quickly. Ed Bastian in January said the supply-demand balance is as good as I can ever recall it being as we look into 2025. And now, just 2 months later, it is a completely different story. They still are maintaining full-year forecasts, but the speed, and we keep going back to this, the speed of the shift in tone is shocking, and it has gotten a lot of people attention. And we've asked this question before, John. Who is going to be next at a time where this is really going to be the ongoing theme?
The answer to that is American Airlines, right on cue. They say the revenue environment was weaker than expected. The outlook for the first quarter, Lisa, adjusted loss per share of 60 to 80 cents. They had seen a loss of 20 to 40. They say revenue environment weaker than expected. They say this also. They cite Flight 5342, softness in domestic leisure. Now, this is the issue that Delta brought up as well, and it's difficult to disconnect the two things. On the one hand, you've got a slowdown in consumer spending, one. Two, you've got the why. Is it because people are worried about the economy, or are they worried about flight safety? And it's very, very hard to divorce the two, and I guess we're going to see in the next several months.
Ed Bastian did refer to this in a recent interview yesterday where he said that there was some kind of ramification from that. American Air citing that, as you just mentioned as well. At the same time, we've had flight issues for a while. They haven't seemed to impede demand to a great degree. Was this different, or is there something else going on? And whether this is confirmation bias or whether this is idiosyncratic, we have also heard warnings from the likes of Walmart. We've also heard warnings from the likes of Target and Best Buy. So this is the reason why not only is President Trump's stance today, this afternoon, at that meeting going to be very important, but if the guidance continues in this vein, it is harder to dismiss this as an idiosyncrasy related to air flight safety.
The 5-day moves have been brutal. You've got American Airlines down by something like 5% of the pre-market. I mentioned the move we're seeing in Delta. Even before these moves, the 5-day move down 10% on American, United down 15%, Delta down by 14%. It's a whole lot more than just air safety issues. It's certainly a whole lot more than that.
Well, you talked about this, and honestly, at a certain point, you have to wonder, okay, am I being too gloomy? On the bright side, how do we look at this? But if people are getting laid off, or they feel like their companies aren't going to be getting certain federal contracts, or frankly, there just is a paralysis with respect to business investment, why would you double down on travel? Why would you double down on taking vacations? How many people right now are taking long vacations as they try to deal with the barrage of headlines that's headline roulette at this point? Not many, especially not if they're on Wall Street or a business.
Look, I joked about you being too gloomy. I just think this is the reality of the situation. I've said it repeatedly coming into 2025. I'm not scared of saying this out loud. I want them to succeed. I want anyone in the White House to succeed. And what I mean by success, I want to see better hiring, I want to see more investment, I want to see higher levels of growth at a time where we've been blessed with pretty decent levels of growth. Confidence into 2025 was sky high. Why? Because this was going to be a business-friendly administration. And we wanted to see that translate into better hiring, better investment. Confidence for businesses, particularly small businesses, has started to decline. We saw that with the Small Business Confidence Survey this morning, 4-month low. And the plans for hiring, the plans for investment. Look at this for the plans for investment. The share of owners who said it's a good time to expand declined by the most since April 2020. Unfortunately for the administration, that is not Biden data. That's Trump data.
That's Trump data, and you see this show up in a lot of surveys when it comes to consumers as well. Not just the fact that more people are concerned potentially about losing their job, you see the Doge effect, but also when it comes to tariffs, if companies are going to put that price hike onto consumers, they're going to have to pay more for their everyday goods, let alone how can you think about taking a vacation. What is so different, Jonathan, in Trump 2.0 than what we saw in Trump 1.0 was the sequencing. Trump slashed taxes before beginning the trade war. Right now you have this uncertainty, this overhang, this fog of what trade's going to look like before we even get to the tax bill.
There's a chance we work through this. Of course there is. There's a chance we get to a better place. And the strategic anchor of the equity bulls out there remains the same. We understand what they're trying to achieve. Rebalance the economy away from public spending towards the private sector. But they acknowledge, even the president acknowledges, there will be some disruption in between. this is the kind of disruption we're getting right now. The data speaks for itself.
The problem is, what are the relief valves? And we talked about this heading into this year. There's the Trump put, the idea that if the market goes down too much, President Trump would come out and respond. That's been pushed off. There's the Fed put, the idea that the Fed will come to the rescue. That's the reason why CPI data is going to be so important tomorrow, and why on that survey from the NFIB, the fact that companies are looking to raise prices at the highest pace going back to 2021 raises some concerns. Does that push off some of the Fed relief valve? These are some of the questions people are trying to grapple with at a time where there's a lot of uncertainty, and people are trying to figure out when's the break point where they can get some more clarity.
The small business optimism retreating this morning is going to get the administration's attention, because the only comment we got out of them yesterday was that they think that there's a divergence between what they're saying, what's happening in the stock market and animal spirits, versus what they see unfolding for businesses and business leaders. They think that's more important. When we look at business leaders today, they're concerned.
If you are just joining us, welcome to the programme. Equity futures just about bouncing back, but that bounce fades. We're positive by a little more than 0.1% on the S&P 500. In the last hour, small business optimism falling to a 4-month low in February. Bloomberg's Mike McKee joins us now to break it down. Mike, let's talk about why and what underpins that shift lower. Why that softer sentiment?
Well, I think you can see it in one number, and that's the uncertainty index rises to 104, and that's the second highest level ever. It's not like the economy has fallen off a cliff, but nobody knows what's coming next, and it's very hard to plan. So you see the 10 different indicators that the small business owners fill out, 7 of them were negative. 3 were positive, but the ones that were positive weren't particularly great. More job openings that they can't fill, earnings trends up by just a little bit, and then expecting easier credit conditions up by a little bit. And that would suggest maybe people think things are bad enough that we're going to start to see the Fed cut interest rates again.
Mike, can you give us a sense of how much of an about face this is at a time where, as John mentioned, coming into this year, confidence among small businesses was sky high?
Oh, it's a big about face, not only for small business, but for large business as well. And I think it comes back to the fact that throughout the campaign, Donald Trump said, on day one, I will. And day one has come and gone. This is the 51st day, halfway through the 100 days, and he hasn't yet. We haven't seen much except the turmoil of Doge firings in Washington. And so people are starting to say, well, wait a minute, what's actually going on here? And why all of a sudden are we talking about pain instead of immediate gain?
Mike, do you think this now starts to bring up a different conversation at the Fed, maybe bringing up this idea that we can see Fed cuts sooner?
Well, bring up maybe, but at this point, the Fed is stuck like everyone else in not knowing what's going to happen. And we have tomorrow tariffs on steel and aluminum. And then the first week in April, we have tariffs maybe on Mexico and Canada and China and who knows who else. And so as long as there's that uncertainty, the Fed's going to sit tight because the economy is still growing. And inflation is still coming down very slowly, but still coming down. So they don't have to move. So I think they'll be as quiet as possible about the outlook going forward. And we just have to let the markets divine what the Fed is going to do for the time being.
That meeting a week tomorrow. Mike McKee, thank you, sir. Bloomberg's Mike McKee breaking down the softer than expected small business confidence print we got in the last 60 minutes or so. A week tomorrow, March 19th, the Federal Reserve's got to get together, decide on interest rates. Based on the communication and the guidance from basically the whole committee, there's going to be no action next week. But then they've got to put out forecasts, Lisa, and putting out forecasts, I think, gets so much harder, and it's certainly harder than it was the last time they did this.
Why don't they just put out some numbers and say, look, these are made up. We have no clue. We're in a black box right now. And essentially everybody knows that. The dot plot has been gaining a lot less relevance over the years as it's been wrong again and again. So at a certain point, do you dismiss that and start to talk about things like what they have been talking about, which is weighing the idea of softening growth with sticky inflation? How do they measure those two things?
Equity futures right now positive by about 0.2%. Let's get you an update on stories elsewhere, including an update on the latest in the airline sector. In your Bloomberg brief, here's Danny Berger. Hey,
yeah,
Danny.
John, another airline, another dour outlook. This time, American Air, those shares falling 3.4% in the pre-market. It cut its forecast. It reported weaker than expected revenue in this environment. American expects a loss of 60 to 80 cents a share, grappling with weak leisure demand and a fallout from a fatal collision in Washington. Elsewhere, the House Freedom Caucus has backed a stopgap funding package to help Speaker Mike Johnson pass the bill without Democratic support. If passed, the bill would reduce and then freeze spending for 6 months. It would add $6 billion to defense and $440 million to immigration enforcement, while cutting IRS funds by $20 billion. And in sports, Manchester United is planning to build a new 100,000-seat stadium in a bid to modernize its facilities. The stadium will be built next to its current home of Old Trafford, where the club has played for the last 115 years. Man U did not say how much the stadium would cost or how long construction would take. It's set to become the largest stadium in the UK. And that's your brief, John.
Got to make sure they don't get relegated first, Danny. Danny, thank you. More from Danny in about 30 minutes' time.
Who's gloomy now? Look at this.
Fans are going to hate that.
Oh, really? Why don't you cheer up, John?
I'm not taking it back. Up next on the programme, Canada retaliates.
I always say when the market speaks, you have to listen. The market is speaking. CEOs are speaking. People are speaking out. I don't believe in protectionism with your two closest friends and allies in the entire world.
Up next on the programme, Scott Lincecum of the Cato Institute from New York City this morning. Good morning. Unwinding just a fraction of yesterday's moves on the equity market, up 1/3 yesterday, the biggest one-day loss of 2025 so far. In the bond market, yields were lower across the curve, down 11 basis points at the front end. Further out along the curve, the 10-year up today by not even a single basis point. The 10-year yield 4.2225. At the surveillance this morning, Canada retaliates.
There's one person that will put us in a recession, and that's President Trump. I always say when the market speaks, you have to listen. The market is speaking. CEOs are speaking. People are speaking out. Why is he doing this to his largest customer in the world, Canada? No one buys more products off the U.S. than Canada does, including autos. I don't believe in protectionism with your two closest friends and allies in the entire world.
So here's the latest this morning. Canada responding to President Trump's tariffs on the country by slapping a 25% surcharge on the electricity it provides to Minnesota, Michigan and New York. Trump responding on Truth Social, writing, Ontario just announced a 25% surcharge on electricity, of all things, and you're not even allowed to do that because our tariffs are reciprocal. We'll just get it all back on April 2nd. Bloomberg's Tyler Kendall joins us now for more. Tyler, that relationship is getting more and more tense by the day.
Yeah, John, and later on in that interview, the Premier of Ontario said that he is coordinating closely with Mark Carney, who we have to remember over the weekend in his victory speech said that Canada is now clouded by dark days brought on by a country they can no longer trust, meaning the U.S. We know Canadian consumers have already started to boycott U.S. goods as well as the use of Amazon. But as we look forward here, of course, this administration keeps pushing us towards those reciprocal tariffs on April 2nd as kind of the end-all solution to any of this heightening in rhetoric that we're seeing. But first, of course, is tomorrow, those 25% tariffs on steel and aluminum. We know Canada, for example, is the #1 exporter of aluminum to this country. And at the moment, the White House is telling us not to expect any sort of modifications. That's the word that they use, meaning exemptions or carve-outs, although, of course, all of that can change. And while producers have largely applauded this move, domestic producers in the U.S. wanted to see this, we have to keep in mind that this also applies to those downstream metal products. Think things like car bumpers and wires. We'll be watching closely to see if manufacturers indicate that they will pass those higher costs off to consumers, because while we've been talking a lot this morning of how it appears the White House appears to have this higher tolerance when it comes to a market sell-off, we'll have to see whether or not consumers have a higher tolerance for a tick up in prices, and if that could potentially serve as a check on this administration's policies, since we know that President Trump has been pushing that he will bring down prices.
Tyler, we also know the president will be sitting down with CEOs later today. What are we expecting to happen at this business roundtable?
Well, as you guys have been discussing all morning, it's no doubt that those CEOs are going to want some firmer guidance, some firmer clarity when it comes to President Trump's tariff plans and the uncertainty that has been surrounding them. But we should also point out that the last time President Trump addressed the Business Roundtable was when he floated that he would put forward a lower corporate tax rate. And there is no doubt that they are going to be looking for any sort of assurances there when it comes to President Trump's tax cut agenda, which, Anne-Marie, we know is already starting to face some pushback in the U.S. Congress. Not necessarily that lawmakers don't want to see it through, but how it is going to get through, particularly whether or not his 2017 tax cut plan can be made permanent, or whether all those other tax priorities like no taxes on tips, overtime pay, or Social Security can end up being on the table if Republicans can find those pay-fors.
Tyler, appreciate the update. Tyler Kendall in the nation's capital down in Washington, D.C. Joining us now to extend the conversation, Scott Lincecum of the Cato Institute. Scott, welcome back to the programme, buddy. It's good to see you, as always. Let's just take a step back. Can you think of a historical parallel that speaks to the moment we're in right now regarding trade?
You'd have to go back a long way. I mean, you're really looking at Smoot-Hawley level tariffs if these reciprocal ones kick in and this everything else we have so far. It really has been that long. One of the, I think, mistakes people make is looking at the first Trump era and saying, oh, well, that didn't hurt. Those tariffs didn't hurt the economy that much. But we're talking in terms of both the size of the tariffs and the speed of them. It really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
We also see trading partners react. Ontario putting tariffs on electricity going to certain states in the United States. What kind of retaliatory measures are you expecting as well?
Yeah, the thing that I'm looking at most are asymmetric retaliation. So not tit for tat tariffs on goods because from the United States, because, those tariffs are going to hurt Canada or Mexico or China as well. But there are a lot of other ways that countries can retaliate against U.S. businesses that are less painful for them and more painful for the United States. You mentioned, export taxes on electricity, boycotting American liquor in Canadian liquor stores, but the Chinese removing business licenses for certain American multinationals. There are all sorts of ways that governments can go after U.S. interests without just simply slapping tariffs on stuff.
Scott, in Trump 1.0, we saw carve-outs and exemptions, especially from downstream companies, for those companies that maybe make products when it comes to steel and aluminum, which we get those tariffs tomorrow. Are you expecting any sort of exemptions?
I think in the longer term, there has to be. But it really, we just have to wait and see with this administration. We're not just talking about steel and aluminum that's more expensive here in the United States. In a lot of cases, you're talking about steel and aluminum that simply isn't made in the United States. And in some cases will never be made here because it's specialty items, for example. In those cases, American manufacturers are just going to have to eat the tariff. And that's a major cost hit for a lot of companies that produce things that are really reliant on those metals.
There's this ultimate goal of bringing production back to the United States. This is something that President Trump has talked about, which is the reason why I was really struck by an automotive news study that shows that about 1/3 of U.S. auto parts suppliers, they would move production out of the United States if 25% tariffs on Canada and Mexico stick. Can you explain this counterintuitive trend that actually might do the exact opposite of bringing manufacturing to the United States?
Sure. Well, we have to remember two things. One is that there are places that have lower production costs than the United States, of course. But second is that the U.S. consumer market simply isn't driving the global economy bus. And for a lot of companies that have business elsewhere, there isn't an incentive. Just move your business that you aren't serving the United States offshore to places that don't have high tariffs on your input costs, don't have all this uncertainty, and don't have the threat of retaliation if you're potentially exporting. So, it's just a numbers game for a lot of these companies. And oftentimes, the economic reality is that numbers make more sense to move your business out of North America, out of the United States, than to pull it in.
Scott, some people have argued that the ultimate goal of this administration is something that everybody can get around, the idea of reducing waste in the government, the idea of broadening out the middle class and bringing certain types of business back to the United States. A lot of people have been talking about that on both sides of the aisle. Is there anything that you see going forward that really does give you hope and optimism that maybe even some of these negotiations will ultimately lead to lower tariffs, or there could be some sort of clarity that comes after April 2nd that gets us closer to that place?
I wish I could be really optimistic here, but the last couple months don't give me grounds for confidence. Yes, I think you could see a few tariff reductions in a few markets. India lowering tariffs on motorcycles, or the Europeans maybe trying to lower tariffs on cars. But the reality is that this shoot first and negotiate later strategy creates intense geopolitical and political problems for foreign countries. It's really difficult for leaders that have to win their own elections abroad to cave to Donald Trump and suddenly liberalize tariffs. And that's why over the years, countries have engaged in free trade agreement negotiations to lower tariffs overall, to not do this reciprocal tit for tat thing, but instead kind of achieve a general level of liberalization that matches while protecting certain sensitive industries. That has tended to work pretty well, including for the United States. But this strategy of using tariffs to bully other nations into lowering their trade barriers, it didn't work much during the first Trump administration, and it hasn't worked much in the 80s and the 90s, and I'm worried that it's not going to work very well again today.
Scott, Lisa's trying to be optimistic. You're not helping. Scott Lincecum there of the Cato Institute.
Should
Scott,
be.
appreciate it. Thank you. Up next, Holly O'Neill of Bank of America on the state of the U.S. consumer. From New York, this is Bloomberg. Lisa's mood's turned happy, almost optimistic, constructive.
You asked for
happy
this.
Because the market's down, or happy because you think things should be better?
You told me to take a shower, so I took a shower.
No, I said
washed it off.
Yeah. I said I needed one. That's different. Equity futures right now in the S&P, positive by a third of 1%. If you're just joining us, I'm not explaining. On the Nasdaq, up by 0.4%. Let's get you some movers 2 hours away from the opening bell. Your morning movers with the wonderful Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. This market is the most oversold since 2023, but there's no good news at Delta. What you've got here is a great and fast unwind from clarity and vision at the start of the year on earnings to a knock of 50%. 30 to 50 cents, that's what they're going to earn. We were looking at 70 to $1. This is about lowering the guidance. The question is whether it's a domestic U.S. fissure in confidence, and does it morph into something which knocks the premier front part of the plane on the transatlantic route. Right now, down 8.1%. Tesla down 15% yesterday. You've got that. The worst day since 2020. The halo effect is gone. In other words, that Trump bump by association is now gone. President Trump says he'll buy a Tesla today to show support for Musk. The reality is it's about deliveries. UBS say down 16% in the quarter, down 5% on the year. I leave you with a view on Oracle. This is about a divergence between the numbers and the guidance, down 1.2%. Safra Katz, the CEO, says more capacity is coming online. Our revenues will grow in 26-27. The market is impatient. Larry Ellison talks about hyper growth. I leave you with a thought. The cloud. Infrastructure, application and revenue, all lighter than the market had estimated. This is about the data and the figures versus rhetoric and the forward guidance. Jonathan, good morning.
Manus Cranny, good morning. And thank you, my friend, for everything. Appreciate it. Thank you very much. On our radar this morning, Ontario, Canada, raising prices on all power exported to Minnesota, Michigan and New York. The move part of retaliation against President Donald Trump's tariffs. The latest push from Canada, the latest tension between the two nations.
And it really points to what people didn't expect, which is the resentment that would set in and the fact that political leaders would have to show force against Donald Trump to really cater to their own populations. This idea that not only that, but they would have to come up with some sort of fiscal plan or some sort of political unity. I mean, it's helpful to have a common enemy. And that's essentially what President Trump is offering, a whole host of governments that he otherwise would like to see come down. But that's essentially what he's done.
Doug Ford, the premier, was on with Bloomberg last night. He was talking about Trump has created this chaos. He said Trump will single-handedly be the individual that brings on a recession. The jury's still out on that, by the way. And he's talking about the fact that this is not going to stop because there's patriotism now running wild in Canada. And you know what? You see that in the polls. Trump almost had it where we were about to usher in a conservative leader in Canada. But now the patriotism we're seeing, they're rallying behind Trudeau's party, which is now the party of Mark Carney.
Polyev must be fuming. 20-point lead for the Conservatives over the Liberals. What, 2 months ago? That change has just been humongous over the last 60 days or so. There is a meeting later on today, so just keep this in mind. 5 p.m. Eastern Time, a meeting between the Business Roundtable and the President of the United States. That's led by Cisco's Chuck Robbins. And sources are telling us here at Bloomberg that the group could include Wall Street bosses Jamie Dimon and Jane Fraser. This conversation at 5 p.m., I hope we get to see some of it, is going to be very important.
Up until now, there has been this placating type of approach when it comes to CEOs going down to Washington, D.C., having conversations with President Trump. What can we do for you? How can we rewrap some of our plans and goose them up a little bit and make them look like they're even better? How can you use us as an excuse of the dynamism of the American economy? The tone is going to be different. What do they ask for? And can President Trump give some clarity at a time where he says that he already has, and he has a plan? How does he give clarity without backtracking on some of the plan?
They want clarity, but part of his approach is to be uncertain because if he's negotiating, he wants to have that leverage over allies and foes. I want to see what the tone shifts from individuals like Jamie Dimon, who a month ago said, so far so good when it comes to Trump's use of tariffs. He then went on to say they do get people to the table, they do piss off allies, they're confusing and stuff like that, but they can have negative consequences. So first they were so far so good, but they could have negative consequences. Are we at that point where Jamie Dimon walks out of that meeting and says they do have negative consequences?
I wonder if Elon Musk will be in the room. Elon Musk saying that entitlement spending, including Social Security and Medicare, is next on the Doge chopping block. Musk arguing the federal programs are plagued by fraud. There was a really nice sit-down conversation between Elon Musk and the former NEC director, Larry Kudlow, just yesterday.
The issue with this, of course, is that, yes, Elon Musk is correct when you talk about what is the massive piece of pie when it comes to government spending. It's going to be entitlements. But this runs absolutely counter to what Donald Trump made in terms of promises on the campaign trail and in office. He will not go after Social Security and Medicare benefits. Elon Musk, though, First Buddy, is saying that's something he's looking at. So we need some clarity on that as well.
Is the president buying a Tesla today?
That's what he says, according to his Truth Social. Well, look, it was just after midnight, so I'm thinking he said this morning as in a few hours because he probably didn't go to bed yet, or it could be tomorrow. I'm just wondering if he's going to buy, the small, model,
he's
or is he going to buy a Cybertruck?
100% he'll drive it up.
Come on.
Of course, drive it onto the wall.
A golf cart? That would be very Trump.
That would be hysterical.
Drive it around the White House.
And then leave it there?
That would be cool. Let's talk about CPI. The data drops tomorrow. Get another read on the US consumer, a read on the labour market later on this morning as well when we get jolts. The Bank of America Institute releasing its latest consumer checkpoint survey. The team writing the following. The consumer is still demonstrating underlying forward momentum, though at a more measured pace. I'm pleased to say that giving us some time this morning is Holly O'Neill, the president of retail banking at Bank of America. Holly, welcome back to the programme. A warm welcome to Bloomberg Surveillance. We've heard from a few companies in the last 24 hours, from Delta Airlines, from American Airlines, that maybe the consumer was a bit softer in February. We're just wondering, Holly, whether you see anything of the same at all in your business.
So I think you had it right when you said continued forward momentum, but at a more measured pace. And in February, we saw a little softness mid-month in certain regions in Texas on the East Coast. We really think driven by weather. And in most of those locations, it recovered by the end of the month. So when you look at the February spending data that we have, it was up month over month when you seasonally adjust it. So even though there was some mid-month disruptions with weather, we saw most locations recover from that.
Holly, on what, though? Recover in terms of spending on consumer discretionary, on groceries? I mean, we've been talking all morning about the airlines coming out and saying that they really haven't yet seen that recovery in some of the domestic travel spend. Is that really being focused in, say, buying food for families?
Sure. So overall spend recovered. So our total debit and credit card spend was up month over month, seasonally adjusted. So that includes everything. When you dig in underneath on the grocery front, grocery spending was up. And we actually, within those numbers, you saw value grocery spending up, premium grocery spending down a little bit. So overall groceries up, but you saw the consumer adjusting where they were spending their money.
So this goes to this question of, is this a head fake? Are people getting a little too carried away with the narrative that sentiment is deteriorating so rapidly that spending is falling off a cliff and that's going to stymie any kind of American exceptionalism? Would you push back against that and say, actually, what we see is just the same as what we saw before, which is a moderating trend, people looking for value, but otherwise a consumer that's still pretty healthy?
That's right, a moderating trend. And you really do have to separate what sentiment says versus what consumers are actually doing. And so that spend data, the grocery trends that we talked about, the overall spend, that is what consumers are actually doing. And we do at times see a difference in sentiment and their actual behavior. And I think that's very important. So again, continued forward momentum, but at a more measured pace for the consumer. We did not see spend fall off a cliff, as you said.
We've also talked about the fact that delinquencies on credit cards have been creeping higher. We have seen some signs of distress in auto loans. I'm just wondering where fact meets fiction, right? Where stories have gotten carried away from each other, from themselves, versus any kind of true warning signs that you're seeing in any of the trends that you monitor.
So from a credit perspective, we're seeing a very normalized environment at Bank of America. And in fact, we're seeing delinquencies, somewhat stabilize and are expecting them to come down as the year goes forward. So we're not seeing any unusual patterns there. And I would call it a very normalized credit environment from what we're seeing with our clients.
You mentioned the potential tariff impact in your report. What sectors are you seeing that bleed into this potential increase in prices and then potentially what it might be harder for consumers?
So we'll look at the consumer as a whole, right? And we'll look at high-income consumers. We'll look at low-income consumers and watch what their patterns are. But as we talked about with the groceries, consumers do self-regulate with shifting prices, and I would expect nothing different no matter what tariff environment comes through. So we'll watch the consumers really closely as to how they adjust their spending patterns if prices were to increase.
Do you see any policies out of Washington hitting consumers right now besides trade?
We are not. I mean, again, across the board, we're seeing very normalized, good momentum with the consumer overall. So we're not seeing anything underneath from Washington come through now.
Holly, just to finish on what's been happening with interest rates have stayed much higher for longer at the Federal Reserve, but rates at the long end, something that this administration has celebrated, have started to move lower, which is important for mortgages. What are you seeing in terms of credit access, and are consumers trying to step up or are they holding back?
I would say consumers continue to borrow. Consumers continue to borrow at a normalized rate, and we see that in our credit card data. So average borrowing from our credit card borrowers is slightly above where it was pre-pandemic. So they still have access to credit. I think from a mortgage perspective, we haven't quite seen the demand really flood back into the market. We're still seeing purchase volume, but again, because of the rate environment, that refi volume is certainly at the lower end. But that's something that we would expect to come back as the rates change.
Holly, appreciate it. This was an important update on a day where a lot of people are concerned about the consumer. Holly O'Neill there of Bank of America, the president of retail banking. What we've seen so far then from the companies, the likes of Delta, the likes of American Airlines, seeing a softer consumer than anticipated only a few months ago. What we've seen in the surveys is things really soften up. Saw that from the New York Fed just yesterday. What you're hearing from Bank of America, which has literally millions of bank accounts for retail accounts in the United States of America, is yes, things have moderated, but you still have that forward momentum.
They still saw an increase that was significant in travel spending, which I thought was interesting when I looked at their recent study, because it just highlights that it's not as clean a story as it may seem. You talked, though, about the New York Fed survey yesterday. Mean unemployment expectations jumped 5.4 percentage points to 39.4%, its highest reading since September 2023. The sentiment is concerning for people because it's happening at all ends. At the same time, right now, you're not seeing it in the hard data.
Not yet. And maybe we will in the months still to come. Equity futures right now on the S&P, positive by 0.5% with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Western security officials say Russian President Vladimir Putin has no intention to compromise on land, peacekeepers, and Ukraine's neutrality in any peace talks. Those officials said that Putin has made a maximalist list of demands ahead of negotiations and is prepared to continue fighting if his goals aren't met. Greenland is heading to the polls in a general election that will determine the country's path to independence from Denmark. All leading parties favor sovereignty, but the winner will get to define how and when Greenland becomes its own nation and which countries it may align itself with once that happens. Elsewhere, Apple is preparing a major software overhaul. Bloomberg has learned that Apple is planning to transform the interface of the iPhone, iPad, and Mac, aiming to make its operating systems more consistent and simplify navigation. The revamp will be unveiled at Apple's Worldwide Developers Conference in June. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some.
Up next on the program, Kelsey Barrow of JP Morgan Asset Management. Live from New York, you're watching Bloomberg Surveillance. The airlines in focus this morning. Check out these two names, both American and Delta. Delta is down by 7. It was a whole lot worse than that. It was down by double digits earlier this morning after cutting its guidance yesterday for Q1, slashing the outlook for the first quarter. Who was next? American Airlines was next. That stock is down by 3.6%. Getting an update also from Dick's Sporting Goods. The airlines are telling us that the consumer started to pull back in the middle of February, and businesses did too. The outlook at Dick's in focus here, Lisa. The stock down by close to 4%.
A similar type of tone as the airlines. And there was a question, how much is the airline story idiosyncratic because of safety concerns? Dick's Sporting Goods also gives a downbeat outlook, talking about, quote, the dynamic macroeconomic environment as leading to some of the concerns that they have. You're looking at some sort of earnings per share being as low as $13.80 for the upcoming year versus the expectation of $14.23.
Why don't they just say it? Why do they have to say the dynamic macro environment?
Macroeconomic environment.
Why don't they just say policy?
Well, and actually we heard directly that from Ed Bastian. I think a lot of pause. Take a step back. This is very quickly moving, and we have gone from a scenario, I can't believe you're making me justify this, where companies were concerned about invoking the ire of the White House, to now trying to give a slight suggestion that maybe this is problematic.
And maybe we get an update on that slight suggestion at 5 p.m. Eastern Time. Later on this afternoon, the Business Roundtable sitting down with the President of the United States. Under surveillance this morning, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some. That's great because the world's looking at a period of time right now where you have kind of debt spending internationally and some austerity or restructuring in the U.S.
So here's the latest this morning. U.S. Treasuries rallying yesterday as the S&P 500 nears correction territory. Kelsey Barrow of JP Morgan writing, amid the uncertainty, one detail is clear. An allocation to high-quality fixed income is once again serving as a diversifying ballast in investor portfolios. Kelsey joins us now for more. Kelsey, good morning. Good to see you.
Good morning.
Let's pick up on what Steve Chevron said there at the end. Maybe some austerity in America, and I stress maybe. And you put that up against perhaps a real expansion of the fiscal deficit over in places like Germany. What does that mean for treasuries in an international bond market?
Yeah, so I think that you've hit on a really key point. We've been very focused on the U.S., what's happening in the White House, but there are seismic shifts happening outside of the U.S. right now. And the shift in Europe towards defense spending and towards infrastructure spending is really an important shift that we're seeing. And while we're talking about in the U.S. that bonds are serving as a diversifying safe haven. So while stocks are going down, bond prices, you have U.S. Treasuries, agency mortgages, investment grade credit, all up in price yesterday. In Germany, you have essentially the opposite, which is bonds have been hit massively. Bond yields are up, but stocks are up in Europe too. One of the biggest trades that's been in place for at least a year has been the investment of foreign investors in U.S. equities on an unhedged basis, right? They wanted the U.S. equities and they wanted it unhedged because nothing's ever going to happen to the dollar, right? That, I think, is the biggest trade that is in the process of being reevaluated right now.
You think we're unwinding that big dollar long we've built up over the last several years?
That is what it appears. It's not going to be a straight line, right? But I do think that what has been underestimated is not what the U.S. is doing, because that's been out there. Trump's been talking about tariffs. Trump's been talking about layoffs. What's been underestimated is the response from the rest of the world. We knew they would respond. The magnitude of the response has been the surprise.
There's a real question embedded in this observation about the shift in the balance of dollars and the dollar long, which is if money is moving away from the United States, do long-term treasuries offer the same kind of ballast, or will there not be the same degree of demand for them because some of that money is diverted elsewhere, say, to Germany?
So I think that we can differentiate a bit between the equity markets and the dollar trade and the bond trade. Typically, you think about them together, but what we've seen over the past few weeks is you can have periods where the Treasury market is getting a bid, long-term yields are falling, and the dollar is softening modestly. It sounds like a bit of a paradox, but I do think it's something that can continue to occur. One thing that will be on investors' minds as we move forward is the deficit trajectory, right, in the two places. In Europe, we're seeing for the first time Germany is considering a deficit, considering more deficits as an advantage to them. At the same time, the U.S. is considering the fact that deficits are not our friend anymore, and we need to be managing them much more closely. As long as those two, that sentiment continues, I think that you can continue to see the support in long-end treasuries. And on the other hand, I would expect Europe, Germany to continue to underperform.
I would love you to have a debate with Ashok Bhatia of Neuberger Berman, who was on the show yesterday. At some point, I would love to witness you guys have a discussion about this. He was saying he actually is getting a little bit more bearish on long-term treasuries. What he sees is this concern that even as people price in Federal Reserve rate cuts, that stickiness and inflation and that real kind of floor under how far the Fed can go and ongoing deficit concerns that are not going to get fixed by simply cutting on the edges. It will take something more sustainable, is going to really create a problem longer term for the United States and for the Federal Reserve. Why do you disagree with that the term premium is just going to be structurally higher in the United States?
Well, I think the term premium already is structurally higher, right? So if you're a longer term investor, if you are, looking at the market over a 5 to 10 year horizon, you're already observing that term premium in the U.S. is substantially higher. Yields are substantially higher than they were before. So I think that story is already essentially in the price. And what we're looking at now is that there's quite a bit of demand at these yield levels, particularly when you have a Fed that is maintaining an easing bias. Yes, inflation has been a bit stickier than before, but it's our view that ultimately what is going to get the Fed moving more aggressively in terms of rate cuts is if we start to see the weakness translate into weaker labor market data.
High yield spreads wider yesterday by almost 20 basis points, back through 300. Is that a buy yet? What are you looking for?
So it is interesting. This goes back to this kind of question of, is it the spread move that people care about or the price move? So spread buyers are saying, great, okay, we've had a bit of a backup. Maybe this is an opportunity to get in. On a price basis, most of the high quality part of the high yield index those bonds have not really moved down in price very much because the yield movement has offset the spread widening. So I think you could view that in two ways. One, maybe there's a little bit more pain to come, but also I would say it's really credit towards the strong fundamental starting point for investment grade and high yield bonds in this market. And I don't think we shouldn't lose sight of that. Coming into this year, growth was very strong. Defaults continue to remain very low. Margins for companies were at the higher end of their ranges. So companies are probably as best placed as they possibly can be for the difficult times ahead.
Kelsey, appreciate it. Kelsey Barrow there of JP Morgan Asset Management. Corporate America is still resilient. It's a message we've heard over the last number of years.
Corporate America that borrowed bonds a while ago and then locked in financing costs in the high yield bond market.
Everyone else, if you haven't done that, might be a problem. Coming up, Matt Miskin of John Hancock, Ben Callow of Baird, Lindsay Piegza of Stifel, and Lindsay Rosner of Goldman Sachs. The third hour of Bloomberg Surveillance up next.
The risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures near session highs, positive by 0.5% on the S&P 500. The next stop for this market, just in terms of the economic data, about 2 hours away. In 2 hours' time, the JOLTS job openings read. Job openings in the United States of America, another read on the labour market worth looking at. Then later on this afternoon at about 5 p.m, the Business Roundtable, led by Chuck Robbins of Cisco, sitting down with the President of the United States. Included in that meeting, reportedly, potentially, Jamie Dimon of JP Morgan, Jane Fraser of Citi, coming at a time when business confidence and small business confidence specifically, Lisa, is just starting to soften.
We saw it roll over to the greatest degree going back 4 months in the NFIB Small Business Survey earlier this morning. We're hearing from a host of different companies that they are downgrading their outlooks in the near term because of consumer uncertainty. We're hearing that across the board, across industries. At the same time, Holly O'Neill really presenting the opposite view, which is consumers are still spending. Watch what they do, not what they say, and that has been somewhat different.
There is still that forward momentum. Are we losing some of that forward momentum, though, for consumers? So let's go to the airlines. We've heard from Delta, we've heard from American Airlines in the last 24 hours, both of which have cut their outlook for Q1. Ed Bastian of Delta suggesting that maybe some of these issues could be transitory. But what does it mean for summer travel? This is what we're hearing from Delta executives. They're speaking at a JP Morgan industry conference just moments ago, planning to slow capacity growth plans for both spring and summer. That speaks volumes.
It speaks volumes, especially, and I keep going back to this. In January, they said that the supply-demand dynamic was as good as they've ever seen it. Suddenly now, they are cutting capacity in order to keep prices up and keep their profitability up. We're seeing similar tones across the airlines. We heard from American Airlines. We heard from JetBlue. We heard from Southwest, now charging for you to check your bags for the first time in their history. I mean, all of these ways to really drum up revenue. Well, I mean, look, I'm just saying, it's always really fun to fly, but it's going to get even more fun.
Take a beat? I think we should take a beat.
Okay, go ahead.
They've got this totally back to front at Southwest.
You're correct on this.
The most disruptive part of flying right now is the boarding process because the overhead cabins are full of luggage and people have to put their luggage in the hold. The convenience is the cabin, not the hold. So charging people for the hold is not the issue at play here. Charge people for the cabin, give the hold for free. You'll make the money because a lot of people want the convenience and you'll open up the space and hopefully you'll improve the experience of flyers in the United States of America. Why is that so difficult to get your head around?
You know, it would also improve probably some of the employee satisfaction who are not trying to break up fights for people to get on into the plane first. You know, the whole idea of gate lice, remember that? People who try to pretend that they have a higher status, they can get on first. They wouldn't care if they could just pay to
Maybe
check
it's some
their
regulation that I don't know about that prevents them from doing that, because it just makes so much sense. Why not do it?
Well, it's also opening up now, potentially this void for other airlines to fill. Delta now saying that Southwest bag fee change puts customers up for grabs because they're saying that this might mean customers are saying, look, we'll go elsewhere if we're going to have to pay for it. But I totally agree with you. You want to pay for the convenience. And also, it just goes to show that more people want to actually bring their luggage with them because when they're at capacity, they just take your bag for free because they have no choice.
Want to make it smoother, reduce the friction. That's what it should all be about. Anyway, there's your tangent. Equities right now in the S&P positive by 0.5%. We begin this hour with stocks looking to rebound from their biggest one-day loss of the year. Matt Miskin of John Hancock writing, there is an equity risk being priced into the US that is going in the opposite direction in non-US. We struggle to see such a divide in global growth being sustainable. Matt joins us now for more. Matt, welcome to the program, sir. Let's talk about that. Why do you believe that some of these trends are unsustainable?
Because at the end of the day, John, we're all together on the same economic cycle. So global growth is actually moderating in our view off of a pretty good level in 2024. If this is a macro regime shift, and it's almost like we went into a reacceleration into an air pocket. So we're feeling that turbulence. All of a sudden, the U.S. economy is slowing down a bit here. Might be the weather. You know, we might have to do a little Milli Vanilli and blame it on the rain. But at the end of the day, we're feeling an air pocket. If the macro regime is going back to slower growth, we're not going to likely see a lower quality cyclical rotation out of much of these non-U.S. equities.
So, Matt, you're not chasing Europe here. You're not chasing China.
That's right. I mean, the momentum has been terrific, and it is seen just massive gains year to date. But what we're seeing is really reruns that we saw in the United States. So from Europe right now, we're getting election euphoria. Everything's going to change. It's going to be much better. And European financials have skyrocketed. I can't stop watching them day to day because they're the new meme stock. But after an election, a lot of times there's this cooling after post-honeymoon period, which actually the United States has seen a little bit here. That may happen in Europe. In China right now, they're going after the AI trade. We've seen this trade before in the U.S., and so a lot of these we think are going to be shorter term phenomenon. We'd be tactical, try to trim into some strength, redeploy capital. We're actually looking at higher quality bonds and actually credit relative to equities. So you can dial back your equities and go in. You were just talking about high yield bonds yielding around 7.5%. Get income now instead of price appreciation. Income's likely to be a bigger driver of total return going forward. That's what we're focused on.
For a second, Matt, I thought you were going to come out and say, buy U.S. stocks, buy the weakness, and instead you say, buy bonds, which is not exactly raging optimism and talking about high-quality bonds at that. Are you talking about, if it's not necessarily the golden spot in Europe or in China, that we're facing a global slowdown where the United States and duration is really going to be the haven that will protect you at a time where other areas might be getting a sugar high right now?
It's exactly right, Lisa. And what we're seeing is that certain markets are repricing, certain markets aren't. And as a global multi-asset investor, this is what's phenomenal for us because we're looking around and we're saying, what is pricing in risk? What isn't? And actually, the 10-year still at about 420 to us is not pricing in that much bad news. I mean, you got to rewind about 5 months and pre-Fed cuts. The 10-year was 360. So you still have a lot of cushion of yield potential that could be evaporated, frankly, if the bond market starts pricing in worse economic data. And then globally, yes, there's capital that is flying around the world looking for the fastest momentum trade. The U.S. momentum factor has hit a wall, and that has yet to happen on a global basis. But we actually don't. The U.S. is actually holding up okay in our view right now. It's just slower growth. It's not the end of the world growth. And it's odd to us that some of these high quality stocks are the ones selling off the most. Actually, we think there's going to be value in some of these tech names that have sold off here, whereas other parts of the market have gotten more expensive and they're lower quality equities.
What are you waiting for?
Matt, I'm going to ask this because a lot of people are saying, okay, this potentially could be a buy the dip moment. If you liked it 10 days ago, why not like it even more on sale? It seems like there is a level of uncertainty that's making it difficult for people to say with conviction that we're not in some sort of paradigm shift, that we're not seeing a rejiggering of the global dynamism and, frankly, a releveraging of Europe while you still have a pretty big deficit in the United States. What gives you the confidence that there will be that upswing, that there will be that sense that the U.S. is still exceptional?
So we're watching high yield spreads, and as you all have already talked about, they're over 300 basis points. They're going in the wrong direction, so that is making us actually less optimistic in terms of this, potential reacceleration of the economy. But initial jobless claims is another thing we're watching, and they're 220,000. They came back after the prior week. But what we're doing right now is we're bracing, in essence, for the potential slowdown around the government employment picture. This last jobs report, we didn't think was that bad. But the question is, okay, well, is the next one going to be weaker? And are we going to see the Challenger report was actually the biggest shock of last week, showing that the layoff announcements were ticking up. That usually leads initial jobless claims. And then again, high yield spreads. So we are more defensive in the equity positioning. We do have some high quality, but real quality values, things like healthcare, utilities, dividend paying stocks, high quality balance sheets. Those have sold off a bit, but they've held in mid cap, for example, and some of the high quality is holding up the best year to date. And then international, it looks like the world, they're trading on another planet. And in our view, that's going to come together. We wouldn't chase that. We still like quality, but again, income is going to be a better return driver after so much return out of equities. We got to find different asset classes to work into the portfolio. Credit and high-quality bonds are great opportunities to us.
Matt, I hear what you're saying in terms of equity risk being priced into the U.S., and it's basically going in the opposite direction everywhere else in the world. Does that change on April 2nd?
Perhaps. I mean, it can change on a dime, frankly, but right now you could just see it in the commodity trading advisor or kind of the momentum traders, global macro traders. It can change quickly, and we just want to be careful here chasing that, and so much right now is politically driven. This year, 2025, almost everything has been political, influencing the markets. And in our view, that is a shorter term phenomenon. It's not investable. We actually don't use politics in investing. I know it sounds crazy because given everything that's going on, but you really want to focus on the earnings trends. The best earnings in the world still is in the United States. We still like the U.S. vis-a-vis other parts of the world. And actually, for once in a while, they're getting cheaper. That might actually cause a relative opportunity versus a lot of other equities elsewhere.
Matt, you say you don't use politics, but we're talking about policy. The Trump administration is talking about a global realignment when it comes to trade and also changing the way basically the U.S. economy works, trying to reprivatize and also make sure jobs are going more into the private sector. That's not politics. This is policy. You have to start baking some of this in, no?
And Maria, I'd love to agree with you on that one, but the policy can change on a dime too. Yesterday we could have tariffs, today we can't. Next day it could be tariffs, the other day it can. And if you're trying to make a decision on 12 to 18 months or 3 to 5 years for clients, investor portfolios on tariffs that could be here tomorrow or gone the next day, it's just going to drive.
Just to jump in, if you can acknowledge that that's going to be a feature of the next several years, wouldn't you also have to acknowledge that the multiple that people will be willing to pay for some of these names will be lower than it otherwise would be if we had clarity on policy?
I hear you, John, but at the end of the day, NVIDIA or some of these huge tech giants, they've been growing earnings. That wasn't because of fiscal policy. The real earnings trends are because of it goes back to like SWOT analysis of business school, or it goes back to kind of the productivity or the executing of the business. We are investing in companies, not countries. It's about the stocks, not the economy. You're not investing on GDP. You're not investing GDP. You're investing on the stocks. And I think that's a big differentiation right now. Right now, everything's getting turned around really fast based on political headlines. You're going to get yourself turned around into a pretzel on that. You want to really focus on the fundamentals. And right now, they're not that bad, but they are diminishing. If that macro regime is changing, you want to actually move up in quality, focus more on income. And we're trying to keep it simple. And that's where we would position.
Sounds like you're buying NVIDIA.
Not go that far, John. We don't talk about it.
That's right.
We like quality.
That's right. Just as you're in the flow, just sending a trip up. Matt, appreciate it. Thank you, sir. Matt Miskin of John Hancock Investment Management. Equities right now in the S&P positive by a little more than 0.1%. A small bounce this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Billionaire presidential advisor Elon Musk is calling for cuts to entitlement spending, including Social Security and Medicaid, arguing that the federal programs are plagued by fraud. Speaking to Fox Business, Musk said most of the federal spending is entitlements, so that's the big one to eliminate. However, many Republicans have been adamant that entitlement benefits will not be part of DOGE cuts. Shares of Dick's Sporting Goods falling in the pre-market 5.2%. The sporting goods retailer reported sales and profit that beat analyst estimates, but it did issue a disappointing outlook for the fiscal year. Dick's CEO has been working to invest the company's physical store network and upgrade its e-commerce capabilities. And Mr. Beast's biggest moneymaker is not YouTube, it's chocolate. Jimmy Donaldson's Feastables chocolate business generated about $250 million in sales last year, with a more than $20 million in profit. His media business lost almost $80 million. Sources tell Bloomberg that Beast Industries is looking to raise a couple $100 million to expand its existing divisions. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Up next on the programme, the Morning Calls Plus, Ben Callow of Baird on a big move lower in Tesla. That's next. This is Bloomberg. Equity futures here just about positive, up by 0.1% on the S&P, up by 0.2 on the Nasdaq 100. You're open in about 1 hour and 13 minutes away. Let's get you some morning calls. First up, Barclays lowering its price target on Delta to 80, anticipating softer demand. That stock is down by 7% this morning. Your second call from Stifel, lowering its price target on Oracle to 150, expecting limited multiple expansion. That name is down by 2.3%. And finally, CFRA upgrading Amazon to strong buy, saying the company is more recession resilient than its peers. Stock just a little bit softer. We're down 0.1% so far this morning. Let's turn to Tesla. Shares looking to bounce back after their biggest one-day drop since 2020. The stock down nearly 45% so far this year, wiping out its gains since President Trump's election win back in November. Ben Callow of Baird writing, we continue to view Tesla as a core holding long-term and see the company as the leader in real-world AI, but a bearish near-term. Ben joins us now for more. Ben, welcome back to the programme, sir. You're one of the best, so looking forward to this conversation. Walk me through, just from your standpoint, what's leading this stock lower? Is it something bigger than just the name itself, or is it Tesla specific?
It's market is the backdrop, but Tesla specific. It's delivery numbers. It's as simple as that. For Q1, the stock can't go up until the consensus numbers come down, because there's this narrative that Musk is destroying demand out there. Whether that's right or wrong, they're doing a Model Y refresh across all 4 factories. And so a Model Y typically has, 300,000 deliveries in a quarter. So let's just take out 2 months of that. So 200,000 cars that aren't being produced or just now being produced. And that's going to be compounded with all the backdrop of, protests and, all the bad stuff going on with Tesla. And it's going to extend that narrative around demand.
But Ben, deliveries have never really mattered, right? I mean, it doesn't seem to matter how much they sell or how much they don't sell. It's always about this faith in longer-term robo-taxis and autonomous driving. Has that belief shifted? Has there been a narrative vibe shift among retail investors that could mean a longer-lasting dip?
I think so. I think that over time we've seen, the lens where Tesla's value to be longer at some points, and when things get bad, it tends to, refocus very short term, and that's where we are right now, very short term focus. And I think that when we get a delivery number that's worse than people are expecting, it's going to be carrying on that narrative of demand being bad because of demand destruction, and that affects the long term story.
Yesterday, Elon Musk was asked on Fox News about how he was running his other businesses while he was engaged in right-sizing the government. And he said, with great difficulty. At what point do people get concerned about the fact that their CEO is distracted and doesn't really have time to manage the company, forget day to day, but even week to week?
Well, it's a good question. It's come up a lot because of SpaceX and his other businesses that he has. Now that he's at Doge and he's spending his time in Washington, D.C., I think it's harder to defend what he's doing on a day-to-day basis and how much he's being involved in. And you have pundits out there, people that would normally be like on his side saying, like, hey, send me 5 bullet points of what you've done. I'm not saying that's right or wrong, but when you have someone that is well known in the media saying, hey, why don't you send me 5 bullets about what you've done at Tesla lately, that raises eyebrows.
Ben, yesterday we had, or last night, the president come out and in a truth post say he's going to go out and buy a Tesla in the morning. He talked about the fact that Elon's, quote, baby is under attack and people want to do harm to Elon. If Trump comes out and buy a Tesla, is that bullish or bearish for the shares?
I think that it's good that he supports, and I agree that, Musk is an important person in the United States, globally. But I think there's, a lot of people that are indifferent to Musk at best. And, one point that I'd like to make when we're talking about demand is if, we read about, people's cars getting keyed or in worst case scenarios, set on fire. If I'm indifferent or even a Musk supporter, I might pause before I go buy a Tesla. But our call is not that. Our call is that numbers are too high because of production issues in Q1. But that's going to extend the narrative of demand destruction in longer term.
But it's not just demand destruction potentially in the United States. When it comes to Musk and his political involvement with the president and Doge, we're also seeing this in Germany and people pushing back because his support for far-right German party. How do you pinpoint potential political erosion of the shares?
It's difficult, and that's where uncertainty is, and that's why the stock can't go up until, I hate to keep repeating myself, until numbers come down on the street, because it's going to continue that narrative. But I think that, Europe counts for about 25% of sales. I think the demand destruction is actually happening there versus the United States. Now, those numbers get kind of iffy because they are having production issues right now. But I think in Europe, people take this a lot more seriously when they're buying a car than the Uber driver, in New York City.
Potentially more than political threats or political boycotts is the idea of China competition and the fact that BYD has overtaken Tesla as by far the biggest seller of electric vehicles in China. And you have this increasing production in that nation as well as lower costs. At what point does that become a real headwind that becomes harder and harder to ignore, especially with all of the other challenges that are facing this name?
Anecdotally, I was in Europe for 2 weeks visiting clients over the last 2 weeks ago. And, I see BYD stores and, talking to clients. Someone brought up a good point. Like a year ago, no one would have bought a Chinese car. Now with the alternative of being a Tesla and Musk, this was their opinion, not mine, that it's an easier sale for a BYD. But I think it just compounds, the uncertainty in the stock right now.
It's certainly a tricky moment for the stock. Ben, appreciate your time, as always. Ben Keller there of Baird. The stock this morning attempted to bounce back from the big one-day loss yesterday, the biggest one-day loss since 2020. If you just go to the analyst community this morning, check out the ANR page on a Bloomberg terminal if you have access. The average 12-month price target right now is 362. So you're talking about 60% upside from where we closed yesterday. And if you ask those analysts why are they so bullish, they won't talk about car sales. And this is the tricky moment with Tesla, to be honest with you, because there are market regimes where auto sales and deliveries drive the stock. There are other times when it really doesn't at all. You're talking about the future, full self-driving, what's going to happen with AI, that big futuristic stuff. That's going to be what underpins a lot of those really bullish calls.
This is a storytelling market. This is a storytelling market that really points to the idea of a future where we don't have to drive and we can send our kids in cars with no drivers and they can get anywhere that they want safely and in an orchestrated manner. And the chief storyteller is not available. And that, I think, is important. And the fact that the chief storyteller is now a polarizing figure in American politics makes this a much more difficult story for a lot of people to buy into.
Market backdrop doesn't help. People don't want to hear nice stories. They want to see evidence. They want to see the real deal. They want to see the data. And in moments like this is why I think deliveries matter that much more.
Yeah, it also matters what point we're coming from. I mean, we're seeing a 55% retracement in the shares after a huge run up after the election, giving up all of those gains. So are we back to where we were before, or is this the beginning of something more protracted? And that's really the ultimate question.
Tesla this morning bouncing back by just 1% in the pre-market. Up next on the program, we'll catch up with Lindsay Piegza of Stifel. We'll get her thoughts on what's happening with the economy, the latest small business confidence read, and what we're hearing from the airlines. We'll speak to Lindsay about that. Then Lizzie Rosen of Goldman Sachs as we look ahead to the economic data through the rest of this week, CPI tomorrow, and some of the moves we're seeing in fixed income. From New York City, this is Bloomberg. Equity futures on the S&P positive by 0.25%. The open and bound about 60 minutes away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. This morning, I had a little bit of an airline special for you. I know we're also just getting some breaking lines from United about them seeing a drop in government-related travel. Delta, though, kicking it off with that. This really started it off yesterday with their earnings cutting basically in half their first quarter expectation. Delta shares falling some 4.33%. It's the worst of all worlds. It is a consumer that they say is less willing to spend because of macro uncertainty. That's hurting domestic travel, plus the mid-air collision of American Air and a crash landing for Delta. Speaking of American, another airline that we heard from this morning, a very similar picture, seeing a wider loss for the first fiscal quarter. Those losses aren't as bad. I should say all these airlines are starting to pare some of the worst of their losses. American Air down about 1%. Now, Southwest, also a similar warning from them. Their forecast is going to look weaker with that demand, but a difference in fortune for the shares. Those shares up 10.33%. And John, I know you have some feelings about this one. Part of the reason that the shares are up is because they're doing a change of strategy. No longer will you get free checked bags. Your first and your second one, you're going to have a fee paid unless you're part of their loyalty program or have a business flight. All of this part of Elliott, some of the Elliott management changes that's come in. So those shares up nearly 10%, John.
Danny, thank you. Appreciate it. That's the latest on the airline front. Just want to throw in this additional headline. Danny mentioned United Airlines. If you're just joining us, welcome. This is quite a headline, saying it's seen a 50% drop in government-related travel. That's the headline just dropping from United.
I'm not surprised about this at all because anecdotally I did hear potentially some departments and agencies were pulling back on who they were letting go travel to conferences or meet people around the country or internationally. So when you see this, I'm really not surprised given the Doge effect and how they want to really rein in spending at these agencies and make agencies more efficient. But 50%, that's huge. That's half of government travel.
Yeah, it's government travel and all related. And we keep talking about the idea of what kind of contractors and contract work is also going to be put on ice as they wait for that. And just to give you some commentary from the JP Morgan Airline Conference, Ed Bastian, Delta's CEO, saying the first quarter has been a parade of horribles. That has been his discussion point for the airline industry.
So how much of this, and this is the key challenge, I think, how much of this was about the accidents we've seen, the flight safety events of the last several months? How much of it is truly about a slowdown in the consumer and business-related stories connected to what we're seeing with the Doge effort down in Washington?
Look, we can't say with any precision, but what we can say is it's not just the airline industry that's giving the same type of sentiment shift. We're hearing from Dick's Sporting Goods. We heard from Kohl's. We've heard from Walmart. We've heard from a whole host of other companies. At a certain point, it's no longer anecdotes when you have a holistic tone shift.
Get more data later on this morning, about 90 minutes away. You'll get Jolt's job openings at 10 a.m. Eastern time. Tomorrow, you'll get CPI. The day after, you'll get PPI. Mike McKee, our economics and policy correspondent, joins us now for more. Mike McKee, what are you looking for in that data later?
Well, we're hoping not to see a parade of horribles in the data this week. JOLTS comes in with supposedly more job openings, but it's kind of irrelevant at this point, given the fact that people aren't really hiring that much, according to what they're telling officials at the Fed and other places. So look at the quit rate. Let's see what people think about their ability to get a new job. And, of course, CPI, everybody's going to be watching to see whether inflation progress continues or goes the other way, because we've gotten some not so great news this morning. We were talking in the 7 o'clock hour about the NFIB survey. There's also the New York Fed survey from yesterday showing the highest number of people expecting worse financial conditions in the next year in 15 months. And the share expecting higher unemployment is at its highest since 2023. That NFIB survey, as we showed you earlier, the second highest level ever for their uncertainty index, and a 10-point drop in small business confidence. So people are looking at the data, they're looking at the headlines out of Washington, and they're not feeling really great. I'll leave you with one chart here that might be important for the viewers right now. This is the New York Fed's question about what do you think is going to happen to stock prices. Kind of speaks for itself.
Not a pretty picture, that's for sure. Mike McKee, thank you, sir. Appreciate it. Here's the take from Lindsay Piegza of Stifel, writing in and weighing in on the U.S. economic slowdown, saying the following. The clear rise in hiring hesitancy has some investors raising the probability of a downturn or even a domestic recession and increasing bets of further Fed policy relief sooner rather than later. Lindsay, I'm pleased to say, joins us now for more. So, Lindsay, let's talk about that. We have seen a major sentiment shift. The soft data, the survey data, has cratered in some places. Lindsay, when you see those kind of moves this quickly, is it inevitable? Is it even avoidable? Do you expect to see it in the hard data?
Well, it's not necessarily inevitable. What we're seeing right now is anxiety over the uncertainty of the realized impact of policy. Now, this was a large campaign promise in terms of the international tariffs in particular. So businesses we saw responding in anticipation at the start of the year, building up inventories, moving to the sideline, curtailing investment and employment plans. From a consumer standpoint, we saw consumers pull back. Again, all of this uncertainty really hitting the pause button for both businesses and consumers. But it will take a few months to see how these policies pan out and the actual impact on prices, on relationships with international providers. And at that point, we'll be able to mesh between near-term uncertainty and longer-run realized impact on the economy.
And Lindsay, we kind of got a reality check from Holly O'Neill of Bank of America earlier this morning, where she said consumers are still spending. I mean, they might not be spending as much on flights, but they're still spending, and it's a gradual slowing, but it's not some sort of catastrophic falling off a cliff in terms of what they're seeing in credit cards. And one thing that we keep thinking about is the economy moves pretty slowly. It takes a long time to really hammer an economy that otherwise has quite a bit of momentum. How quickly could we see it really show up in some of the hard data in a way that could be concerning? Or realistically, is the U.S. still a behemoth that is moving pretty slowly and still has quite a bit of momentum?
Well, when we look at the consumer, we did see a pullback at the start of the year. So we've already seen the hard data reflect the uncertainty in part of the consumer. That being said, it has been a second derivative decline, meaning a slower pace of still positive expenditures. So consumers are still out in the marketplace buying goods and services, but they're doing so at a noticeably reduced pace. That being said, we're also looking at how the consumer is affording these purchases, and they are increasingly reliant on buy now, pay later options, ramping up credit card usage with outstanding balances over $1.2 trillion. However, when we put that in perspective of the overall household balance sheet, we still see that the ratio of debt payments relative to disposable income is at a multi-decade low, or at least near a multi-decade low, suggesting there's still a good amount of spending and borrowing power left on part of the consumer to continue to support at least positive growth. Maybe not a robust economy, but if the consumer could gain some confidence and be willing to continue to move into the marketplace, I think the economy could maintain this positive pace of about 1.5% to 2%. But it all comes back to instilling that confidence back into the consumer, not necessarily the ability for the consumer to continue to spend.
This is kind of a mind-spinning moment, Lindsay, and I keep thinking about how soft data and anecdotes are going to be more important right now than the hard data that is going to be backward looking. The fact that people are looking at the University of Michigan sentiment survey more than JOLTS or even initial jobless claims, because maybe that'll give them an edge onto what's to come. How much can we lean on soft data that has been messy and non-correlated with what people end up doing quite often?
Well, that's exactly it. Consumers often say one thing and do the exact opposite. And so while we are hearing from consumers that there is this anxiety amid this massive amount of uncertainty, again, consumers are somewhat pulling back, but nominally this is a still positive pace of expenditures. And as long as the consumer, the backbone of the U.S. economy, is continuing to spend right now at an average 3% pace, that's still very indicative of a top-line GDP pace, holding all other variables constant, of about 2%. So again, the economy is still on relatively solid footing, but I think what we're seeing in the sentiment numbers, what we're seeing in the NFIB, what we're seeing from some of these anecdotal reports is this massive amount of uncertainty and this unknown from all of these fiscal policies coming down the pipeline, and a big question mark of how is this going to impact the economy as we look out to the second half of the year.
Lindsay, a week tomorrow, Federal Reserve time, a meeting with Chairman Powell, a news conference, new forecasts. How eventful will March 19th be?
Well, I think it is going to be eventful, not necessarily from a policy standpoint. We do widely expect the Fed to remain on the sidelines. However, from a communications standpoint, we want to see where the Fed is falling in terms of are they erring on the side of the economy is still positive, and thus they're going to continue to remain on the sideline, waiting for the data to evolve, or are they starting to identify some of these signs of weakness, suggesting that they're gearing up to reignite some of this further policy relief that the market seems to be bracing for? So it's really going to come down to that communication, that message from Powell and from the FOMC statement.
Lindsay, appreciate it. Lindsay Piegza of Stifel there. Looking ahead to the Federal Reserve a week tomorrow, March 19th, for an update from the FOMC. New forecast as well. Updates coming from the airlines this morning. United Airlines saying it's seeing weakness in travel demand. The headline that crossed just moments ago, a 50% drop in government-related travel. Those stocks initially this morning a whole lot softer, at least in the last 20 minutes or so, recovering, some of which are in positive territory.
Yeah, and some of them have added to some of the cost revenue, like charging for bags that you check, not the ones that you put in the overhead, which might actually lead to a better quality of experience. But there is this sort of question going forward about whether they are the canary in the coal mine in terms of signifying a really rapid sentiment shift where consumers aren't traveling, or is this idiosyncratic? Is it specific to a couple of parade of terribles?
It's an aggressive business, this airline business, eh? United CEO, the Southwest bag fee change is slaying of the sacred cow. Delta came out and said passengers are up for grabs. Pretty aggressive stuff, isn't it? Southwest comes out with a change and they're like, yes, let's go.
First of all,
feels like Hunger Games right now at the airline conference.
If you've ever been lined up to get on a plane, it feels a little bit like Hunger Games too. So just saying, it's not just the airlines that are aggressive, it's also people using the airlines.
Lindsay Rosner of Goldman Sachs joins us now. Not getting into that. Lindsay, welcome to the program. It's good to see you. You don't want to get into that either.
Not aggressive on the airlines, not me. Thank you. No.
Something you said to us last time, I think, that the data is your friend. What's the data telling you now?
The data's telling you right now that you are paid to pause. And what we mean by that is it makes sense to take a page from the Fed's book. There's nothing we have to do in markets right now to reposition necessarily. So for us, we're just waiting to see how the data unfolds. We need to learn more. JOLTS is not going to give us much information, unfortunately, today because it's really January. But we need to see that, back to your prior guess, has the consumer changed their path? We think not, but all of this data is really going to help us.
This sounds so calm. I mean, I love this. You know, people are talking about slaying of the sacred cow and a parade of horribles. And you're saying we can just stay calm and take a look at what's going on and we don't have to change anything. What are you waiting for? I mean, there's a lot of pretty heated rhetoric out there.
Yeah, I think what we're waiting for is prices that make sense. And so we've been saying that fixed income makes sense in a portfolio. If you look year to date, I think there's a lot of concern right now about what's happened with stocks, off 8% from the peak, down maybe 4% overall. This isn't a massive move, but contrast that, which we think is really important, with what fixed income's done for you. It's earned you in the front end of the curve 2%, in the middle of the curve 4%, back end even more. So I think we're calm because we're bond people, but we're calm because we have a good setup in our portfolio construction overall with bonds as a ballast.
There's a question about how long-term bonds can really remain a ballast if people start to get concerned about higher overall inflation from a deglobalized world, the idea that supply chains will have more built-in inefficiency. How do you cope with those kinds of discussions? Do you just assume that there isn't going to be price appreciation, that yields are going to sort of stay around here and that that's fine because it's relatively good to be paid to wait?
Well, what will be a problem certainly would be if tariffs are on the maximalist side of things. And what we've seen recently is tariffs on, tariffs off, tariffs being placed out there at a higher level, then brought on at lower levels. I think until we see a full-blown, really aggressive tariff regime, I think you can feel confident in bonds. They have good coupons. We're starting at a good spot there. They will be support, we think, as we wait to find out more. But again, we don't have to day trade our portfolios. And I think that's the important thing. There's been a lot of just frenetic behavior in the markets right now. We were talking before we got on that it's hard to think about even taking a day off from the markets. You can't take a vacation, I think, right now under this administration. But as we learn more, I think we're going to be emboldened that rates are going to help you.
When you're looking at potentially that maximalist approach to trade, it sounds like you're basically waiting for April 2nd. Is that accurate?
Yeah, we're waiting for April 2nd, just like we waited for March and we waited for February. I mean, I think there's a lot of markers that we keep waiting for. At some point, I think there will be an end to kicking the can a month, and we'll have what is the final here. And that's what really people are waiting for. And I think that uncertainty doesn't do the market well. And so hopefully April 2nd is maybe the beginning of the end of we know what the permanent state will be.
We're seeing some economic advisors outside the administration, but close to the president, like Steve Moore, saying you got to push up the tax cuts. You can't wait for the end of the year. Do you think that's an accurate assumption, that they need to be able to balance some of this uncertainty and bad rhetoric around tariffs with some of the good policy changes they're trying to get through?
Yeah, I think you're bringing up a great point. If you think about what happened post-election, we had this big euphoria bubble. And I think a lot of people have said that, the air is out of this bubble or the balloon has burst, so to speak, because all the good stuff was thought about, deregulation, tax cuts. Well, we haven't had those yet because the sequencing takes time. Instead, we've seen the more negative things potentially, like tariffs. And so it's really hard when everybody was banking on really positive things to happen. The negative ones happen first, and we're still waiting for the positive things later on. They are coming. I think they're coming much, much more slowly. Certainly, if we sped them up, I think people would feel a lot better.
We're getting some policy clarity abroad, and I wonder how you and the team are thinking about the surge we've seen in European bond yields over the past week or so, specifically in Germany, the 40 basis point move last week. These are regime shifts in policy, particularly in Germany, that we haven't seen in decades. How are things changing for you and the team? How do you think about the global backdrop for fixed income now?
Yeah, so what we've said really since 2024 is that there are great opportunities of divergence and that we should be able to take advantage of them in our macro strategies. What's happened in Germany is, to your point, something totally new, large, significant. We actually don't think that the backup in yields is over yet, so we wouldn't hop in yet. Still prefer the U.S., but I think it's really important to think what that means for a backdrop for credit. So from a credit perspective, Europe has actually outperformed the U.S., so when we're thinking about how to position our portfolios, we're still leaning into U.S. because we feel like there's more opportunity there. But should that be dislodged, it'll be a good opportunity to shift the portfolios and add back in European credit once we get more clarity on, in fact, if the defense spending will be passed, what will really happen.
What's more compelling to you, the pushing away from the U.S. effect of a potential deterioration in the data, or a potential positive shift, not only with respect to the spending getting passed, but a sense that maybe it could ignite some kind of growth and infrastructure spending on the heels of it in Europe?
Yeah, so this is the big change, and I think you're seeing that with the yields in Europe. This is big spending, and I think now you're starting to see that all the views that there could, in fact, be a recession in Europe or things are looking really, really weak, that's changed a lot because spending is a huge part of GDP, government spending. So that does change the tone out there. But what's important is it is a global environment, and I think what we've seen with stocks, with bonds so far, and the big volatility in performance is that you want to do active management to take advantage of all of these differences and all these movements because they're happening quickly.
Lindsay, it's good to see you, as always. Appreciate the update. Thank you. Lindsay Rosner at Goldman Sachs. Don't take a day off. No one at Goldman takes a day off, do they?
Certainly not this year.
Vacations at Goldman.
But this
this is the reason why people aren't going to be traveling to beautiful, warm, sunny spots that are going to be really nice.
Cheaper flights for you, Bramo.
I know, maybe. You're trying to send me away?
No, not at all.
You're like, yeah, you can go get one.
That's all. I'm coming with you.
Fabulous.
Futures on the
Trip.
S&P, just about unchanged. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Speaking of airlines, John, United Airlines said that it's seen a 50% drop in government-related travel. Speaking at a JP Morgan conference, the CEO said the company is seeing weakness in travel demand. Reacting to the news that Southwest will be charging for bags, he said it's the, quote, slaying of the sacred cow. 5 of the billionaires at President Donald Trump's inauguration have collectively lost $209 billion since January 20th. The Bloomberg Billionaires Index shows that Elon Musk's wealth has declined by nearly $150 billion as Tesla shares have tanked. Jeff Bezos has lost $29 billion and Sergey Brin has lost $22. President Donald Trump says that he's going to buy a new Tesla this morning. Speaking of the slump in Tesla shares, he said it's a show of confidence and support for Elon Musk. Tesla fell in their worst day in more than 4 years yesterday. In a post on Truth Social, Trump said, "Why should Musk be punished for putting his tremendous skills to work in order to help make America great again?" And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. We'll head down to Washington, D.C. and catch up with Tyler Kendall, looking ahead to 5 p.m. Eastern Time when the Business Roundtable sits down with the President of the United States. Yesterday, the worst day so far in 2025, down 2.7% on the S&P, and the Nasdaq 100 down by 3.8%. Today, no real bounce at all. We're totally unchanged on the S&P. We're not even positive 0.1% now on the Nasdaq. The opening bell, about 38 minutes away. Let's get you the day ahead. It looks like this. 10 a.m. Eastern Time. JOLTS job openings at 5 p.m. The President meeting with top CEOs and Wall Street bank executives. Look out for that. The Business Roundtable later. Wednesday, CPI plus President Trump's tariffs on steel and aluminum go into effect. On Thursday, PPI and another round of jobless claims. On Friday, the U.S. government shutdown deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, looking forward to later on this afternoon. What are you expecting?
Well, John, President Trump has said that there will be a short-term adjustment period in order to have long-term growth. I'm sure many of these executives would like to know what that timeline is that the White House is tracking here. Interestingly enough, 1 week ago today, the Business Roundtable put out a pretty lengthy statement about President Trump's economic agenda. It was right before he addressed a joint session of Congress. And unsurprisingly, they touted their support for many of his economic policies, including tax cuts and deregulation. But notably, they said that they were going to push President Trump to protect the benefits of the USMCA, citing that U.S., Canada, and Mexico trade has contributed to more than 13 million American jobs. So no doubt tariffs and the uncertainty that comes with them are going to be a topic of discussion today. We should quickly note that this continues a trend from this White House when it comes to outreach to the private sector. Yesterday, President Trump met with some top tech CEOs. I was there at the White House. I watched them walk in, though they didn't answer any of our shouted questions, but it included execs from companies like Intel, IBM, Qualcomm, and HP, as their industry in particular tries to navigate these tariff threats. John, the official White House schedule says that President Trump will be at the Business Roundtable for 1 hour. We know he's prone to long remarks, but we are expecting that after he gives his public-facing comments, he's going to end up having some private conversations with the execs in the room.
Tyler, appreciate it. Looking forward to that. Some of it might be on camera, so look out for that later on this morning, later on this afternoon. Tyler Kendall down in Washington, D.C. Want to watch a little bit later. It's interesting. This morning, we've hardly talked about the tariffs on steel and aluminum, just assuming 25% on steel and aluminum happens overnight.
That's what everyone is expecting. Those tariffs go into place tomorrow, 5 p.m. I want to know if these executives leave the room feeling uncertain. And 10 a.m. when the Tesla showroom in Georgetown opens up, I want to know if Donald Trump really goes and buys one.
I want to know what President Trump could say that could potentially stave off some of the uncertainty in markets and whether he'll even begin to try, especially because it could be seen as a reversal or a capitulation of some of the current stance that he's taking that's hardliner. That's really the key to me.
They've been pretty consistent with the message over the past few weeks. Let's see if it stays that way later on this afternoon. Coming up tomorrow, Alicia Levine of BNY, Adam Hodge of Bully Pulpit International, Rick Wurster of Charles Schwab, David Kelly of JP Morgan. CPI tomorrow morning, the main event, live from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. After early exits in Dubai and Doha, Coco Gauff is looking to play herself back into form, and the former US Open champ enjoyed a confidence-boosting win over last year's finalist Maria Sakkari. The 20-year-old closing it out 6-2 in the second on her 6th match point to reach the round of 16.
Today, fears of an economic downturn see the US stock market lose $4 trillion in value.
Why farmers are struggling under Trump's tariffs and spending cuts.
And a hearing into the death of soccer superstar Maradona.
It's Tuesday, March 11th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Jonah Green in New York.
And I'm Tara Oakes in Liverpool. We start in the Philippines. Where supporters of Rodrigo Duterte are rallying outside the airbase where he's being held. The ex-president was arrested in Manila's airport at the request of the International Criminal Court. It's a major step in the ICC's investigation into the thousands of alleged extrajudicial killings in Duterte's signature war on drugs. The 79-year-old has repeatedly defended the drug crackdown. He denies ordering the murders of drug suspects and says he instructed the police to kill in self-defense only. On Monday, US stock markets suffered their largest drop since President Donald Trump took office, with tech shares falling at their fastest pace since 2022, and trillions of dollars wiped off the S&P 500. And the mood in financial markets is still skittish. Carmel Crimmins is here to tell us what's going on.
So what started as a stock market sell-off accelerated to a full retreat. We saw corporate bond sales scrapped, Delta Airlines cutting its profit expectations due to economic uncertainty, and treasuries rallying as they took on that safe haven role.
So what's triggered it?
Well, Trump's trade war and the cuts to federal spending are darkening the economic outlook. But I think, crucially, signals from Trump and his advisors that there needs to be some near-term pain while his policies take effect has really spooked people. It has markets preparing for the possibility of a recession, and they're now pricing in a 50-50 chance of a Fed rate cut in May.
I thought the markets were very bullish on Trump.
Well, they were. The period between his election and his inauguration were a boom time for stocks. Investors were betting on tax cuts and deregulation to power returns. But the mood has soured over what tariffs and spending cuts could mean for growth.
So where do we go from here?
So the global sell-off eased a bit and US stock futures have recovered somewhat, but the mood is still very fragile. Trump is meeting with US business leaders later today, so it's going to be interesting to hear what he has to say to them. You know, will it be words of reassurance or more like a fasten your seatbelt kind of chat? We'll have to just wait and see.
Trump's tariffs have not just provoked chaos in the markets, it's causing stress and confusion in the Farm Belt, an area where Trump has historically enjoyed widespread support. U.S. farmers are also grappling with a pause in federal spending and a freeze on most humanitarian aid as well. Leah Douglas has been covering the story.
Well, we spoke to more than 24 farmers and food or farm organizations in 7 states, and they all were reporting some amount of grant funding that was frozen from the U.S. government and from the U.S. Department of Agriculture. The impacts are really broad. We spoke to one farmer in Montana who has been waiting on a $648,000 grant from USDA to build a feed mill that would serve area farmers. And with that money frozen, now that project has been delayed. We've talked to some organizations that have laid off staff and farmers that are making different planting decisions or potentially losing customers who themselves are waiting on grants from the USDA.
And I was surprised to read in your piece that they are also affected by foreign aid cuts as well.
That's right. So U.S. farmers sell a significant amount of U.S. commodities into the foreign aid infrastructure. So those are commodities that the U.S. government is donating, sending abroad into different development programs. And with a lot of disruption to USAID, the dismantling of that organization, and disruption to foreign aid in general, that's meant a lot of confusion in farm country.
And we first started off with in the goat business.
So another set of farmers that we spoke to, Ed and Becky Morgan, who have a livestock farm in Shanks, West Virginia.
And they liked our sausage. Like, cool. this is viable.
They have been growing their business selling flavored sausages and breakfast sausage links to public schools in their area. That's been a great booming area of business for them. But now those schools, which were waiting on grants from the USDA for food programs, are themselves wondering whether they'll be able to continue with those purchases, which is putting Ed and Becky in a tough situation.
And on the tariffs, Trump says farmers should just produce goods to sell domestically instead of exporting. How do they feel about that idea?
Farm groups and farmers have been pretty critical of President Trump's proposals of tariffs that will affect U.S. farm goods. The domestic farm economy is really reliant on export markets. We grow huge amounts of corn and soy and other grains for export, and those products can't be easily redirected to be sold inside the United States. So it's caused a lot of concern. The Secretary of Agriculture, Brooke Rollins, has said that the agency is starting to release some of this frozen money, but did not answer questions about how much has been released or what the timetable is for that.
Ukraine has launched its biggest drone attack yet on the Russian capital. At least 91 drones have been downed over Moscow. The drones have sparked fires and forced airports to shut and flights to divert.
A tanker carrying jet fuel for the U.S. military was hit by a Portuguese-flagged container ship off northeast England on Monday. The collision set both vessels ablaze and forced both crews to abandon ship.
A judge has temporarily blocked the deportation of the Palestinian student arrested at Columbia University, and a hearing has been scheduled for Wednesday. Mahmoud Khalil is currently in a federal jail for migrants in Louisiana.
Today kicks off the trial of several medical professionals in Argentina charged with the death of football superstar Diego Maradona in November of 2020. Maradona's heart failure just days after a brain surgery was reviewed by a medical board, which said his healthcare team acted in an, quote, inappropriate, deficient, and reckless manner. The medical team generally rejects the charges. Here to explain is our bureau chief for Southern Latin America, Adam Jordan.
The focus of the case is whether the defendants, all part of Maradona's medical team, we're talking nurses, we're talking psychiatrists and a brain surgeon, whether they were culpable in his death. What the
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME futures across equity indices, interest rates, FX, energy, agriculture, and metals. Access CME futures around the clock at Interactive Brokers.
This is a dramatic increase. Can you talk us through here just how many things will be affected? You were talking about electricity a little bit in the break, but there is a daisy chain to consider here, isn't there?
Yes, I mean, aluminum, the U.S. relies on aluminum imports because the number one cost to produce aluminum is electricity. U.S. electricity cost isn't competitive with the rest of the world. So therefore, and Canada has a better cost basis, mainly because hydroelectric power up in Canada. So the cost to a customer to get aluminum into the U.S. is the price of aluminum that we see on LME plus a delivery premium called the Midwest Premium. So you've seen in the last few weeks when the talk from tariffs had started, the Midwest Premium previously had reflected a 10% tariff. Then it moved and it's reflected a 25% premium over the last few days or over the last month or so. And now we'll see, if you watch that, we'll see how will it go up to 50%. I kind of doubt it will go that high, but I think it will go beyond 25%.
Right. Well, I'm looking at the Midwest Premium. My producer Joe in the control room can pull that up year to date. It's gone from like 20 cents to 40 cents so far, but that was only at the end of business yesterday. Right. Now we're looking at a 50% tariff. I think a lot of people were expecting 25, so that could change dramatically at the end of business today. Joe Doe, if I'm Mary Barra, or if I'm Jim Farley right now sitting in Detroit, knowing that I have to buy aluminum to build my F-150s, how's that going to look?
I think this is a shock. I am already making calls around the market trying to figure out what people are thinking. I think this one's coming as a bit of a shock. It's unclear if the President of the United States had given a heads up to either of the industries or other industries that he might be considering doubling these. Listen, the Ford CEO said at the middle of last month that the aluminum tariffs would blow a hole into the industry. I think that was also with the idea that it would stack with the Canada-Mexico tariffs that actually have not come into place. But now you've effectively...
Well, they will on April 2nd, right? Because Donald Trump has been clear that he's given them a reprieve for 1 month.
Let's ignore that for a second. They were assuming, okay, if you get a stack, right, tariff stack, you had 25% on aluminum, and you were going to get 25% on Canada, which is the biggest producer that the U.S. consumes from. More than half of what we consume in the U.S. is produced in Canada. So then they were saying, wait a minute, 50%, that's way too much. Well, guess what? Sure, you put a delay on that till April whatever. Yeah. But now you're saying, you know what, we're just going to do 50%. Now you've just actually created the same problem that you had before. And that's even before we get to the fact that, oh my gosh, these Canada-Mexico tariffs are supposed to come into place in April, and then that would stack on top of that. We haven't even gotten to steel. Steel's the actual tonnage. That's a much bigger market.
Let's talk a little bit about steel. And Rich, I'm curious to get your perspective here, because you see the reaction in the stocks of U.S. Steel, for example, Nucor, some of the equities that fall under your coverage. What does this mean for those companies, and what was their position heading into this period?
Well, what it means is that obviously the price of steel has greatly increased, and it should increase a little bit more. But it's also what's going to do is start to attract imports also, because people are going to say, well, even if the price of Canada's steel is up 50%, but the price of the rest of the world is only up 25%, so I can afford to take a 25% tariff on their price and bring it in. Right. So if you look at the U.S. imports about 20% of their needs a year. We've looked at probably a third of that is actually steel that the U.S. producers don't want to make or can't make. So that still has to be imported, and the other one is opportunities for these other companies to step in and fill the void with those, make those grades of steel that they hadn't in the past.
You know, to that end, we've seen U.S. Steel take a little bit of a jump on today's news, but it had been tumbling into today. It's still up on the year. Growth concerns on one side, then the tariff pressure on the other. How do you net out those concerns, Joe?
I mean, demand's the bottom line. If nobody has confidence in the economy, because that's what we're talking about here. We're talking about GDP. If nobody has confidence in the economy because tariffs are coming on the whim, why would you buy steel? So yeah, maybe you get a short-term bump in price if you're the mill. But looking out, inventories are the highest we've seen in years. Consumers are the bottom line here. And if they're not buying steel, it doesn't matter that you're saying, well, guess what? There's no foreign imports coming. Because they're not buying the domestic stuff either. So I think that's really what we're going to have to watch today. There's a lot of concern in the market, I'm sure.
And it's worth pointing out, I mean, we're coming off a year where U.S. Steel is down 30%. I know it had some idiosyncratic issues, but it's been a pretty ugly picture.
Well, but even away from the stock price of U.S. Steel and Nucor, it seems like, or I'm sure he would tell you, what President Trump wants to do is bring production jobs back to the U.S., especially steel jobs. So are you saying you don't think that Nucor and U.S. Steel are going to be ramping up their production of aluminum and hiring a ton of people? Like, is Allentown going to be...
Well, they're not going to be hiring a ton of people. They could ramp up production. Right. But the great thing about these EAFs is they don't require a lot of people to operate. And that was never the point in the first place. Donald Trump made clear in 2018 that it was about capacity utilization to improve the profits of the steelmakers. It wasn't about hiring more people.
All right.
If you look at utilization, the industry last week was at 75%. So it does have spare capacity to ramp up. Aluminum's a different story. The U.S., our electricity costs aren't competitive, so we're not going to be able to add production of aluminum in the short term. And no producer is going to do it unless they can get a 20 or 30-year power contract that locks in the price of the power.
But steel, will they add jobs in steel production?
Well, I don't know if they'll add jobs, but I think they'll take that 75% utilization they're running at and ramp it back up to, the mid-80s.
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME futures across equity indices, interest rates, FX, energy, agriculture, and metals. CME futures offer around-the-clock access, deep liquidity, and capital-efficient margins, helping you seize opportunities whenever they happen. The best-informed investors choose Interactive Brokers.
Look at these headlines.
Right. We need to read some headlines as well, because you have Trump on Truth Social talking about an extra tariff, an extra 50% tariff on Canada, aluminum, and steel. This is an additional tariff, he says. He calls it a 25% tariff on electricity coming into the United States. So clearly the turmoil still hitting markets.
Going into effect tomorrow, I think that's important as well. And you can see the S&P 500 now down close to session lows, so sort of losing that steam that it was building. The NASDAQ 100 hit session highs in the aftermath of that JOLTS data, actually, but now losing that momentum as well, up about 0.2% or so. So these hits just keep coming.
Yeah, and this is, I mean, so you've already got from Canada, at least from Ottawa, an export tax on electricity of 25%. And we're going to put additional tariffs, it looks like, on that electricity. By the way, Canadian electricity was much cheaper than U.S. electricity. That's why Canadian aluminum was cheaper than U.S. aluminum. We don't produce a lot of aluminum in this country. I can see you're chomping at the bit to say something. But
no, to read more of this.
I just want to point out, you know, the reason that we import so much aluminum is because Canada can make it much more cheaply than we can. And this effectively erases that.
Well, here, then, what do you make of this other headline that's been coming out? It's a long post, right? He's going to be declaring a national emergency, he says, on electricity. But he also said he's going to threaten to permanently shut down the Canada car industry. Can he do that, Matt?
I mean, he can, if he wants to, effectively shut down Americans buying Canadian cars with big enough tariffs. Of course, I suppose they could still produce cars for other countries, but there aren't any Canadian car makers per se, right? They're just producing, you know, Fords and Stellantis, you know, Dodge and Chrysler vehicles.
Mike McKee, we only have about 30 seconds, but weigh in on this as our economics correspondent.
Well, we had one interesting data point this morning, and that was the NFIB Small Business Survey. And in that, their uncertainty index rose to the second highest level ever, which may explain some of companies' reluctance to do a whole lot right now because they have no idea what's going to happen.
Reduce it. That, but probably so, yeah. He was a gentleman. Will you reduce it back? He was a gentleman. Look, I said it before. We give Canada $200 billion a year. We subsidize Canada between all of the things we give them and trade. We give them, we don't have to have cars made in Canada. We don't have to have lumber from Canada. We have tremendous lumber. We have tremendous trees. All I have to do is unfreeze them from some of the restrictions that were put on. I can do that with an executive order. We don't need energy. We have more energy than anybody else in the world. So we spend $200 billion a year subsidizing Canada. We don't have to do that. And frankly, the way that gets solved is Canada should honestly become our 51st state. We wouldn't have a northern border problem. We wouldn't have a tariff problem. They don't have much, they spend very little, as you know, the least of almost anybody on military, and we spend the most of anybody on military. We have a great military. I rebuilt the military during my first time. We're going to have to rebuild it a little bit again, not that much, but we're going to have to rebuild it a little bit again. But Canada would be great as our cherished 51st state. You wouldn't have to worry about borders. You wouldn't have to worry about anything. And by the way, Canada is very highly taxed, and we're very low tax. We're considered a low-tax nation because of me, because I cut the taxes so low. So the people of Canada would pay much less tax. It makes a lot of sense. And by the way, when you take away that artificial line that looks like it was done with a ruler, and that's what it was. Some guy sat there years ago and they said, rah. Well, when you take away that and you look at that beautiful formation of Canada and the United States, there is no place anywhere in the world that looks like that. It's
plus Greenland, of course. Plus Greenland.
And then if you add Greenland, that's even.
I mean.
This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Heidi Stroud-Watts. The top stories this hour. Asian stocks are poised to slide after a sell-off in big tech fuels the Nasdaq's worst day since 2022. President Trump meeting with top executives this week amid recession concerns.
Washington and Beijing reportedly discussing a Trump-Xi summit that could take place in June.
And Alibaba.com's president tells us he sees more potential for AI applications, including in the company's global trade business.
This industry is moving so fast, and a lot of people doing a lot of innovations.
We'll take a look at this is how we ended up when it comes to the US session, and futures also looking pretty negative. We saw stocks just plunging on the growing anxiety that the combination of tariffs and government filings, as well as a number of other Trump administration policies, will torpedo US economic growth and bring about a recession. The Nasdaq 100 really being hit, wiping out more than $1 trillion in its worst sell-off since 2022. The S&P 500 is now on the verge of a correction. We have also seen treasuries rising there as well, as these US recession sort of angst and woes really sending investors fleeing for safeties. Really, markets are boosting bets that the Fed will be cutting more in fear of an economic slowdown that's really starting as a narrative to take hold across broad risk assets there. Yields on that benchmark 10-year note down as much as 10 basis points to 4.2%. We saw the US stock market, of course, in the meantime posting the worst day of the year. Take a look at how we're shaping up when it comes to commodities as well. US crude continuing to see that retreat. We're seeing oil falling to that 6-month low again on these demand side worries over weakening economic growth, both within the US and, of course, the global picture in terms of major economies that are about to be hit by trade tariffs. This is a picture then, not a very bright one when it comes to how we're shaping up for Asia. This is how we're opening just a couple of minutes into the start of that staggered open here in Australia. It's tough to sort of get a read, but we can certainly see the direction is broadly downwards. Asian stocks are generally expected to decline today after that sharp drop in the US there, and we are seeing a little bit of downside there in Sydney. Chicago Nikkei futures also pointed firmly to the downside. We're seeing equity benchmarks in Hong Kong as well looking to tumble by almost 2%. A slide is expected when it comes to the start of trading in Shanghai as well. Really, we're seeing this sort of a 3-week stretch of volatility, if you will, around the world. But it is interesting when it comes to volatility. We've sort of come down from the peak fear, if you will, that we've seen in the markets. So perhaps we could sort of, see a little bit of a turn, but certainly that fear greed indicator showing us that the current selling pressure is the strongest on record right now.
Yeah, let's get a little bit more on this. We're joined by Sam Stovall, Chief Investment Strategist at CFRA Research, joining us now. Sam, as Heidi said there, fear. What are the key words at the moment? I guess uncertainty is another one. If we take a look at this chart on the terminal, we can see that the Nasdaq's not just slipped 4%. It's seeing the strongest selling pressure on record as fear grips the market. Is this entirely inspired by confusing trade policy, or are there other factors at play here as well?
Well, Paul, I think that the confusing trade policy has really sort of tipped over the first domino, and as a result, we then have additional questions about the earnings for the coming year. The market is still trading at fairly hefty valuations, more than 2 standard deviations above the mean over the last 20 years. And then also the concern is about the consumer, since they represent 70% of the U.S. GDP. If they then start hearing the word recession, they start closing their purses and wallets, and that ends up causing a concern for the consumer discretionary category. So it seems as if this has become a manufactured correction that has caused a lot of sectors to tumble.
So if it's a manufactured correction, could we say with any confidence that the floor is in here, or do you anticipate more selling to come?
I think that there probably will be some more selling. I believe that we probably could see the S&P 500 go down to 5,400, which was the support level seen back in September of 2024. That would be a 12% decline, so a mild correction, in my opinion, and that would probably be a good place in which the market could bounce. I typically say that stocks tend to pop after a drop. So I would not be surprised if we start to see some green by the end of this week.
So, Sam, that's the when part of the question, and I do wonder about the where, which is also the topic of our question of the day. Where are we going to see that potential equity bounce? Because at the moment, we're seeing a lot of the skepticism play out when it comes to the sector leaders, right? Tech, consumer discretion, as you say. A lot of defensive, seeing sort of some interest now as well. Where do you see investors potentially buying that dip if and when it happens?
Well, when it does happen, I believe that usually what they do is rotate from first to worst, meaning investors tend to move away from the defensive consumer staples, healthcare, utility sectors, and into the groups that were the worst performers. Obviously, this time around, that's communication services, consumer discretionary, and tech. And should the bounce actually last for a while, traditionally what we find is that the bouncing off of the worst sectors tend to outperform the market by about 5 percentage points and has done so 73% of the time going back to 1990.
Sam, there's a more compelling sort of argument potentially than ever to invest outside of the US, right? What do you make of the kind of fading US exceptionalism story and the fact that we're seeing that underperformance really in stark contrast to the outperformance in a lot of global markets? China is just one of them.
Exactly. Well, I think that reversion to the mean is starting to take place because the developed international markets as well as the emerging markets have underperformed the S&P 500 in 12 of the last 15 years. And right now, those groups are trading at double-digit discounts to their longer-term average relative PE ratios. So we're looking at areas of opportunity that had pretty much been ignored up until now.
All right, Sam Stovall, Chief Investment Strategist at CFRA Research. Thanks for joining us today with your insights. Well, something that could shift market sentiment. Any updates from President Trump's meeting with US business leaders this week? Let's get to our tech reporter, Annabelle Drawlers now. So, Belle, Trump is going to be meeting with tech executives. What are we expecting here?
Well, what we're expecting or what we're hoping for, of course, is any sort of updates of exactly what's discussed in these meetings. We know that an event happened on Monday where President Trump met with the Technology CEO Council in the Roosevelt Room in the White House. But we also know from our reporting on the ground that all of Trump events ended up being closed door, and there's been no playback of this just yet. So it's unclear exactly what happened. But just to give some context, the Technology CEO Council is comprised of the IT industry's leading executives, essentially. It's an all-CEO membership. It's currently chaired by Steve Mollenkopf. He's, of course, the CEO of Qualcomm. He's been in this position since 2017. But it's the group that really advocates for the public policy positions on the issues that are critical to the US IT industry's continued growth. And so, of course, it's a very important point for this. We've seen, I mean, you're looking here at the wealth wipeout that we've seen for some of the richest in the US following President Trump's inauguration. But there's a lot of jitters that are feeding across the US tech industry. The worst day you were just discussing there for the NASDAQ going back to 2022. But clearly a lot of recessionary concerns on the horizon. Plus, you've got concerns around how exactly the geopolitical tensions between the US and China in particular are playing out. So that has happened. No details as yet. Of course, there's more meetings this week. And just to mention, President Trump is also expected to address top CEOs and Wall Street bank executives, but that is happening on Tuesday.
That's a very different narrative so far this year for Alibaba.
Yeah, it's been quite an exceptional run for the stock, and we know a lot of the drivers of that. I mean, Alibaba is of course, very domestically exposed, and so maybe a little bit more insulated from some of those geopolitical tensions. It's been successfully executing this turnaround strategy in its e-commerce operations under Jian Fan, and it's also been starting to really see the rewards of investing heavily in AI. Of course, in the latest earnings, the company pledged that it would be funneling even more money into this endeavor. But actually yesterday we had an exclusive interview with the president of Alibaba.com. Now, just to give some context, this is the B2B B2B business, essentially, wholesale division of Alibaba. It sits within AIDC, but essentially a very internationally exposed business, very, of course, prone to any sort of tariff or trade tensions between the US and China, but also has been investing heavily in AI. And in an exclusive interview, I asked Kuo Zhang exactly who is likely to come out on top in the AI race in China. But, of course, it's always a little bit unclear. But take a listen.
In January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you asked this question in March. I don't think that anybody can anticipate what's going to happen in April as well, since this industry is moving so fast and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle.
Thanks so much. So, yeah, you just heard there Kuo Zhang essentially saying that who wins is very unclear at this point in time. But what is interesting and maybe a little bit different from what we see in the US so far, as well as this willingness of big Chinese tech companies to integrate offerings, for instance, from DeepSeek into their own AI product suite in order to essentially stay competitive.
Well, Alexander Bolgerol is there. We do have more ahead on the Asia trade. This is Bloomberg. The US and China are reportedly discussing a potential summit between Donald Trump and Xi Jinping. That's according to the Wall Street Journal. Our China correspondent Min Min Lo joins us now from Beijing. So what do we know about this potential meeting?
Yeah, we're actually getting conflicting reports from various media. SEMP, for example, reporting that this summit could take place as soon as April. But Wall Street Journal is saying that this could be a so-called birthday summit, because if you're curious, President Xi's birthday is on June 15th, but Trump's birthday is on June 14th. So they're looking at potentially setting up a meeting in June. But of course, April is that deadline for that U.S. investigation into China's trade practices, which Trump had ordered, and that could be a basis for even further trade action. We know that China had been keen to start dialogue as soon as possible. That was what the Commerce Minister Wang Wentao had said at the press briefing last week. But a Chinese source, according to SEMP, had said that it's getting harder to engage with U.S. officials in this current administration compared to even during the Biden administration because of all the changes happening in Washington. Some sources even saying that Washington officials aren't able to start any dialogue now because they can't articulate their China strategy at this point. And of course, the other question is where the two leaders will meet, because SEMP reporting that both sides are wanting the other party to travel to their country. Trump hoping the summit could be held in Mar-a-Lago in his estate in Florida, but Beijing hoping for a more formal summit. And of course, if you look at what happened to Zelensky in Washington, that public scolding there, anyone watching that will want to avoid a repeat of such a heated exchange. China wouldn't want to be seen as a supplicant of the U.S. as well. So perhaps the greater likelihood at this point, according to SEMP, is for Trump to travel to Beijing. But of course, also the climate is very different from 2017 when China last hosted President Trump during his first term in office. China had rolled out the red carpet, treated him to dinner to a meal in the Forbidden City. There was months before that trade war. The conditions and the atmosphere around the two sides, the relations between both sides is of course very different now.
Min Min, we've also got the National People's Congress wrapping up today, having its closing session. Can we expect to hear anything new?
Well, not quite. Today is just going to be a ceremony where the delegates would vote on some of the resolutions from the government work report. They will vote on the national and local budgets this year and the social and economic development plan for the year. But of course, it's known as a rubber stamp parliament. We expect near unanimous votes for most of these items that will be passed today. Normally in the past, we would expect to hear from the Premier who would hold a press conference. But since last year, that has been cancelled. We don't expect to be able to hear that from Premier Li Qiang this year. And that's a sign again of that consolidation of power that President Xi has accumulated over the years, and Premier Li being seen as someone with less free reign over the economy compared to some of his predecessors, because this used to be one of the only times that reporters get to pose direct questions to the Premier, but we're not likely to get this opportunity this year.
All right, Bloomberg's China correspondent Min Lo there. Well, US and Ukrainian officials are set to meet in Saudi Arabia on Tuesday to discuss possible concessions for a ceasefire with Russia. Bloomberg News editor John Honey joins us now for more. So, John, it appears both sides have moved on from that, shall we say, unproductive meeting in the White House. What's on the agenda today? What's going to be talked about? And I guess just as crucially, what isn't being talked about?
Yes, the American the American team, the American administration, has, at least in public, been taking a much more conciliatory tone than in the now notorious White House meeting between Donald Trump and President Zelensky. Marco Rubio, the Secretary of State, who will be leading the American delegation in Saudi Arabia, has called this a listening session. However, at the same time, the Trump administration expects Ukraine to make some sort of commitment to diplomacy. What will officially, at least, not be on the agenda is the natural resources agreement, which Trump has asked Zelensky to ask the Ukrainians to sign, and that was what brought him to Washington for that Oval Office meeting.
So far, we've seen an indication of willingness from Russia, but there's no meeting that we know of that's been set up between the leaders. Do we know how smoothly that path will go, and also how much buy-in is going to be required from European partners?
Well, the second question first. The Secretary of State said that the Europeans would be involved in any final settlement. This after much concern, if not alarm, in European capitals over the exclusion of, say, France, Germany, other countries in the talks. At the same time, Steve Witkoff, who's Donald Trump's Middle East envoy, is making a second trip to Russia, where he will meet President Putin. That's what the Russians are asking for, or what their input is going to be is regarding the talks that are going on, that will be going on in Saudi Arabia. Are as yet unknown.
All right, Bloomberg News editor John Hartney there. Thanks for joining us. Some of the other stories that we're following: Germany's Green Party has demanded tougher rules for defence spending, making a counter-offer in talks with the Conservatives and the Social Democrats. Chancellor-in-waiting Friedrich Merz needs the Greens' support to pass a financing package that requires changes to Germany's constitution. The package includes removing limits on raising debt for defence and setting up a $540 billion infrastructure fund. A cargo vessel collided with an oil tanker off the UK coast, spilling jet fuel in one of the most significant maritime disasters in the area for many years. One person is still missing from the container ship that crashed into the tanker, which, according to one estimate, was holding about 140,000 barrels of jet fuel at the time. A major support operation is now underway. The environmental impact still being assessed. Heidi.
Well, coming up next, we'll be talking AI in our exclusive interview with the Alibaba.com president, Guo Zhang. This is Bloomberg.
Monthly interest credits. Open IDFC First Bank Savings Account now.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Well, the head of Alibaba Group's original core business says the use of various AI applications are having a profound impact on the company. Alibaba.com's president Guo Zhang tells Bloomberg exclusively that its vendors are having an easier time finding new markets for their goods.
take the buyer as an example. So if we think about the search volume for the information or for a product, I think the search volume for the information part is 10 times than the products part. So think about it. If you want to start a business, you will not specifically go to a products or go to a kind of suppliers. You will come up with an idea like what's trending and what's the specific kind of textile you're going to use in your product. And then it's come up the big business plan, and then it's come to the products. So now using AI, have this kind of a multi-round dialogue kind of search. A lot of people now, it's more easy to do business online. And for the sellers, we see current our kind of for agent, these tools is already better than 60 or 70% of the seller if they are new on Alibaba.com in terms of the conversion rate for the customer engagement and for the product management.
But how many businesses, I think there's around 200,000 SMEs that are on the platform. How many businesses are actually using AI today?
So currently the weekly active sellers are more than 100,000. So it's more than half of the sellers is already equipped by this agent-based tools. And for the buyer side, actually, we launched the Axio from last November. Until now, there are accumulating more than 1 million users is using Axio, using this AI-based powered search.
How much do you feel the competitive pressure on AI, given the amount of innovation that's coming from China?
Okay, so first of all, we think there's a lot we can do so far. For example, we talk about the reasoning models, but based on language. There's a lot on the multimodal stuff that we can do later on. Like you can base on anything, an image, a video, or a file that you uploaded the file that the reasoning model can help you to interpret and to execute upon. So all those kind of things, we still believe there's a huge space to grow and we can leverage the most. I mean, the models from Meta, from DeepSeek, from Ali Cloud, 同一千问. So all these models actually can help us to boost the capability of the applications that we believe application actually is a key here. And why we think we can do it here, we can do better than others, is not going to be a few tools that play for the people answer the easy questions. It need to be highly integrated into the big scenarios. Like global trade is a $30 trillion business. I don't think of any other business is larger than this. So if we can apply AI in this business and helping a lot of SMBs, so who cannot participate in the global trade, but now they can. So I think this is a big success for us.
A lot of people are expecting industry consolidation or AI consolidation in China this coming year. How many winners do you see in the AI space in China?
So actually, for that part, I can only speak of my opinion. So if you ask this question in January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you ask this question in March, I don't think that anybody can anticipate what's going to happen in April as well. This industry is moving so fast, and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle. As people in this technology domain, I don't think anybody can anticipate what's going on for this year.
Alibaba.com's president Ku Zhang speaking exclusively with Bloomberg's Annabelle Jewellers. All right, we have another chapter in the ongoing saga that is Star Entertainment. We are hearing from Star. It's confirmed that it's entered into an exclusivity and process deed with Salter Brothers Capital, and this is in response to media speculation in the Financial Review that there is a $750 million refinancing package in the works with Salter Brothers that would secure Star's long-term financial future. The question on everybody's lips, though, Heidi, is who's Salter Brothers?
Oh, I can help you out. They hold a significant portfolio when it comes to some of these high-end luxury hotel and accommodation assets, including the Bannisters Hotel. So they are the second biggest hotel owner at this point in Australia.
Monthly interest credits. Open IDFC First Bank Savings account now.
నిజమేంటంటే కొత్త ఇండికా న్యాచురల్ అండ్ నరిష్ క్రెమ్ హెయిర్ కలర్ లో ఉన్నాయి. మీ ప్రసిద్ధి చెందిన హెయిర్ కలర్ తో పోల్చినప్పుడు 30% తక్కువ డై కెమికల్స్. ఇది నిజం.
Getting some breaking news out of Australia. It is Westpac consumer confidence for the month of March, and a big jump here, rising 4% from a month earlier. That's the biggest increase since we've seen since November last year. Of course, in February, we did have the RBA cut the cash rate to 4.1%. Coincidence? Perhaps not. Consumer sentiment up 13.5% on year. A number of people who think it's a good time to buy a house now, that's up 4.3% on month as well. This is crucial for the RBA, in fact, because they did mention at that last meeting that they are assessing improved consumption, which could suggest the risk of inflationary pressure resuming. But a big jump there in consumer confidence. The reading, though, still in negative territory overall because it is below 100. Heidi.
Yeah, take a look at if you see much of a reaction. Of course, it is broadly a down day after that. A big sell-off in the US overnight. We're seeing equities in this part of the world looking pretty sluggish today as well. This is a picture when it comes to FX. So that flight to safety that we saw, obviously involving treasuries, obviously involving the US dollar as well. The Bloomberg dollar index rising in the New York session, really part of that broader safety trade there. Dollar yen holding at that 146 level. We are looking at dollar yen really on the verge of potentially being oversold. 145 is that sort of level that we're looking at the moment. And dollar China also one to watch as well as we get that wrapping up of the MPC today, and the reporting that potentially we could see this leadership meeting being arranged between Presidents Trump and Xi. Also watching the euro at the moment as well, as some of the concerns over German funding or sort of agreement over funding for the rearmament effort is now being called a little bit into doubt, and that obviously had been such a big driver when it comes to both the euro and the European equity rally over the past couple of weeks.
Well, joining us now is Laura Fitzsimmons, Head of Australia Macro Sales at Deutsche Bank. Laura, thanks for joining us today. I just want to pick up on that theme around the dollar. I mean, we've got a yen now with a 146 handle, although there seems to be a floor in for the US dollar now. Are we stabilising here, or can you see more weakness to come?
Yeah, I think it's more selective going forward. I think broadly there was obviously a lot of subscription to the long dollar trade as we began Trump 2 administration, and a lot of those trades are all being unwound across asset classes, as we've seen. I think in terms of FX, I guess where we're focused at the moment is looking at, I guess, in terms of the equity sell-off that we have in the US, what are the best plays in terms of the FX land that we can look at here? We're taking the dollar leg out of it, and trades like Euro Swiss, for example, also CAD Swiss, essentially CAD Swiss potentially looking lower, but certainly the euro, as you mentioned, Heidi, it has been one over the last week which has had a huge amount of attention, and being at Deutsche Bank, we've certainly been at the forefront of delivering our views around that. We're still very excited by the prospect. It will face obviously some hurdles to come over the month, and obviously from the legislature we do need to not rest on our laurels here. However, the base case is that the package will get through. So we are still very bullish from here, and thinking that it's clearly going to be a bright spot in an otherwise rather gloomy kind of global outlook at this point, just given what's happening in the US.
Yeah, well, the bond market's sending some pretty clear signals on what it thinks is going to happen as well, suggesting that, let's not ignore the risk of a recession here. And if we take a look at this chart on the Bloomberg terminal, we've now got markets pricing in 3 Fed cuts for 2025. Although we heard from Jay Powell, he seems to be in no hurry to change policy. What's your view on where we end up with rates this year?
Yeah, it's obviously evolving quite quickly. Deutsche Bank began the year with looking for no further cuts from the Fed, and that was quite controversial at the time. And then it started to play out, particularly as tariffs tended to be seen as having more the inflationary impact. Now, when we heard from Chairman Powell over the weekend, I guess at least the hike was pushed aside, and I think that obviously allayed a lot of investors' concerns that might actually be a risk again. But now it's really about, how much of a clear run do they have at cutting rates again, and we don't think that that's something that's going to evolve in the very near term. It's still a risk for the remainder of the year, but certainly in terms of the March decision and in the very near term, as I said, we still feel that the uncertainty around tariffs and the inflationary impulse that comes from those will be enough to keep the Fed on the sidelines, particularly when they started the year obviously with much stronger growth. Fundamentally, the US was in great shape, and it's really now the noise and the uncertainty, consumer sentiment that's coming off, but obviously inflation expectations expectations also increasing. So they have a lot to consider, and I think from that perspective, we think that on hold makes the most sense.
From a positioning point of view, as you say, uncertainty on US policy basically permeating every front in terms of risk. How much short-term is there in the market? Because we speak to a lot of money managers that are like, even 24 hours, is a very long time in this sort of news cycle.
Absolutely. I mean, the headline noise is hard for investors to deal with. And certainly in markets, I mean, it's something we've become used to. But right now, it's certainly at the peak of noise, we would say. And I think overall, for investors, I guess what I would be more concerned about when I think about the US is actually some of the more problematic things that President Trump will have to deal with. Obviously, the deficits was a huge focus heading into this administration. And so far, they've made a lot of noise about spending and DOGE. And, essentially, though, if we are going to look at tax cuts being continued and certainly other cuts being delivered as well, and we're not really, when we look at the numbers, we're not seeing where that spending saving is really coming from. And so the numbers just don't quite stack up. And I think if they're already laying out a sort of a bumpy roadmap to get to these longer-term goals. If the longer-term goals are not that attainable, and actually by weakening the economy, you're compounding the problem, that's actually more of a concern, I would say, for investors. And maybe they're not thinking about that yet. It's a little bit too far down the line. But certainly I think that is what's maybe drawing into some question around owning US assets, whether that be bonds or equities or the US dollar.
It's not just the inflationary and growth picture that gets impacted domestically, right? It's also every other economy, including Australia, that's hit by tariffs, by that relationship. And I do wonder, if you take a look at market pricing for the RBA at the moment, is it still too much of a one-way bet in terms of expectations?
It does seem that this market has particularly priced a lot more in terms of easing than maybe you would expect from the RBA, particularly when we heard that rhetoric from Governor Bullock and obviously Deputy Governor Hauser as well recently, striking a fairly hawkish tone for a central bank that's just cut. Now, in our forecast, we actually do have a total of 4 cuts at Deutsche Bank for the RBA this year, but the market is really, I think, more in the like I would say, thinking more that maybe 1 to 2 more might be delivered. I think the market pricing has generally erred, as I said, on the side of overpricing the cuts. And until we really start to see some weakness coming through, not just on the domestic spending side, but also I think once we get past some of the government spending, past the election, that might become a little bit more clearer. But for now, it's just hard to imagine the RBA shifting so soon again to cut rates once more. And I think they've pointed actually to Norway. And obviously, we had a very strong CPI coming out from Norway overnight. Now, this is an economy that the RBA has actually drawn some parallels for Australia with. So I think it's worth us noting that they're still very alert to the risks that tariffs can cause on the inflation front. They don't feel like that fight is over yet. And I think we have to keep listening to them from that perspective.
Laura, really great to see you, particularly here with us in the studio. Laura Fitzsimmons, who's the head of Australia macro sales at Deutsche Bank. Well, China has set a fiscal deficit target of around 4% of GDP to counter the effects of rising US tariffs. We spoke with Michael Pettis, he's a senior associate at the Carnegie Endowment for International Peace, about what comes next for the Chinese economy.
Raising the fiscal deficit target by a percentage point is more for signaling purposes than anything else, because the truth is the real fiscal deficit, as calculated, for example, by the IMF, is something like 15 to 20%. It's much higher. So what that really means is that part of the fiscal deficit will be shifted away from the local governments towards the central government. But ultimately, it doesn't really tell us a lot about what they're going to do. I think this year will look a lot like last year. The really big question mark is trade. Last year, trade was great. If it's good again this year, it'll look very, very similar. If it's not good, and they're not able to raise consumption, which is their big goal, then we'll probably see a bigger fiscal deficit. We'll probably see more debt and more investment in infrastructure.
Well, what is the panacea for creating that domestic demand?
I think it's pretty simple. Budget constraints. I mean, you basically spend based on your income. If I want you to spend more, I've got to give you a bigger income. So if you raise the income share of ordinary Chinese, the consumption share will automatically go up.
Is that going to happen, though?
It's really tough for it to happen because a lot of people think that low income is just sort of an oversight or a bug in the system. But the low household share of GDP is fundamental to the way the economic model works. And it's the reason why Chinese manufacturing is so competitive. So if you fix one, you undermine the other. You can't really separate them.
From a historical standpoint, how do you see the evolution of protectionism coming on both sides? Obviously, from the trade front with the Donald Trump administration, now 20% tariffs on top of what was already in place. It's a symptom of something you told me much deeper and longer lasting.
We see it too much sort of as a Trump Xi thing. And I don't think it's that. I think, we're going to see it continue to spread. The imbalances that we have are the largest we've ever seen. As Keynes explained, these imbalances put downward pressure on global demand. And the countries that absorb that downward pressure have to respond either with higher unemployment or, much more likely, higher debt. And at some point, it's not sustainable, and you've got to reverse it. So we're going through, in my opinion, a major transformation, equivalent a bit to what happened in the 1970s or what happened in the 1930s, a big change in the way the world operates. Trade war is particularly painful for surplus countries. Remember, the biggest surplus country then was the United States, and it suffered most from the contraction in global trade. If you can't run surpluses and you can't raise the domestic demand, then you have to reduce production, which means firing workers, rising unemployment.
Where do you think we'll be in 5 years with the Chinese economy? Essentially, it's going to be going through a protracted trade war, and they have to also stimulate domestic demand. So where are we going to be in 5 years?
That's as much a political question as anything else. Growth will be much lower. I think growth expectations will also be much lower. Debt levels will be much higher, which is one of the reasons they'll have to constrain the growth in debt. But the real issue for me is whether they decide to go through a rapid adjustment, which means taking the losses and allocating them, or a slow adjustment. If I had to guess, I would say they would prefer a slow adjustment because it's socially less destabilizing.
That's Carnegie Endowment for International Peace Senior Associate and Professor of Finance at Peking University's Michael Pettis speaking there with Bloomberg's Stephen Engel. All right, we have more ahead on the Asia trade. This is Bloomberg.
Monthly interest credits. Open IDFC First Bank Savings Account now.
We'll be watching 7&I shares as we do just about every day. There's always something happening in this latest developments when trading in Japan starts in the next hour. Couche-Tard now saying that it will continue to keep pushing for a deal with the Japanese firm despite 7&I's own attempts to fend off a takeover. For more, let's bring up Bloomberg senior editor Reid Stevenson in Tokyo. So clearly there's still hope that perhaps this remains, one of the few options on the table for 7&I. What are we hearing from Couche-Tard right now?
Yeah, indeed. I mean, this statement from Couche-Tard this morning comes after a flurry of news over the past week. Last week we saw massive announcements by 7&I, new CEO, share buyback, the sale of its U.S. business, and on and on. Monday is when we saw sort of a new development where an activist investor in 7&I came out criticizing some of the steps it's taken in this sort of process where essentially, the company has been seeking to fend off this takeover proposal by the Canadian operator of Circle K stores by implementing steps. And then 7&I itself had yet another announcement yesterday saying that it had made proposals to Couche-Tard about resolving some of the potential antitrust issues in the U.S. And all of this essentially led up to now this morning where we have Couche-Tard saying in a kind of long-winded fashion that it's still interested in Seven & I, it's confident of the financing, and it's also has a path, a clear path, in fact, toward resolving some of the potential U.S. antitrust issues, namely because any deal between these two companies would mean that the number one and number two player in the U.S. are going to combine, creating a company with more than 20,000 convenience stores in North America, and really dwarfing the next competitor by 7 to 8, 9 times. So that's where we're at this morning.
Reid, just looking over this media release from Couche-Tard, it's quite unusual in many respects. They're just ladling on the respect with a trowel. Is this part of the strategy here? Is charm and politeness?
I think you're absolutely right. Couche-Tard is actually very much aware of some of the potential sensitivities and concerns around any potential deal. That's why I think they've played sort of a slow game, so to speak. They've, displayed patience, and I think, this statement this morning suggests that they'll continue to do so in pursuit of a deal. What they made clear, for example, is that they did not want to cut jobs or really mess with the Japanese convenience store business of Seven & I in any way. Really, that is the crown jewel. In fact, what they want to do is, take some of the best practices from that and really spread them into a sort of an international convenience store champion. Something that Seven & I itself has said it wants to do, but hasn't quite executed, leading to a rather low or undervalued share price and attracting a lot of criticism, attention, as well as this buyout proposal.
All right, Bloomberg senior editor Reid Stevenson there in Tokyo. Let's take a look at how Tesla is doing at the last close. Not great. A horrible day for Tesla stock. Off 15%. That's the worst day since 2020. Year to date, down 45%. Tesla's wiped out all of the post-election gains, and concerns over sales high to just keep on growing. UBS has cut its forecast for deliveries for the first quarter and the full year, and registrations in Germany, we all know Elon Musk's relationship with that country, down 70% in the first 2 months of this year. It's had an impact on Elon Musk's wealth as well.
Yeah, and multiple ironies to this. One, of course, is the fact that Tesla gained 98% in the weeks following the election, expecting that it was going to be a bullish signal. And, of course, the fact his very significant role within this new administration, that drop of $185 billion in his net worth since the peak in December 17th, that is, as our very own David Inglis has worked out, the equivalent of Croatia's annual economic output. Sticking to tech, though, Apple preparing a major software overhaul to transform the interface of the iPhone, the iPad and the Mac. The update aims to change the look of operating systems and simplify navigation. For more on this Bloomberg scoop, let's bring in our technology reporter Mark Gurman. And Mark, as an Apple user, I kind of shirk away from these changes in formatting, in the way that the device looks. But what are we expecting?
This is a nice distraction from artificial intelligence woes that Apple has been facing, right? We're not expecting any big AI improvements this year, but we're expecting an entirely new look and feel. This is fundamental to how the devices will operate. These are the biggest changes to iOS, macOS, and iPadOS in many years. In the case of the Mac, a couple decades. In the case of the iPhone, about 15 years, right? So this is largely significant, and it's deeper than just cosmetic changes. It's not just about a new design. It's about how they look, how they feel, how you operate them, how you navigate through the operating system. App icons are going to change, menus are going to change, windows, buttons. So this is an end-to-end overhaul for Apple's biggest operating systems, and this is how users interact with the company's products, right? This is why people buy Apple products, because they get and they use and they like the intuitive user interfaces of the product. So this is a very big deal for Apple.
Well, nice try, but let's get back to that AI distraction. I mean, the update to Siri has been delayed. I mean, what is the hold-up here, and when is that update coming?
Yeah, artificial intelligence for Apple has been a disaster. They bought Siri back in 2009, 2010. They launched Siri on the iPhone 4S at the end of 2011. And since then, their lead in AI has just completely fallen apart. They have got nothing in comparison to what you're seeing from ChatGPT or Anthropic or Perplexity or even what runs on Microsoft and Samsung devices because of their partnerships with companies like Anthropic in the case of Amazon, Microsoft, OpenAI, and Samsung's obviously working with Google Gemini. So they're very behind. Two major Siri improvements, sort of this AI infusion. One feature called App Intents, another called Personal Context. This allows you basically to tap deeply into the apps and control them via Siri, but also really source up your data in order to provide context for different queries, right? So for example, you can go to a coffee shop, they show in the advertisement, they could say, who's the person I met here a few months ago, and the phone will be able to tell you, or be able to pull up text messages you had with your mom as another example they provide in their keynote last June, and make a lunch plan with her. But those are delayed, and I'm told it's indefinite sometime next year.
Our technology reporter Mark Gomer with the latest on Apple. We do have some breaking news, just data crossing the Bloomberg. Japan GDP numbers for the fourth quarter growing 2.2% on an annualized reading. The estimate was for 2.8%, so a little bit softer than expectations. On a quarter-on-quarter basis, we're seeing growth of 0.6%, pretty close to the estimate of 0.7%. Nominal GDP at 1.1% quarter-on-quarter, a little bit slower than the 1.3% expected. Private consumption levels are unchanged quarter-on-quarter. Business spending, though, rising over 0.5% quarter-on-quarter. That is better than expectations. That came in a little bit under there. Net exports adding 0.7 percentage points to that GDP on a quarter-on-quarter basis as expected. And finally, that GDP deflator at 2.9% in the fourth quarter year-on-year, pretty close to estimates of 2.8%. This kind of doesn't really change the trajectory when it comes to the Bank of Japan. We did hear from one ex-official talking about the likelihood that the next rate hike is probably going to happen in June. Unlikely to move in July, given that we're expecting a national election there. June or September at the moment is looking a little bit more likely, particularly as we've seen the fastest base pay gains in 32 years. That's been the biggest missing sort of puzzle piece for that Japan revival. More ahead on the Asia trade. This is Bloomberg.
Let's check in on US futures. Not doing great is the short story here. We do have Dow Jones futures like 9 points in positive territory, but elsewhere S&P futures off by 1/3%. The Nasdaq, which bore the brunt of yesterday's or today's selling in the US, is showing further downside here, off 0.7%. It was a wretched day for the Nasdaq, down 4%. Worst day since 2022. The Magnificent Seven hammered. Tesla, the worst of those, off 15%. And futures showing that, well, there may be a little bit of downside to come. A lot of fear circulating at the moment on growth, on recession as well, mostly linked to unpredictable trade policies. So economic anxiety there also stoking. Fed cut wages, market now predicting potentially 3 in 2025. Market opens in Seoul and Tokyo. Up next, this is Bloomberg.
இப்போ எக் ஒயிட் புரோட்டீன் ஷாம்பூல இருக்குங்கிறது தெரியாதா? ஷிக் எக் ஒயிட் புரோட்டீன் ஷாம்பூ. இது டேமேஜ் ஹேரை பராமரித்து ஹேர் ஃபாலை குறைக்கிறது. முடி கொட்டுற கவலையா? சான்ஸே இல்ல. ஷிக் எக் ஒயிட் புரோட்டீன் ஷாம்பூ.
This is the Asia trade. We're counting down to Asia's major market opens, and of course we are bracing, I think perhaps is a good word, when it comes to how the rest of the Asian session plays out when Japan and South Korea come online. Of course, we saw that growing anxiety that from trade tariffs to geopolitical tensions to domestic government firings and some of the immigration reforms, that we're going to see all of these administrative actions from the Trump government potentially really crater US growth.
Yeah, plenty of fear and uncertainty to go around. We've got yields continuing to slip, so the bond market seems to be making up its mind about the recession risk as well. It's just going to be interesting to see whether or not, it's the floor is in for US stocks or not, and whether Asia could be a beneficiary.
Yes, that sort of outperformance gap when it comes to markets like China, for example, Europe, of course, continues to widen. And this is the picture as expected. We're really looking at a sea of red there as major markets continue to trickle online. The Nikkei 225 already down by 1.2%, within the topics up by over 1% as well. Some pretty solid GDP data. The revised fourth quarter GDP has been revised down, the real GDP number, to 6.8% quarter on quarter, but still the strongest since the second quarter of 2024, even with that downwards revision. So really keeps the Bank of Japan very much on track for further tightening, and expectations are sort of around July or potentially September this year, according to some commentary from a recent commentary, I should say, from an ex-BOJ official, Kazuo Mama there. We are also seeing the yen sitting at that 147 level. Some questions as to whether dollar yen might be looking oversold, but of course we had that flocking to the US dollar and treasuries as a way of haven demand overnight as well. Take a look at Korean stocks, because here we'll see really potential.
देखो बहुत बार सेल कर चुके हैं, अब थोड़ा सा रिस्की लेवल हो जाएगा, कर सकते हो, क्वांटिटी कम रखना। ये दोनों ही लेवल ऑफ रिस्की है। मैंने थोड़ी देर पहले प्राइस एक्शन दिखाया था यहाँ पर, जिस तरह का ये प्राइस एक्शन बना है, एक बार रेजिस्टेंस लिया, नीचे आया, दोबारा रेजिस्टेंस लिया, नीचे आया, थर्ड टाइम रेजिस्टेंस लिया, उसी लेवल पे आया, फिर से उसी लेवल पे जाके फिर ये कुछ ये प्राइस एक्शन बना हुआ है। अब इसमें कहीं ना कहीं तो ये रेंज ब्रेक होने के चांसेस हैं। डाउन साइड ब्रेक हुई तो बहुत बड़ा मोमेंटम कर जाएगा डाउन साइड पे भी। सिमिलरली अप साइड पे किया तो फिर ऊपर के लेवल भी वीक हो जाएंगे। फिलहाल के लिए रेंज बना सकते हो। कल सेलिंग आई थी मार्केट में, फिर उसके बाद यहाँ से एक बाइंग आ गई थी क्लोजिंग होने के बाद फॉरेक्स में। मॉर्निंग पे फिर से एक सेलिंग थी और फिर से एक बाइंग आ गई है। जिन लोगों ने बाई किया वो भी प्रॉफिट बुक कर लो, ठीक है। अभी भी रेंज है, रेंज ब्रेक हुई नहीं है। रेंज ब्रेक होगी तभी मोमेंटम आएगा। जिन लोगों ने बाई किया था उनका भी टारगेट हो चुका है यहाँ पर। बाकी ट्रेल करना है तो आपकी चॉइस है, क्योंकि ये रेंज है, किसी ना किसी साइड तो मार्केट को उड़ना ही है। ज़्यादा देर होल्ड नहीं कर पाएगा मार्केट। सीपीआई का डेटा है, मोस्ट प्रॉब्लम मुझे लग रहा है सीपीआई के डेटा के बाद शायद थोड़ा बहुत मार्केट मूव कर जाए प्रॉपरली। देयर इज अ वेरी हाई चांसेस। बाकी नेचुरल गैस कल एक सेलिंग का ट्रेड बनाया था, एफई से नीचे सपोर्ट था, वो ब्रेक हो गया था, वहाँ से सेलिंग अच्छी आ गई थी। नीचे मैंने बताया है यहाँ पर बाइंग का एरिया है, यहाँ पर भी एक बाइंग का एरिया है, यहाँ से भी ट्राई कर सकते हैं। यहाँ थोड़ी क्वांटिटी लेकिन कम रखना, और कैंडल ओपन इक्वल टू हाई पे बाय मत करना, ओपन इक्वल टू लो पे सेल मत करना, ठीक है। रिस्क में चले जाओगे नहीं तो ज़्यादा। लेट्स सी अब किसी एक साइड की रेंज ब्रेक हो जाए तो क्रूड ऑयल में किसी भी साइड हो जाए, या तो यहाँ से ऊपर निकल जाए या फिर वापस सेलिंग आके नीचे मार्केट ब्रेक कर दे, तो थोड़ा ध्यान रखना अब इन लेवल्स पे, क्योंकि अब ऊपर का लेवल भी वीक हो चुका है। ये दोनों ही लेवल अब रिस्क पर है। WSL मींस वीक सपोर्ट लेवल, वीक रेजिस्टेंस लेवल। ठीक है, सीपीआई का डेटा इंपॉर्टेंट, क्रूड ऑयल की इन्वेंट्री भी है, ध्यान रखना। 6 PM पे आ जाएगा सीपीआई का डेटा। 5:30 अभी न्यूयॉर्क सेशन ओपन हो जाएगा, एंड देन आपका 7 PM यूएस मार्केट ओपन, 8 PM क्रूड ऑयल की इन्वेंट्री। ठीक है, क्रूड ऑयल मैंने बता दिया। अगर यहाँ से अब इस रेंज पे ना थोड़ा संभल के करना, चाहे बाय करो सेल करो, ये रेंज ऐसा नहीं है कि अभी की बनी हुई है। 2 वीक रेजिस्टेंस भी सपोर्ट भी, अब करने को आप यहाँ से भी सेल कर सकते हो, यहाँ से बाय कर सकते हो, बट अब किसी ना किसी एक साइड का एसएल जरूर जाएगा, इसका भी ध्यान रखना। आई डोंट नो किस साइड का जाएगा। प्राइस सेक्शन के अकॉर्डिंग तो नीचे सपोर्ट ब्रेक होना चाहिए था, नहीं हुआ है। रेजिस्टेंस लिया, नीचे आया, फिर उसी लेवल से रेजिस्टेंस लिया, नीचे आया, रेजिस्टेंस लिया, नीचे आया, रेजिस्टेंस लिया, नीचे आया, फिर से उसी लेवल पे। लॉजिकली तो इसको नीचे सपोर्ट ब्रेक कर देना चाहिए था, नहीं कर पाया अभी भी। अगर ये ऊपर का रेंज ब्रेक हुआ तो फिर सीधे 5000 6000 ही मिलेगा। तो रेंज का ध्यान रखना आप। पहली बार जैसे कल सेल किया था, कल पहली बार आया था लोअर एंड के आसपास, तो यहाँ से सेलिंग ठीक ठाक बन गई थी। इसी तरह से सपोर्ट एक बार दो बार ले चुका था, तो कल फॉरेक्स में थोड़ी बहुत और आ गई, एंड दिस अ थर्ड टाइम। बाकी सेलिंग भी देखोगे तो थर्ड टाइम ही है। तो 3 बार सपोर्ट ले चुका है, 3 बार रेजिस्टेंस ले चुका है। दोनों ही लेवल अब वीक है, सपोर्ट भी और रेजिस्टेंस भी। करने को कर सकते हो जब तक ब्रेक नहीं होता, बट ध्यान रखना एसएल जाएगा तो निकलना भी है। फ्रेश एंट्री बना रहे हो, बाकी सेफ थोड़ा सा मेरे अकॉर्डिंग किसी एक साइड का अगर रेंज ब्रेक हो जाए तब बन जाएगा, बिकॉज उस केस में फिर हमारे पास एक ब्रॉडर रेंज बन जाएगी। ऊपर रेजिस्टेंस अच्छा हो जाएगा, नीचे फिर सपोर्ट स्ट्रॉन्ग माना जाएगा। बाकी नेचुरल गैस में जरूर ट्राई कर सकते हो, नीचे यहाँ पर भी सपोर्ट है, इस एरिया पर भी सपोर्ट है, यहाँ पर भी बाई कर सकते हैं। कैंडल का ध्यान रखना, ओपन इक्वल टू हाई पे मत करना भाई। बाकी क्रूड ऑयल अगर मोमेंटम नहीं आया टिल 6 PM तो फिर इन्वेंट्री के बाद ही आएगा, बिकॉज फिर मोमेंटम होना भी नहीं है क्रूड में। इन्वेंट्री फोरकास्ट लास्ट वीक +3.6 था, इस बार +2.1 है, मींस लास्ट वीक के कंपैरिजन में कम एक्सपेक्ट कर रहे हैं। तो फोरकास्ट के अकॉर्डिंग 2.1 से कम कुछ भी आता है तो इट इज़ पॉजिटिव फॉर प्राइस। तो फोरकास्ट देखोगे तो फोरकास्ट तो आपका बुलिस है प्राइस के लिए कि प्राइस को ऊपर जाना चाहिए एज पर द फोरकास्ट। देखते हैं एग्जैक्टली कितना आता है। क्रूड में ध्यान रखना, ठीक है, आप बाइंग सेलिंग करोगे इन लेवल से थोड़ा संभल के, क्वांटिटी ज़्यादा मत रखियो। बाकी नेचुरल गैस में ज़रूर ट्राई कर सकते हैं इन दोनों ही लेवल पे। वाला थोड़ा ज़्यादा स्ट्रॉन्ग है। लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नेचुरल गैस क्रूड ऑयल बताया मैंने, कर सकते हैं बिल्कुल कर सकते हैं, बट लिखा भी हुआ है तो क्वांटिटी मत लेना ज़्यादा, ठीक है, क्योंकि अब रेंज ब्रेक होने वाली है किसी ना किसी साइड, मुझे भी नहीं पता किस साइड होगी, ये मुझे पता होता किस साइड रेंज ब्रेक हो रही है तो बात ही अलग है। एक लेवल एक से दो बार ठीक ठाक काम करता है, अब तीन तीन बार एक ही लेवल पे आए प्राइस तो फिर रुकना नहीं गाइस, 15 लाइक्स पे रुक जाओ कैसे चलेगा बताओ। यहाँ पर जो सेल करेंगे ध्यान रखना क्रूड में थोड़ा क्वांटिटी कम रखना, देखो क्योंकि मोमेंटम किसी साइड भी आ सकता है, बट जहाँ भी आएगा बड़ा ही आएगा, चाहे यहाँ से नीचे जाए या फिर यहाँ से ऊपर जाए प्राइस, मोमेंटम बड़ा होने वाला है। बाकी सब हर किसी को होली की शुभकामनाएं एडवांस में। 14 को है होली वैसे, मार्केट बंद है उस दिन, एमसीएक्स मार्केट ओपन रहेगा इवनिंग पे।
Asia was a bit more sober, but we see quite strong growth in Southeast Asia, in particular in the health and beauty and as well convenience and restaurants. So I think we're in good shape relative to achieving our revenue guidance of 2% for 2025 and share gains with margin expansion, despite, I think, a pretty cautious environment out there.
How about your outlook for China and Hong Kong's retail sector as well? And I mentioned that in the context of the about to conclude NPC, where we've heard from China's policymakers and their plans to spur domestic growth in China. Has that changed your outlook there?
No, I think I see similarity. Hong Kong, China, Taiwan, Macau. I think there's just, a sense that until there's a confidence of personal wealth beginning to grow again, consumers will be careful. And we see it not only in terms of shopping, but tourism, for example. We get a lot of tourists into Hong Kong. And tourists pre-COVID versus post-COVID in terms of what they purchase, wildly different, much more value-oriented. Yes, unique products, but value-oriented products. So we're ensuring we've got the right items on shelf.
How about M&A opportunities? What are you looking at in that department, if anything?
Well, we've done a few divestments. 2024, we exited food in Indonesia. We were not a number one position, therefore it was not helpful. We exited our minority shareholding in Yonghui in China. We're ensuring that the portfolio, we're pivoting more towards operating than portfolio companies, so any potential inorganic moves would be accretive to the existing portfolio, but would be a majority in controlling interest. Not going to speculate, but we keep our eyes open, and potentially these challenged times offer opportunity.
I'm curious because, of course, you operate some of Seven & I's stores outside of Japan. What do you make of the ongoing tussle over 7&I's future, and does it have operational impact on you depending on what happens, depending on if a takeover by Couche-Tard does eventually come through or some other form of restructuring takes place instead?
We're a very profitable 7&I franchisee. We have a very long-term, strong contractual relationship with the franchisor. Whatever controlling shareholder, I don't think it changes the agreements that are in place, nor I think a very good relationship with us. So we don't see any concerns regardless of how that particular battle turns out.
All right, Scott Price, Group Chief Executive of DFI Retail Group. Thanks so much for joining us today. We've got more ahead on the Asia trade. This is Bloomberg.
I think it's going to be panic at the disco. We haven't gotten there yet, but as these levels climb, there will be unwinds and more uncertainty that triggers even more.
It looks like those conditions are not going to change, and the volatility is going to persist as long as we have uncertainty around tariffs and economic policy. But I do believe that longer-term investors can start looking at these levels, start putting their shopping lists together, and start looking at quality names that have been beaten up over the last couple of weeks.
It's the whipsaw that's going on that's driving the markets crazy.
Bloomberg TV guests there on the US market sell-off, and a chorus of Wall Street strategists warning about rising volatility in the stock market. Morgan Stanley's Michael Wilson is the latest to sound the alarm on slumping US growth. He expects the S&P 500 index to drop as much as 5% to 5,500 in the first half of the year as corporate earnings suffer from Trump's tariffs and lower fiscal spending. Market forecasters at banks such as JP Morgan and RBC Capital Markets have also tempered bullish calls.
Meanwhile, Carlyle Group's Jeff Curry thinks that the world is seeing peak oil trade. Curry explains that the trade in fossil fuels across borders is set to decline as nations seeking energy security accelerate investments in renewables and nuclear power. He adds that the subsequent reduction in trade will lead to slower oil and gas demand. Let's take a look at how we're trading when it comes to the start of futures in Europe, and of course a terrible lead-in from the US, from the Asian session so far, with just the sheer amount of anxiety when it comes to the US economic slowdown and how some of these tariff and other Trump administration policies could be playing.
Good morning. We're half an hour away to the open here, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. It's a cautious start to trading in Asia after volatility hits Wall Street, with investors unnerved by President Trump's tariff plans, even as he downplays risks of a recession.
Yeah, Donald Trump dialing back his threats to double duties on Canadian steel and also aluminum here by 50%, or to 50% rather, but says Australia will not be granted an exemption from those tariffs.
Also ahead, Ukraine accepts a temporary US-brokered ceasefire plan in return for military aid and intelligence.
Plus, a big show coming up here. A lot of key executives coming through to discuss earnings, industry trends, with top executives from Chinese auto tech providers Hesai, ECARX, and we're also talking percent. That now takes the index down 9% from the top on, interesting enough, Valentine's Day, Feb 14, or not interesting enough. 0.2 to 1% to the upside on the Asia-Pacific benchmark. We are likely to see a bounce today across these Chinese markets. In fact, just on that very note here, and as you can see, a couple of markets are coming online, like Taiwan. And we have this ASUS conversation coming, of course, later on in the show. It's a very tech-heavy, tech-focused show we have for these next 2 hours or so. So the bounce I mentioned we're likely to see, and really, if you read the read-through across markets in the U.S., of course, particularly the China proxies, 3% to the upside. NIO was a big one. NIO, XPeng have been really big moves of late. BABA for obvious reasons, and of course Hesai was at 50%. So we'll talk with David Lee later on, of course, on their plans, this tie-up that they have, and really what they're projecting as far as earnings are concerned. Right. The approach to the open is flat. It's worth pointing out that the southbound flows, which have been really a key source of support here for these markets, actually started extremely strong this time yesterday and then turned negative into the close. So they were net sellers of these Hong Kong markets. We're looking at steel for obvious reasons here, given, of course, the tariff conversation. And on dollar China, as far as technicals go, 200-day moving average to the downside, we're hitting that as well. So you flip it around, that could be your resistance to the upside. At about that level, 4-month highs in that. And the CGB curve, 2, 5, 10, and 30 had a 2% print yesterday. That's what we're tracking here today. So we're pulling back a little bit from that, as well as a 1.9% handle here, Rebecca, on the 10-year yield in China.
Yeah, that's right. Yields very much still in focus. Essentially on that 10-year specifically, to your point there, we saw them surging 19 basis points over the last 5 trading sessions. And that essentially is the biggest jump in 5 years. Now, there's sort of 2 big reasons for the move, but we have a really nice column out by our colleague Yesir overnight explaining that part of the move has in fact been driven by the PBOC engineering this sell-off to try and cool speculation that we've seen in the fixed income market. Of course, part of that has also been the DeepSeek story, people, moving away from safer assets and trying to take advantage of the rally that we've seen, largely speaking, at least in some of these stocks, particularly in Hong Kong. However, to your point about southbound flows, yeah, we'll keep an eye on that closely. Today, we did see this reversal. We had a record number target hitting on Monday, about $3.8 billion US dollars. Elsewhere, the USD, yes, the USD-yuan exchange still in focus, really over this story, and it's closely linked to the PBOC story, whether or not they're going to continue to offer really this focus and support to maintain that currency stability, or whether we may finally start to see the looser monetary policy that was promised to investors all those months ago. There's been a bit of whiplash for investors, being promised something and then not really seeing any of those cuts coming through. The commentary from the PBOC, however, Dave, has still been relatively hawkish. Elsewhere, we also have new earnings coming through, Cathay Pacific, Samsonite.
Yeah, it sounds like a travel day if you look at that. Okay, to the point Rebecca was making, right? So there's uncertainty around tariffs, and perhaps it's really one of the key reasons why, the PBOC, which told the markets back in December that they were going to move on rates, haven't just yet. They're looking at the timing. They will do that, they say, when the timing is right. Now, on perhaps more of certainty, is that a good way to describe this right now, on the trade conversation? So you have the White House saying this 25% levy on steel and aluminum will go into effect midnight their time, March 12th. That's the U.S. time, of course. That's as the Trump White House, or Donald Trump himself, backed off on this threat to impose 50% tariffs on Canadian metals. Let's bring in our Chief North Asia correspondent, Stephen Angle, joining us right now from Beijing with the latest here. Yeah, Steve, obviously multiple fronts here, Canada, Mexico, and China, Australia included. Why did you get us up to speed?
Yeah, no doubt that the Canada story is front and center now, but China is definitely watching the gyrations. And we'll talk a little bit about where the negotiations, or lack thereof, between China and the United States are going right now, when you kind of have a hard time figuring out what you're trying to mitigate, because the news flow changes almost by the hour. And that's what we saw overnight, essentially a roller coaster ride with Donald Trump essentially threatening doubling of those steel aluminum tariffs on.
सिल्वर का व्यू देख लेते हैं एक बार. देखो फॉरेक्स में देखोगे सिल्वर को, वैसे 6 PM का डेटा है मेरे अकॉर्डिंग, उससे पहले ट्रेड मत करो. Wait for the 6 PM data. After that you can trade, because 6 PM data is very important, which is CPI data. Right now, if you look at this in 15-minute time frame, सो मार्केट के पास जिस लेवल पे मार्केट है, रेजिस्टेंस ही है वो पूरा, दैट होल एरिया 33.40 तक, दैट इज़ अ होल रेजिस्टेंस एरिया. एक बार ऑलरेडी यहाँ से सेलिंग आ चुकी है. कब आई थी ये? 19 फरवरी को, फिर 20 फरवरी को, एंड देन ये थर्ड टाइम आया था कल 12 फरवरी को. अभी भी रेजिस्टेंस पर ही है पूरा जोन. मेजर रेजिस्टेंस है, ब्रेकआउट हुआ तो वेल एंड गुड, नहीं तो मेरे अकॉर्डिंग तो कुछ मूव नहीं करेगा. रेजिस्टेंस ब्रेकआउट जितने जल्दी तो नहीं होने वाला. नीचे लोअर एंड पे देखोगे मेजर सपोर्ट, तो मार्केट के पास एक रीटेस्ट ही पेंडिंग है शायद ना. हाँ, फॉरेक्स में मार्केट के पास एक रीटेस्ट पेंडिंग है. ये रेजिस्टेंस था वहां से. ठीक है, नीचे मार्केट के पास एक रीटेस्ट पेंडिंग है अराउंड 32.50 के अराउंड। तो ये दो लेवल है जिनको देख सकते हो फिलहाल 15 मिनट टाइम फ्रेम पे। ये पूरा रेजिस्टेंस जोन है, नीचे सपोर्ट रीटेस्ट जोन है। रेजिस्टेंस था, ब्रेकआउट हुआ है, तो इसका एक रीटेस्ट पेंडिंग है अभी। 6 PM का डेटा है, उसका ध्यान रखना इंपॉर्टेंट है।
Doesn't feel China's doing enough. Now, what we're hearing from sources is that the United States, or the White House in particular, has said, look, we've given our demands either directly or through even the U.S. ambassador in Washington, D.C., in notes to Chinese diplomats, essentially saying they want three things on the fentanyl issue. Some reasonable, some would claim to be a little bit outlandish. One, stop sending the precursor chemicals to Mexico. Well, that would indicate that China would have to admit that it is doing that. Secondly, use the death penalty for drug smugglers. We all know that China has one of the toughest drug anti-narcotics policies, and the death penalty is used for drug smuggling. But the third one is probably the one that gets the most attention and probably is the least likely, and that is, according to sources, the White House is asking China to essentially order a front page, full page, if not front page, article condemning essentially the fentanyl trade in the People's Daily, which is the Communist Party mouthpiece, the most senior Communist Party mouthpiece, which is usually dedicates the front page to the thoughts and policies of Xi Jinping. For China to do that would indicate that they are part of the problem. And everything that I've heard while I've been here the last 10 days, every official is essentially, including Wang Yi, the foreign minister, saying this is not a Chinese problem. This is a U.S. demand issue. And essentially, he had the sharpest words last Friday in his press conference saying the Trump administration on fentanyl has been two-faced, and that was maybe one of the more kind assessments that Wang Yi used.
Stephen Engel, our Chief North Asia correspondent in Beijing for us. In fact, later on in the show, we'll be taking a closer look really at Chinese media, really just to underscore the point with the narrative and how that's being framed onshore. Now, as we go into the open today, so we're about 20 minutes away, right? So yesterday was a really good reminder that while, you know, mainland investors and this wall of money coming through the Stock Connect is indeed, of course, a pillar of this rally, it won't be enough on some days. We turned negative on the southbound flows yesterday. Obviously, markets pulled back. We're likely to see a bounce today. And on top of that, where this market goes from here will really depend, Rebecca, and I think our colleague put out a really great column, a piece today on this, will really be the incremental money that will come in, hopefully, to this market.
Absolutely. And there's a really interesting comment here, note by Kinja Lau, who's at Goldman Sachs, of course, who we've spoken to in part about this, that the longevity of this bull run is also a function of to what extent global mutual fund mandates. And we have been having this debate, I think, with almost all of our market guests coming on, to what does it take to sustain this momentum? And I'm thinking back to that conversation we had with Winnie Wu of Bank of America, saying this could be that sort of 2016 Baba IPO moment, but the makeup of investors this time around is going to be very different. She anticipates that we aren't going to see US investors coming in and rushing back into Chinese capital markets. Instead, we're going to see global flows coming from elsewhere, including from Europe. But that this is the beginning of this sort of structural shift where investors are coming back. Long-term investors, foreign investors, will slowly start to come back into this market.
Yeah, and I think Citi made a good point yesterday where they're neutral in global equities, but within that, of course, they've upgraded China, downgraded the U.S., HSBC, who joined us yesterday as well. And while we talk about that, have a look at these flows, right? Harold van der Linden talked about how, from a global perspective, if you're a global equity fund, for example, flows are coming back into EM. For EM mandates, the question is really to what extent China prices out India and other of these markets. What's interesting that we had to look at ETF flows. I'll end on this very, very quickly. This does underscore a few points. It's been very concentrated, the rally, in Chinese internet. Excuse me, number one. We've seen outflows year to date for large caps and overall, so that tells you really what the concentration is. The S&P passive money is still there despite the recent weakness. So Yeah, this is an evolving story. We'll get to all of this, of course, later on in the show.
Yes, and to your point earlier, it is going to be a tech-heavy, it's going to be an auto-heavy show today. But elsewhere, coming up, we'll also be talking investment strategy next with LGT Private Banking Asia as US exceptionalism takes a hit. And later on in the China show, the CEOs of Hesai Technology, ECARX and ASUS will be giving us their business outlooks. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Good morning. You are watching The China Show.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Welcome back. You're watching The China Show. A lot of eyeballs have been focused in really on this U.S. market story. For a brief, I would say, couple of minutes overnight in the Tuesday session, it looked like the S&P would drop into a technical correction. Towards the end, we did see a bounce of the low. Still ended lower, though. So, it still could happen this week, really, just looking at how horrible the momentum looks on this U.S. market near term. We are seeing a bounce, though, as we speak right now on S&P futures and other contracts there as well. Let's bring in Stefan Hofer, MD and Chief Investment Strategist at LGT Private Banking Asia. Good morning.
Good morning.
What do you think is going on in the U.S.?
So I think, first of all, it's quite telling that President Trump actually has to already start to use the recession word and downplay that. But I think if you look really, really carefully on the hard economic data, discretionary spending, the labor market, corporate profits, and so on, I think we can still say that the U.S. is running at a very high level, and the hard economic data does not point to a recession. But we do have a problem in terms of sentiment. University of Michigan, Conference Board, all these kinds of very important indicators are clearly pointing to weaker sentiment. And at some point, sentiment spills over to the hard economy. So we really do need to see a circuit break to stop that from happening.
What does that circuit break look like?
Well, it's quite a grand wish list. A curtailing of the tariffs, walking back more on that front. Also, what could be very helpful would be progress on Ukraine, Russia, and of course the U.S. So a lot of geopolitical stuff, basically, at this point.
Could the Fed be that circuit breaker, you
feel? The Fed has a very huge challenge now because a lot of these policies that we're seeing, if they come through, will still point to inflation being relatively sticky for a longer period of time. And so therefore they're going to be curtailed in terms of how fast they can cut rates. President Trump has been very clear. He wants lower rates. The Fed may not be able to deliver that.
You mentioned tariffs. Is that the biggest issue on the horizon? And how do we think about tariffs against some of the other sort of resolution of geopolitical risk?
Absolutely.
Ukraine, US, minerals deal, ceasefire, etc.
I think what a lot of us did in financial markets, especially last year when it was very clear that the tariffs were going to be on the agenda, we all said it's a negotiating tactic. The bark will be worse than the bite. Now there's clearly some bite coming through, and it's very, very difficult to really estimate the rippling effect across global supply chains, how bad the pain will be for everybody else. Now, the thinking in Washington seems to be this is bad for us, the U.S., but it's worse for you, the rest of the world.
I want to ask about that bite, specifically in China. We've seen 20%, sort of cumulatively, that takes us between 30 and 40%. Were you surprised by the response from the MPC to that? It does seem like Beijing's perspective is that they can stomach that so far.
That's right. I think China has been well prepared for this and has acted, proportionately. That's less of an issue. It's more things like Canada, steel, aluminum, ditching of the trade deal that President Trump himself was instrumental in bringing, and I think it was in 2020. So it's more issues like that.
What do you feel strongly about in terms of just conviction costs right now amidst all of these things?
Well, I think, if you agree that Ukraine-Russia settlement is weeks or months away, then you're going to see a very, very strong peace dividend impact European asset values even more so than they have done already. So that will be helpful. You'll see further euro strength. And on top of that, we have to remember that Europe is in a very different position. The ECB is cutting rates, monetary aggregates are rising, credit growth is rising. That's a fantastic backdrop for equity values.
Right. Now, just a question. If we do get a ceasefire or something along those lines with Ukraine, do you think the market takes that as an excuse to take profits from this massive move up in defense stocks?
Absolutely. Some of them do look quite parabolic in terms of how they've gone up.
That's not vertical.
Exactly. I think the million-dollar question, and it has not really been addressed anywhere yet, is how do you put in a deal that secures Ukraine's security in the future? That's not been addressed. You can talk about ceasefires, you can talk about prisoner exchanges, all those kinds of things, but how do you put something permanent in place? If you get a permanent resolution to this horrible conflict, I think European values will go higher.
So along with these question marks that we've had over the US exceptionalism story, there is this line of argument that European growth is going to be the driver for global growth. To what extent do you buy that? And if you see that dynamic, when do you think that comes into play? Because as you say, it's going to need US sentiment to turn from sentiment into hard economic data.
Right. Well, Europe, taken by history, does move slower. Reforms happen at a slower pace. But every so often in history, there's a big moment. You may remember the Hartz IV labor reforms in Germany a long time ago. That was a big deal, and that really moved things forward a lot. Now, of course, Europe has to take its defense and security matters in its own hands. Hundreds of billions of euros being spent on that. Maybe we'll actually have a coalescing of Europe that we've been missing for a long time that will spur other reforms as well.
So if that's structural, what does it mean? Because, I mean, to your point, Europe every now and then has a bright spot.
That's right.
But for the most part, you look back, there's always a weak spot across the Eurozone economy. And I'm wondering whether this fiscal push is structural enough that, the market removes that premium, that it's almost calcified around that equity market.
Right. Well, I mean, in Germany's case, the removal of the debt brake and basically saying, you know what, it was great that we had a low debt-to-GDP number in the past, but we really have to do other things now. That's very monumental. That's substantial. That's real. And that will be a driving force. So I'm more on the side of saying, let's give them a little bit more time, but changes could be happening in Europe quite quickly.
Right. Very quickly. You like Europe, you like Japan. Yes. I don't see China on your list of conviction calls.
China is tactical for us. So January, the DeepSeek moment, that's very important. It is a game changer. But don't forget, the real estate market in China is still struggling overall. Until we see a change there, we'll move structural.
Fantastic to see it.
Thank you.
Stefan Hofer there, MD and Chief Investment Strategist at LJT Private Banking Asia. Right, going into the open today, just under, what are we doing, 7 minutes away here. Hang Seng Index, A50 futures, the 10-year yield is now, there we go, we're closing in again on 1.9% handle. But there we go, we're looking at a bounce here today. This is Bloomberg. Okay, hump day session is just ahead. Hopefully for the bulls, that hump was yesterday, and we are past that sort of pain point across these markets. As pertains to China, though, we are likely going to see, as you can see, a bounce here going into the open today. To what extent, though, will we see that? Because, the massive net buying turned to net selling into the end there, across the stock connect.
Yeah, that's right. And we sort of started off our day wondering and asking the question, and in fact seeing that southbound investors were going to buy the dip. So
they were?
Yeah, slightly caught us by unawares. I think going into that afternoon session, that was a sort of expectation.
Yeah, there we go. A couple of analyst actions before we talk about some of the big moves individually here. So HSBC's out. In fact, Morgan Stanley and Goldman Sachs separately have also put out some changes on their end, but we only have space for three. So here are the three. MS, Win Macau, price target on your screens, cut to equal weight. Shini Solar and Wuxi Aptech separately at HSBC rated new buy at those specific price targets. Those are 12-month price targets for those stocks?
Yeah, elsewhere, I mean, tech's still very much in focus for us today and, in fact, for the market as well. Taking a look at Alibaba, we did have this report from the Securities Times that the cloud platform Q1 is going to be cooperating with this new news, rather, of a Chinese AI startup, Manus, on some of its open source models. And, of course, we do have this summit coming up on Thursday. This is Alibaba and Huawei.
Yeah, looking forward to that. Mark your calendars. Now, it's a conference hosted by Hangzhou government. There we go.
Yep.
Come through on Thursday. EVs in focus here. So these really led the gains overnight, right? Up double digits for NIO and also XPeng. So more on this in a moment. The open is just ahead. This is the China Show. Good morning.
Good morning and welcome back. You're watching The China Show. We're counting down to the open of markets and really wondering, question mark, whether or not we start to see a little bit of a bounce back. We had 3 sessions of losses in Hong Kong, stocks in Hong Kong, Chinese stocks in Hong Kong, that is, and a little bit of a recovery perhaps in the works today, Dave.
Yeah, we're looking at that question. What I've been wondering, and this is completely random right now, and, you don't want to get in my head, but I mean, just to share that because we're here, I wonder if stalking is stalking when it's done on LinkedIn. Anyway, it's not important, but every now and then you get a list of people who check your profile out, and I'm wondering why we have a different standard for LinkedIn than we do for other social media. But again, that's I guess we're opening up a different can of worms there. The open, speaking of, in mainland markets, 0.2% on the Shanghai comp to the upside. The big news this week across these markets, when you look at mainland, though, is really, well, number one, on the currency, and we'll see how CNY adjusts to this move up in CNH. CNH is at a 4-month high. The other thing I want to point out is that, this move up across the bond curve, we're now flatter, in fact, because the short end lead that melt up, the long end is just catching up as well. And we have a massive bond auction on Friday. In fact, the most ever. The finance ministry said that it is planning to sell, get this, $23 billion equivalent of 2-year government bonds on Friday. That's the largest offering ever of that tenor in a single auction based on the data that we compute. Just mark your calendars now and see what demand likely looks like as far as that is concerned. The Hong Kong Open is looking like this. And we are expecting and we are getting a bounce at the open led by tech, again, 1.4% on the HS Tech Index. MSCI China's up 1%. The question right now is what will the next catalyst be, and who will the buyers of that catalyst then be that next leads this rally to the upside? We have a piece on that which we'll sort of unpack for you in just a couple of moments here. 8 shares are up 0.7%. Baba is up about 2.4. We were up by much more than that earlier on. We're looking at southbound flows, which turned negative, which was a rarity, but it happens about once every 1.5, 2 weeks. From the DeepSeek moment about 8 weeks back. We'll see what that looks like today. Right, earnings. Cathay Pacific, Samsonite, and Wharf are coming out with earnings today, and the next page is about to show you some changes to analyst ratings. We talked about this earlier on. The reaction or lack of it is coming up on your screens. As you can see, so Advanced Microfab raised to buy at Goldman Sachs. Price target there at 275. Wuxi AppTech, HSBC, price target 8250. Win Macau, price target at Morgan Stanley, 5.5 Hong Kong dollars. And Shini Solar, HSBC, price target 4.4. We got through a lot there, didn't we?
It was a relative tour de force there, those actions. But now time for a look at some of the headlines that we are watching in Chinese official media. We chatted a little bit about this earlier, but the reaction essentially to what's going on in the US economy, what's going on in the Chinese economy. And as we saw the 2 sessions wrapping up in Beijing, state news outlets are out with commentary touting the economic strength and resilience. Xinhua, for example, listing the reasons that the, quote, economy deserves your confidence, including China's institutional advantages, effective governance, vast space for further growth, innovation and reform. And of course, this story about confidence is absolutely critical when it comes to the consumption focus that the MPC has laid out?
Yeah, I mean, of all the major economies out there, I think you can come up with the longest list in China of economic levers. But really, what is the most attuned to confidence? It's just very hard to measure. Yeah. But once it turns, it starts to turn, and everything else starts to look great, right? In the meantime, though, to Rebecca's point, state media also spotlighting the bullish calls in Chinese stocks. We talked about this yesterday, that move out of Citi, upgrading Chinese equities on its front page story here on the Securities Times, which also, by the way, cites optimistic views from other foreign institutional investors. And the paper draws a contrast with the U.S. stock market, quoting mainland analysts who say that recent declines there are becoming a trend and are no longer just transient.
And after this stellar climb in Chinese equities that have really caught the attention of state media there, strategists also believe that a longer-lasting stock rally depends on a meaningful return of global funds. We're joined by Bloomberg's Asia stocks reporter John Cheng now. I mean, John, tell us firstly, why haven't we seen long-only funds joining this rally?
So if we look at the buyers of this 20% or so rally in Chinese stocks this year, of course, one major support would be southbound traders from mainland. Actually, just earlier this week, southbound trading turnover in Hong Kong was at a record. And of course, there's also a strong influx of foreign flows from passive money, and also a jiggling of Asian and emerging markets portfolio, from rotating from former outperformers like India, like Japan. But a huge missing piece in the puzzle would be the return of global long-only funds. And in fact, in the first 2 months of this year, even as we saw a huge rally in Chinese stocks, they were actually net sellers of Chinese shares. And I think eventually that is because of their fundamental pessimistic outlook of the Chinese economy. And after so much trouble has been going on in the past few years, I think these long-only investors, meaning they will be adopting a more cautious view on the Chinese economy, and they really need to see more evidence of that side of things turning around before they can have a bit more conviction in the market. And that is the key thing to bolstering a more long-lasting rally in Chinese stocks.
Yeah, I mean, John, to your point, we've seen rallies of this sort, maybe not to this extent, but we've seen rallies of about 20-25%. And the question we've always been pondering with, as is this time any different? And I guess let me add to that question though to you. And what would make this time different in the view of those investors who have yet to be convinced?
So, like I said, I think one key thing is the solid evidence of a turnaround in the economy. Of course, the messaging from the MPC this week and last week we saw were very positive. There's a huge focus on boosting domestic consumption. And if we look at some of the property market data, they're actually showing incremental improvement. So all of that need to come together, and we need to see a more consistent slew of improving economic data in order for those long-only funds to be a bit more positive on the market. But of course, I would say the argument and the investment case for Chinese stocks is becoming more compelling now than ever, because of course we have the technological advancement in DeepSeek and other AI models, and that's driving a fundamental repricing of China's investability, at least on the tech front. And of course, we see the retreat of the U.S. exceptionalism trade, and that means global capital will have to find a more attractive investment opportunities elsewhere. And where would they go? Of course, China would be a very sensible option, because the aggregate exposure to Chinese stocks is still at historical lows. And for example, like markets like US, like Japan, they're already very crowded. So that means global capital will have a lot of potential room to add back to China. And therefore, we'll just have to give it a few more months and see if that will materialize.
These two sort of consecutive factors, the idea of needing to see the hard data, but also, of course, this enthusiasm around DeepSeek. Thank you so much for joining us. That was Bloomberg's Asia stocks reporter, John Cheng there. And coming up, the co-founder and CEO of Hesai Technology will be with us to talk about their latest earnings and the impact of US tariffs on the self-driving industry. That interview is coming up next, so stay with us. This is Bloomberg. Good morning and welcome back to the China Show. Now, a name in focus, US-listed shares of China's LiDAR maker Hesai Group jumped as much as 50% overnight after Reuters reported its partnership with Mercedes-Benz. David Li is the co-founder and CEO of Hesai Technology. He joins us now from Boston. David, I have to start with the obvious question. In your earnings, you touted this potential partnership with a top European OEM. Is that OEM Mercedes?
I won't be able to give further comment. We did mention that we secured a new deal with a top European OEM with a multi-year ICE and EV platform. And it's one of the biggest one we received, and we are super excited about it. But unfortunately, I won't be able to give you further details on the OEM's names.
Not even the first letter of the name, David? I'm kidding. Okay, well, I know you can't. One of the okay. We'll take our chances with that. Okay. Well, in due time, let's put it that way. Could you at least help us quantify what this means in terms of growth for your business? How much potential future revenue do you think you might be able to realize from this? And congratulations, by the way, on this deal.
Thank you. Without the specific numbers, I think we should step out and think about the bigger picture. I think the bigger picture here is we are truly seeing the democratization of such a product for safety for all the automobiles. It's definitely not only self-driving cars. We're talking about the invisible airbag to be having the chance to be on every vehicle. And we're talking about globally, that's like 100 million, close to 100 million vehicles a year. And then we did that by really innovating on the integrated circuit and the manufacturing integrated components. And we brought down the cost from really high to $200. That range, and that's like 99.5% down. And that's why we're able to further advance and bring that to more vehicles. And of course, when we do that, we not only do that in China, we also do that with global partners. And we started with China because China was earlier in adoption of LiDARs and the EV, and we work with 9 out of the top 10 China OEMs by the market cap. And then globally, now we work with 6 out of the top 10 global OEMs or their JVs in China. So for us, that is taking to the next level that we spent years of developing the core components and such a product. Now we're seeing that we've been revenue number 1 globally for the past 4 years, and we more than double our units every year for the past 4 years. Now we're looking to do 1.2 to 1.5 million units this year without sacrificing the margin. We stabilize our margin roughly at 40%.
Okay, so if you've stabilized margin, you've brought your costs down. How are you thinking, and how is that affecting your production targets, not just for this year, but the following years? Because, of course, it's also been about this question of forward planning for you folks. And that's reflected, for example, in the CapEx spend that you had 2 years ago. It's now paying off this year. So I just want to get a sense of what does this mean for 2026, 2027?
Yeah, spot on this comment. The fact that the nature of such a business that everything is in like used to be 7-year cycle. Now in China, it's like 18 months to 2-year cycle, which means that everything we're shipping this year in large volume was largely designed by the R&D effort about 2 years ago. Same with CapEx and everything. So that's why we were investing heavily and we're taking a loss for the first almost 10 years. Now start to pay off, and then you suddenly see that our profitability is significantly improved because the top line keeps growing, right? Our volume of shipments more than doubles every year, while the R&D expense also stabilized because we don't need to keep inventing new products. We already have the great product we developed from 2 years ago.
Right. Now, just to follow up on Rebecca's question, and I think to the first point, we were talking about your new customer and partner in Europe. Are you looking to increase production capacity? I'll ask you directly. In Europe, for example, to cater to those, say, customers who might be concerned about tariffs or geopolitics, and if you are looking to increase capacity outside China, production capacity, how much and by when do you look to increase that by?
It's unlikely that we'll do it in Europe, but we are open to expand our production outside China. We don't have concrete information to share now, but it is one of the options we definitely are heavily looking into. I also want to take a moment to comment on the tariff because people care about the product we ship outside China today. And I'll give you a few numbers. The first is that today, actually, the product we ship to the US is less than 10% of our revenue. And the other interesting number is that because we always had tariffs, it used to be 25, now it's going up, right? But if I want you to think about the nature of such a behavior, tariff by its nature is to balance trade by adding to the price. Of course, it will make our price more expensive. But then people worry about it, assuming that we're competing on price. People assume that American people buy our LiDAR because we're cheaper. That's actually not the case. If you look at historical data on the robotaxi, our product's actually more expensive ones. So now the question is, if we're more expensive, why do people buy Chinese product at all, right? Well, the reason is the safety parts, right? You need the best quality and best performance. And we have that. So if you think about that argument, when US slaps tariff on us, who is end up paying for it? Do people really buy the American alternative because we're more expensive, or people still have to stick to the best quality product as we are shipping today? I tend to argue that for safety part like this, tariff in the end is transferred to America without having the intended consequence that it was intending for.
Okay, so if those tariff risks when it comes to pricing are manageable for your business, what are some of the other real-world problems or real-world challenges that you're facing when it comes to these increasing geopolitical tensions, when it comes to tariffs? I'm thinking about issues, for example, with your supply chain, with potentially with production, with parts, and the visibility over that supply chain too.
We have full transparency as a hardware company, right? We are always very open to the OEMs when we offer our products to them because that's part of the process. They really need to be careful knowing each of the components, and we have always been very cooperative on that. On top of that, I think it's not about the components, it's about how people use this product. One of the, I would say, the elephant in the room is that a lot of people have misconception that, LiDAR scans 3D world, does that mean it has in possession of data, right? The answer is actually no. Sometimes I tell people we build this dumb hardware, meaning that even though it's used for intelligent driving, we really don't have the capability to transfer data wirelessly or Bluetooth or anything, or even store data for more than a second. So it's really a device that has no capability of touching data or invading in privacy for that regard.
David, this is a good point to ask because you were added to the Department of Defense list of Chinese firms with alleged link to the military. Correct me if I'm wrong here. You then sued, and the DoD briefly removed you and then re-added you back to that list. Just give us the latest status and whether or not this, this designation has actually affected your business at all.
It's first, you're right. The facts are right. And we were added and removed and then added. It is ongoing litigation, so I won't be able to share more details on the litigation front. But I do want to make 2 points, right? One is that it's a strictly civilian product. It's designed for civilian use. And LiDAR, by its nature, it's a 3D scan device. But the product LiDAR we build is far from the specs that military needs. So there's no way that military can use that in the battlefield or anything. So we really just build a civilian product like computers, like cell phones, like things like that. And we're certified by the Department of Commerce in the US, the EAR 99, to be civilian. Having said that, it does have an impact. To me, it's really the reputation because it accused us of being involved in the military, the military civil fusion. And the truth is that we were never part of any military effort or engagement or technology or product. And then that we've been telling our customers and the investors, everybody, that it is the case that we're transparent, we're honest. But then when we're on the list, it damages our reputation. And that is actually for us is a huge hit on the reputation and the integrity. That's why we have to clarify that. Not because we think we would just sell our LiDARs to Pentagon, which is on the surface that what it was about. It was not about that. It was about that we build an honest, transparent company, and we want people to know that we stand by our principles.
Let's focus in on the technology itself, and you are, to your point, the world leader here. Where do you see? I mean, I have a couple of questions here, so I'm wondering if you could hit on them. So you mentioned democratization of the technology. Does that mean the product gets cheaper cost per unit, say, moving longer term. That's number one. Number two is, as more OEMs adopt this, and I think you used a very important phrase earlier on, right? This is an invisible airbag, right? Will we need airbags in the future inside vehicles if everyone else uses this? That's, I guess, another question there.
Sure, great question. Well, first is that it is about a cost if you want to put that on every vehicle, right? It used to cost, tens of thousands of dollars, and no one can really put it on their passenger vehicle. Today, now we're building things at a $200 level. It makes it possible. And think about it, it's a pretty good investment if you buy a car and you know that it can stop the car if there's a potential crash. And then so $200, your kids and wife might be in the car. So both people think it's a great investment. I definitely agree with it. And your second question, sorry, what was the second question?
Well, the second question is if it works
did that correct
well
right?
enough.
So, that's right.
Yes, yeah. Do you need the airbag inside?
So now I put on my scientist hat. So anything still could happen. We're just talking about a reduced probability, which means that camera will fail, LiDARs could step in. LiDAR still has a chance to fail, so it would never be zero. But we're looking at a significant reduction on the crash rate for fatal crashes. That's the number we have, especially we've already shipped close to 1 billion units now. A lot of them are on the road, saving lives, and we look at the results and we know it's effective. So that is fast, but it's never zero.
David Lee, fantastic. We could be here all day. Rebecca and I always joke that when it comes to a technology conversation, we tend to geek out. Thank you so much for the time. Let's talk again. David Lee, co-founder and CEO of Hesai Technology. We could use a tech show. Anyway, speaking of, the co-CEO of ASUS is coming on. Biggest decliner across the region today. This is an earnings story, so we'll try and help you guys understand really what the company looks like and the outlook there. So do join us, of course, next hour for that one.
Yes, and also coming up in the next hour, of course, we also have an exclusive conversation with eCar ex-chairman and CEO Ziyu Shen, as well as that conversation with ASUS as well. We'll be talking with ASUS about their business outlook amid all of the tariff talks and hype around AI. Good morning. This is the China Show. You're watching Bloomberg.
Right, welcome back. Just an update here of these markets. Coming up on your screens, casino stocks. We're looking at that very, very closely today. You have, of course, this downgrade. This cut, this is on Morgan Stanley. This is specifically on Wynn Macau. And this really comes down to the market share outlook. So we're down 2.7 in that, and as you can see, that's permeating slightly across the entire, to varying degrees there, at the very least, on this group. Right, we're looking at Chinese benchmarks about 25 minutes into the session, and you know what? We're looking mixed. Unimpressive, uninspired. 23.8 right now on the Hang Seng Index. We're down a little bit right now on the CSI. Although things are looking a lot more encouraging today than they did, of course, yesterday.
Yeah, a little friendlier than how we opened the day yesterday. We've had three sessions of losses, of course, now for stocks in Hong Kong.
There we go. Yeah, so there's potential for this story to turn sour, I think is what Rebecca is indirectly
I don't want to be a pessimistic penny, but, anything's possible at this point.
The morning is young. Plenty more ahead on The China Show. Right, good morning. If you're just joining us right now, we just are going into the first 30 minutes of trade, second hour of the program. We are getting a bounce today, although not a very convincing one, I think, if you look at volume so far. But, I mean, that being said, we are coming off quite a bad day, of course, and against the backdrop, really, of a U.S. equity market that doesn't seem to be, you got a bounce, but momentum there doesn't seem to be convincing as well. Hang Seng China is up 0.4%. We're up 0.2, as you can see on your screens there on the HSI. A very brief look, and as we flip the page, let me just leave you with a thought on market breadth.
we're doing very good on breadth. Actually, no, I'll take that back. Most are actually down, very slight majority. To the downside, you have Wharf Real Estate. That is a company reporting today. Right. Some bright spots on your screens. You have, of course, all the news out of Alibaba. And, of course, you have this conference that is this AI summit that is being reported set to take place in Hangzhou. And Alibaba and Huawei are set to be attendees to that one.
Yes. Yeah. And the collaboration between Manus and Alibaba, QN.
QN, yes, yeah. Absolutely. Okay, so the other story on the macro front as well that we're tracking here is, so we've talked about this melt-up in yields in China. We're not really seeing that today, but we are seeing that in Japan. And again, this is a reminder that the BOJ is coming through next week. We've been looking at various superlatives really on almost a regular cadence here. And I think today is a 30-year yield effectively hitting the highest. There we go. Going back, let's call it 20 years, right? 2.6% on the Japanese 30-year yield, which, by the way, in case you missed it, is now about 60 basis points above where you are in a Chinese 30-year equivalent there. Right. Very, very quickly, the mood music across Asia-Pacific is a good one. S&P futures are bouncing 0.3 to 1%. Most of this market is up, with the exception of a few weak spots like Australia, and really it might be down to the tariff conversation. That market actually is also very near a technical correction, as with the S&P 500. Let's get a sense right now of market direction these next 24 hours or so. Mark Cranfield joins us from Singapore, our MLive, out of our MLive team, our MLive strategies. Mark, yeah, so... Well, how long can this U.S. Let's start with the U.S. and then we'll talk about China in a moment. How long do you think this U.S. bounce can last?
Probably before the end of your program, it'll be all over. I mean, seriously, it looks like a bit of a dead cat type variety. Donald Trump seems to be digging in for a long haul on tariff wars, and investors are very wary about it. They're very spooked by the idea that there's no end in sight. I mean, that's really the danger here for investors in the United US markets, is they can see the correlation between the longer the trade wars go on, consumer confidence crashes further. That's impacting on people's spending habits in the United States. That also means they're sticking away from the equity market. So you've got this vicious circle, and there's no obvious end in sight to it. And that is really going to dent confidence in people wanting to invest in the US market. So any bounces from here, most likely, the serious investors will be looking as an opportunity to sell stocks into any mini rally that you see in the US, particularly when you have a much more encouraging story taking place somewhere else in the world, which is either Europe or China. We get to that in a minute. What is happening in the US, it's almost as though they're goading the Fed into doing an early interest rate cut. And for now, the Fed is holding back and they're saying we're happy where we are, we want more time. And yet the market continues to price for more and more Fed interest rate cuts. That kind of standoff eventually will break when the unemployment rate increases and the Fed will have no choice. But it's a very messy scenario. There is no long-term investor who will look at that and say, yes, I want to throw loads of money to the United States. The picture is just too cloudy and uncertain. Better to stay on the sidelines, or even better, shift your money to some part of the world that looks much more exciting, China or Europe.
Okay, Mark, I want to pick up on that point. Yeah, I mean, do you think we're going to start seeing investors throwing loads of money that they used to be throwing at the US now at China? And are we going to see this sustained momentum? I guess that's the fundamental question.
You can see some of the momentum already. You can see where it's going. Look at the euro exchange rate. That move in the euro against the US dollar, part of that will be money coming out of the United States going into Europe. It's also a story about Europe boosting its defences and that kind of a defence story there. But then also look at China. The currency is pretty stable at the moment. And you can see through the flows that are coming into Hong Kong that clearly money is moving into this part of the world. And a lot of that is fresh money. I mean, the flows that you've seen coming out of mainland China into Hong Kong have been very solid. Happened to be an outflow yesterday, which is pretty encouraging. If you think the decoupling story between China and the US has legs, actually yesterday was a pretty good day for you, because Chinese tech stocks managed to end higher yesterday, even though there were net outflows after several days of inflows. And Bloomberg is running a story that says that the tariff talks between the United States and China are stalled at low levels. So that means it's not even been pushed up to the senior people that make decisions. That's actually a good thing if you're a Chinese investor, because it means the pressure on Chinese authorities to continue stimulus, to continue supporting the markets is very high. They can't back away. That means that it looks as though the US-China situation in terms of trade tariffs will go on for a long time. Chinese authorities have got to keep on doing what they are. And you talk about this AI conference, which is going to happen in China this week as well. That's all very positive. You believe there are legs to the China AI story. Everything is moving in your direction. And anecdotally, I've spoken to senior fund managers around Asia. Money is definitely going into specific AI-related stocks, and it's pretty sizable amounts. And there's probably more to come as well, because this is the early stages of it. So yes, it looks as though decoupling between China and US really is a theme that's going to run for a while.
Yeah, I think, Mark, you make a good point, or a few good points there on the resiliency of these Chinese markets, right? Simply on the dry powder argument, that's bullish already. Add to that the news flow hasn't all been that positive yet on the economy and geopolitics, right? So that's a resilient story in China. I want to ask you, though, about the resilience of the rally in Europe specifically. And we put this question to our guest this time the last hour, that if we do get a ceasefire, say, in Ukraine, might the markets take that news and take profits of this massive rally that's taking place in European defense stocks?
You may get a knee-jerk reaction, but the underlying story is much, much deeper. If Europe is really going to upgrade its defense systems across the board, we're not talking just about Germany, we're talking about France, Italy, the UK. Although UK might not be part of the EU, it still factors into the whole equation. The whole of Europe needs a major upgrade, huge spending, going from a very low base to a slightly higher base, but still very, very big numbers and over an extended period of time. That's not all going to play out just in a matter of 1 or 2 weeks. That's a story for a few years. That will all underpin Europe. Plus the fact that investors will get used to the idea that Europe is waking up. It has to do more for itself. Look at its own AI story in Europe is also very weak. They need to find their own champions. They need to make investments to produce European-driven AI narratives. They can't rely on the US anymore. They're already starting to push back against Elon Musk's Starlink plan, which he was going to introduce Starlink to Europe. They're already moving back on that because they don't really think it's a great idea to have somebody control it from outside the region, which makes a lot of sense. They need their own AI products, and that's a big investment as well. So the European story is really only at the beginning, a bit like the Chinese tech story as well. These two could run for a long time.
Yeah. Okay. Well, Mark, thank you so much for that. Mark Cranfield there, our MLI strategist in Singapore. I just stumbled there because I just saw you're at 109. Okay, I missed that. I knew we were at 108. Let's pick up on that. That story that we just ended with Mark on there on Ukraine. And Ukraine has accepted a U.S. proposal for a 30-day truce with Russia as part of a deal here to lift the freeze on military aid and intelligence. Now, Washington will now take the deal to Moscow.
Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. But I think the ceasefire is very important. If we can get Russia to do it, that'll be great.
Let's bring in John Herskovitz, our East Asia government editor, to talk us through the implications of this. Yeah, and John, so we heard from the president there, U.S. president, that they've now agreed and he now takes that to the Russians to have a look at that. Where does this proposal, the ceasefire proposal, leave Vladimir Putin?
Yeah, it seems like the U.S. and others are saying that the ball is in Putin's court now. So we're supposed to have talks today with U.S. officials and Russian officials. There's also the possibility that Trump will speak with Putin later this week. But it's up to Putin to decide where to go from here. Bloomberg reported earlier this week, speaking with Western intelligence officials, that Putin was probably going to seek some maximalist demands, which are not going to be amenable to Ukraine or Europe. And some of the things that he's looking for are no European peacekeepers on the ground if there is a peace deal coming forward. He wants to see the territory that Russia has seized remain in Russian control. He wants Ukraine to abandon any aspirations of joining NATO. And he's also called for fresh presidential elections. So we'll see where Putin is going to go, but the expectations are that he's going to demand quite a bit and this is not going to be acceptable to major parties, Ukraine and European allies.
John, can you also break down some of the nuts and bolts of what's actually in this proposal?
Sure. I mean, some of the things are prisoner exchanges. Ukraine is trying to get return of some of the children who have been taken into Russia. It's seeking an end to aerial assaults, missiles, drones, that sort of thing. As a part of the aside, the U.S. is hoping that this will further on its minerals deal with Ukraine. And also the main thing for this is that Ukraine sees an end of the freeze on aid and intelligence sharing that it had with the U.S. So these are some of the things that are in the deal specifically and indirectly, which are part of this agreement for the 30-day ceasefire.
Okay, thank you so much. That's Bloomberg's East Asia Government Editor, John Herskovits, joining us. And up next, we have ECARX Chairman and CEO joining us to talk earnings and the outlook for driver assist technology. Plus, we'll also hear from the co-CEO of ASUS on AI and how they're positioning to deal with Trump's tariffs. Those exclusive conversations are both coming up ahead on the China Show this morning.
Right, welcome back. We're continuing our theme here on earnings, tech, autos, everything in between, an intersection between those key themes here. You have Geely-backed auto tech firm ECARX has trimmed its full-year net loss by 3%, while, as you can see, revenue's up close to 20%, total shipments up a third to 2 million, plus including, let me just also mention, a parts to the earnings statement. This continued repurchase program announced late last year underscores the optimism around their commitment to also return money there to their shareholders. Let's talk about all of that. And joining us exclusively is the chairman and CEO of the NASDAQ-listed company, of course, Ziyu Shen. Well, thank you for, again, taking the time. It's nice to speak with you. I think last time we spoke was, back in August. So it's been a while. Before we look forward, what this year is likely going to look like for you guys, I want to just take a step back and look at what happened with the earnings that's come through. What, in your view, was the main highlight from the past year, and what didn't go according to plan?
I think the past year, the most important for us that we got the break even in quarter 4, 2024. And we starting the very good health, financial status for the company. And also, I think in this year, also we have strong confidence for break even, and we to make the health financing status and to achieve more and more global opportunity with global OEM. That's our very important strategy.
Okay, and so thinking about looking forward, are you looking to increase your output? And if you need to do that in 2025 or perhaps it's 2026, how quickly do you have the capabilities to do that?
We have the quick capability to do that because we still invest huge on the R&D side. Also, we are forwarding the global business expansion as well. Also, last year, also we win the global deal with the global OEM, Volkswagen. So that's why we quite confident our revenue growth every year to year, and also our the profitability capability in 2025 as well and the future. So that's we're quite confident.
Yeah, I remember one of the things you mentioned when we spoke to you last in August was, for a company like yourself, the path to become a global player is to really strike deals with global OEMs. There's no other way around that. And you mentioned VW. Congratulations on that, by the way. Can you give us an idea of potentially the other car makers OEMs that you might be speaking with? How do you intend to grow your business from the top line?
Yeah, actually, we already had a very significant and robust technology and product. So we start up from China, and China is the most important and critical market right now. So right now we have confidence to starting service to global OEM. That's our advantage. because in the past 5 years, we spent a huge R&D investment in this area. Our product, including Antora platform and our software Cloud Peak, is very robust software, robotic products. So that's very useful and helpful for global OEM product strengths, So that's why after Volkswagen, of course, we will going forward to other European and US and Japanese OEMs to make their product to be upgraded, more intelligent. That's our very important mission and vision on that.
Just thinking about the Chinese market here, I know you spoke with a colleague of mine, Lyndon Liu, not that long ago about some of the sort of fierce pricing competition that we see in the Chinese market and the pressure that some of your customers were putting on you to cut prices. I wonder if you can give us your perspective on how you expect those pricing trends to change through 2025. Do you still expect that to be a challenging area for you? And what can you do? What ability do you have to respond?
Okay, you are talking about very tough question here. Yes, that's very strong competition in China. And the pricing challenge and pressure is huge. But we still got very significant achievements last year. Our gross margin in 2024, still 20% gross margin. That's very important because we spent R&D and innovation on our product to support this kind of competition in China. So that's why in 2025, I believe this trend still will keep working, even in 2026, but no problem for our side because we still innovation and technology on our product can support this kind of competition. We like that. And then we can leverage these for our global OEM and global market competition.
Okay, understood. So give me a sense of how much you plan to spend on R&D, say this year, for example, and whether or not you think spending on R&D will get in the way of your other goal of breaking even.
Okay. So that's also a good question. So our company already keeping like 14%, 15% R&D investment. I mean, 14%, 15% of revenue whole year for investment for R&D already for 3 years already. So this year we still will keeping like 12% of revenue on that. But actually, our revenue year to year grows 30% already 3 years. So that means we still continue to invest R&D year and year. So that's why we confidence our competition of our product and the innovation and technology and strengths our vertical integration capability from hardware and software system, including semiconductor as well.
Okay, can I ask you then about that? That's an interesting statistic you bring up, 30% revenue growth. I just had to look at some of the estimates that analysts have for your revenues this year, 7.5 billion renminbi, and then 9.6 billion renminbi the year after that. So that actually works out to 30% growth this year and next year. Do you think you'll be able to continue that pace of growth, 30%, 30%?
Okay, this year maybe not keep 30%, like that's very high growth because I made a decision let break even in this year as the top priority and the revenue growth as to be the second priority. So because, break even is most important for the company to go forward the global supply chain and the global OEM partnership. Because you have to get very healthy financial status, including cash flow, to secure, future supply chain with global OEMs. So that's why this year break even is the top priority. And still huge investment on R&D is priority. But the growth of revenue is the second priority for me.
Yeah, I mean, digging a little bit deeper into some of those global ambitions that you have, autos have obviously found themselves, one of the key sectors when it comes to tariffs. I'm not just thinking about the US, but really Europe, Canada, and so on. And semiconductors, of course, have also found themselves as being really caught in the crosshairs when it comes to US-China tensions. So I want to ask, what is the biggest challenge or the biggest pain point for you and for ECARX when you think about that global expansion, and how do you respond?
Yeah, so because ECARX already being international company, we already set up the global R&D network. So in China, for China, we're strong here because we start from here. Also, we invest like European R&D 5 years ago. We made like smart car and the Volvo car and the Lotus operating. Also, we got a Volkswagen deal last year. So our global R&D is stronger and stronger every year right now. So that's why global R&D, global supply chain, we are investing now can support future U.S. and the Euro and the Western market. That's my very part of my team. We already built up international coverage, including supply chain and R&D on that.
Okay, excellent to have you. Thank you so much for joining us. That's Ziyu Shen, Chairman and CEO of ECARX. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during the live show. Go check it out at TV Go. There's plenty more ahead. Stay with us. You're watching The China Show. Good morning. Welcome back. Here are some of the top political stories that we are watching. House Republicans have passed a legislation to keep the U.S. government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If it fails, a shorter-term stopgap may be tried later in the week. If a shutdown does occur on Saturday, the White House Budget Office would decide which federal workers are furloughed and which essential staff must continue without pay. The world's biggest climate alliance for banks is said to be considering changing a revised strategy for members. A source says the Net Zero Banking Alliance will be handed a proposal that would remove the requirement for members to align their portfolios with a 1.5 degrees Celsius global warming limit. Members would be given the flexibility to adapt their targets to their local markets.
Okay, as we go into the Japanese lunch break, there's some movers to tell you about here. Japanese banks, we'll start with that, but there's some big news on Toyota, and that's your tease of the day. So we're looking at the banking system here on the up, as you can see. So number one, yields are up. There's a BOJ next week. That perhaps goes into this bullish call from Morgan Stanley as pertains to this specific group, right? So that's point number one. And don't worry, we'll talk more about this as we go into the BOJ next week. Right, on Toyota, ask it, and sometimes they'll give it, right? So it looks like Toyota will now grant the full amount of demands coming out of labor union spring wage negotiations. And is it playing out across the stock? No, it's not. But it's good news as well, of course, if you ask for that pay rise. Plenty more ahead. This is Bloomberg. Right, welcome back. Going into the Japanese lunch break, and is the weather all the same just about across the Pacific? Well, it's a small sample size because I've only had a look at Hong Kong. Tokyo, though, does look like Hong Kong today. Bit on the misty side. No rain, though, I believe, here in Hong Kong, although it looks like it outside. In Japan, it looks like it's a bit wet there and humid. Going into the Japanese lunch break, we're up on the markets themselves. We talked about Toyota, and they are ready to grant, of course, the full ask out of the spring wage conversations. Dollar yen, and the story there, of course, is this melt up in yields we're seeing on the 30-year highest level there in 20 years over in Japan. Asia, outside of Japan, across sector groups, most are higher. Thank you so much for that zoom in. The dollar is coming back on a stronger footing, though. And again, we've been, after flirting with entering a technical correction on the S&P, we're now back to the 5,600 level, which, if I could just borrow the phrase that our colleague Mark Cranfield used to describe this bounce today, looks like a dead cat bounce going, just given the dynamics so far. This interplay between the White House, the tough rhetoric there, and of course what the markets want to hear, which is eventually for maybe that conversation to go away and not have an impact on the economy.
Yeah, that's right. All right. Well,
earnings.
Thinking about geopolitics, but also about earnings.
Yeah.
Company in focus today for us, ASUS. We're looking at the shares of this company after it reported a profit that missed analyst estimates. Revenue for the year beat expectations, though. Joining us exclusively now is S.Y. Hsu, co-CEO CEO of ASUS. SY, thank you so much for joining us this morning. Maybe first to begin, just lay out what were some of the highlights from earnings and also some of the places where you didn't meet expectations or things went slightly amiss.
Okay, no problem. I just finished the investors conference yesterday, so I can provide you more detailed information. I think this year Q4, actually we deliver relatively good performance, but with some accident. The small accident, but big in the number. Actually, we have the outstanding receivable. The number is 5-point-something billion NT dollar. But besides this, actually, we have our business operation still quite good. In our system business unit, actually, our PC business growth in this year Q4, the YOY is 20 to 25%. The major contribution is from our AI PC and our gaming PC. For AI PC, the year 24 is the first year of the Copilot Plus PC because we are the first mover and we provide most complete product line. So we achieve over 25% of the Copilot Plus PC market share. And for the gaming PC, actually in the last year, second half, we achieved over 30% of the market share. I think this is a very good performance. And about our open platform business, our motherboard also have the 20 to 25% year-to-year growth in the revenue in the last year Q4. And also our motherboard product and our graphic product still maintain the #1 position in the market. And the most important is our AI server business. Actually, last year Q4, we achieved over 100% growth in the year-to-year. So this is a very good performance in the new AI server business. And last one is our AIoT BG. Actually, in this year Q4, achieved over 50% of the YY growth. The major contribution is from our NUC product line because in the last year, we successfully integrated original Intel NUC business into ASUS operation. We also expand our business into some vertical market. So we have very good performance in the last year Q4. So about the outstanding receivables, actually, this is because in that year, we sell our AI server to the customer in India. This is the very big group, the Yota Group, their subsidiary company, so-called the NMDC. This company is the major player in India for their government to enable the AI-related business. So I think these kind of things happen in the normal business operation. And even consider this big write-off in the last year Q4. Actually, I think ASUS financial status is still quite strong and healthy. In the year 24, we even delivered the second highest profit number in ASUS history. And also our sales and our legal department already take some action. We have high confidence we can have good news very soon. Yes.
Yeah, that's why the fact that you're talking and you're emphasizing the accounts receivable, to me, it's almost like I feel like I'm back in accounting class and my professor keeps saying accounts receivable going up, that's a good thing. But if it remains at a high level, that's a red flag. So can I press you a little bit more on that? So do you expect the customer, to your point, your big customer in India, do you expect them to pay? When do you expect them to pay? And if you could just highlight the last point you just made there, what is the worst case scenario in case you're not able to collect?
Actually, we have a lot of discussion with the Yota Group. Actually, Yota Group in India is a very big group and have very strong financial. So I think this time is only some kind of misoperation or misprediction in their business. So we foresee we can receive those outstanding receivable in this year Q1. Yes.
Okay, thank you for clarifying. I think Rebecca has the next question.
Yeah, I mean, so you've previously talked about demand for AI PCs, and in fact, you sort of touched upon that in your first answer there. I think you cited last year sort of single high-digit figures, but I wanted to ask to what extent that you think this DeepSeek moment and the momentum that's coming through now, not just DeepSeek, but also, of course, Manus and so on, does that change your outlook for demand for AI PCs, and what kind of demand are you projecting?
Okay, I think DeepSeek recently is a very hot topic. I think in the past, the demand for the AI server is most from some big giant because they have a very deep pocket, so they can continue to invest in the computing power. But I think of course, they want to train more powerful large language model, and I think their final target is to achieve the artificial general intelligence, like that kind of capability. So if they want to achieve the AGI, this kind of capability, I think they will keep investing because according to the scaling law, more computing power, more data have higher possibility to achieve that kind of capability. But I think the DeepSeek release is also a very good news because if any new technology you want to get into the mainstream, the cost is very important. In the past, the cost is too high for the third party to enable the mainstream application to use the generative AI technology. But after the DeepSeek, because they reduce the cost to even 1/10 or lower. So I think this is very good to help customers to enable those kind of applications because the higher cost not only impact the customer's desirability, but also impact the business viability. So to have the mainstream application enable, I think the low cost is very important. So I think the DeepSeek bring this kind of possibility to whole industry. And of course, for talking about the AI PC, in the year 24, the AI PC is just starting. So only the hardware is ready, but all the software and the application is not so mature. So I think this may take another 2-3 years to get the whole application and environmental more mature to use the AI PC. So for C, in this year, I think the AI PC will occupy about 25 to 30% of the total PC shipment. And even in the next year, we foresee the AI PC will occupy around 60% of the total PC shipment. So I'm very happy and we would like to take lead in this AI PC transformation.
Can I ask you, you mentioned shipments, SY, and one of the main points that I believe you touched on in your earnings call just now is how tariffs will affect the business. So instead of asking a specific question, why don't you tell us how are tariffs going to be a big challenge for you guys, if at all?
Of course, tariff is another very hot topic also. Actually, I think in last year, Q4, everybody knows in this year we need to facing this kind of issue. So actually, we already prepare in advance. I think a lot of companies also doing the same thing. Actually, we ship more goods to our hub in the USA, so we can have more time to respond and do the preparation. Because ASUS is a branding company, so all the manufacturers, we co-work with our EMS, and currently our EMS, they have the different manufacturer site across different countries, including China, Vietnam, Ireland, Indonesia, and India. So we can dynamic allocate our product to do the production in different sites. So I think currently only the U.S. government, they have the extra tax when you manufacture your product in China. So of course, we will move some of our production, especially the goods need to ship to the U.S. to outside of China. We have a lot of choice. And actually, because the regulation will change dynamically, so I think we will do our best to keep our supply chain, have the flexibility and the resilience.
Thanks, SY. That's really interesting. I mean, just to your point there about how you're shifting your supply chains to meet some of those challenges around tariffs, can you outline what your plans are for US expansion? I see from your earnings that about 25% of your revenue so far comes from the US. Are you planning more when it comes to US expansion? And what are some of those challenges?
Actually, we will adjust dynamically. Actually, the 20% number is not 100% correct because the 25% is include the Canada and Mexico. So if we only count the U.S., may only occupy around 10%. So this is the real number. And of course, depending on the customer requirement, we will move our production line outside China. And but some customers, they request to have the production line inside the US. For example, our AI server. Recently, we like to expand our customer base inside the US and provide better service. So in the year 24, we set up the server production line inside the US. And right now, already in the operation. So with this production line in US, we can provide better service and efficient service to our customer in the US.
Understood. And as a final question there, so thank you for the clarification, by the way. So 10% of overall revenue is US market specifically. Do you have a longer term target for that percentage of your revenue that comes from specifically the U.S. market? And also connected to that, since you mentioned production lines and you've put up capacity in the U.S., do you have any plans to expand production capacity onshore in the U.S.?
Actually, of course, we have our internal target because we are strong in the U.S. market, especially for our gaming PC. So we are a leader in this segment. But we still need to consider the cost issue. Of course, if we set up the production line in the U.S., I think the cost compared to outside the U.S. Will be higher. So depend on the customer, what kind of cost and pricing they can accept. Of course, ASUS will select the most efficient way to provide our device to our customer. Actually, ASUS will do everything we can do to control the cost, and we would like to deliver the best service and the best customer value to the U.S. market with the competitive pricing.
SY, thank you so much for the time. We'd love to speak to you again and get an update really of some of the plans you just outlined there. Thanks for the insights as well there. Co-CEO at ASUS joining us there out of their office. Okay, plenty more ahead. This is The China Show.
Good morning. You are watching The China Show. Now, Indian Prime Minister Narendra Modi is in Mauritius for a 2-day visit. He's expected to attend the country's National Day celebrations as a chief guest on Wednesday, as New Delhi looks to reinforce the region's importance to India. New Delhi is among the largest trading partners of Mauritius, and the visit comes as China looks to increase its presence in the region, and Beijing's power play in the Indian Ocean is alarming New Delhi. It's also the topic topic of our big take today. And Bloomberg Global Business senior reporter Kate Wanha is with us. So tell us, first of all, why is the Indian Ocean becoming such an important focal point for these geopolitical tensions, these power plays, and how are we seeing that play out?
Well, the Indian Ocean is so vast. I mean, you've got an area that stretches all the way from the Horn of Africa to Southeast Asia, closer to where we are. And, these are places, of course, that are, people might know them as tropical paradises, Mauritius, the Maldives and Seychelles, but they've also become places that are very important geopolitically because you see both China and India, as you mentioned, jockeying for power and influence in these very important waters. And we know, I mean, it's so important for trade. Both China and India, they get half of their oil supply through these waters. The U.S. also has a vested interest as well. India traditionally has seen this as their backyard, the big brother in the region, but they're very alarmed by what China is doing in the region, flexing its military muscle. It's now got, bases from Djibouti in East Africa clear to Cambodia on the other side of the ocean. And India really wants to make sure that these waters are secure for its own trade. And so you see a lot of jockeying for power and influence in these places that, before were just nice tropical paradises.
Yeah, well, I mean, to your point, right? So that's the hard power part of the conversation. China's been also using soft power. There's the Belt and Road, of course, that we know. How is that playing out as far as infrastructure projects is concerned?
You're seeing so much of it. I mean, you're right. The Belt and Road Initiative does involve a lot of these Indian Ocean countries. Mauritius isn't one of them, but Seychelles and Maldives, Bangladesh and Sri Lanka, they've all benefited from Belt and Road. And even Mauritius, which isn't a Belt and Road Initiative country, they've also seen a lot of this infrastructure sugar, so to speak, right? China has spent money in the last few years to help build or finance an airport, a cruise port, a sports complex as well as a dam. And India feels like now it has to also counter with infrastructure spending as well. It signed a $353 million project to help finance, for example, a new Supreme Court building, and it's built a subway line. So a lot of attention and money is going to this region. These countries, of course, feel like they're getting a lot of infrastructure help and development, but at the same time, they know they're walking such a tightrope politically because it comes with a cost, of course.
Yeah, and I suppose sort of thinking about that political tightrope, there's another big power that we haven't mentioned, which is sort of the obvious other power in the room, which is the US. So what are the US interests in all of this? I mean, historically, the US has been very concerned whenever it sees China looking to expand its political power, even sort of soft diplomacy overseas.
You're so right. I mean, the US obviously is, as a geopolitical power, wants to make sure that these waters are free for trade to flow, through it. But there's also a very strategic reason why the U.S. is interested. It right now operates a military base jointly with the UK on a very remote island called Diego Garcia in the middle of the Indian Ocean. And, from that base, it actually monitors submarine activity. It used it previously to launch bombing raids in Afghanistan and Iraq. And that island is slated to return back to Mauritius under a deal that the UK has crafted as part of a United Nations court ruling. But sources are telling us that it's unclear at this point whether U.S. President Donald Trump is going to sign off on the deal. I mean, folks in Washington really clearly recognize that it's so important for the U.S. to have a presence in the Indian Ocean. But it's very unclear at the moment, with with Donald Trump, his attention is diverted elsewhere at the moment, what he sees the U.S. role in the region and how that's going to play out at a very crucial time where India and China are obviously in the mix.
And it's a critical moment, I suppose, too, of where the US is sort of reevaluating its role, or Donald Trump particularly is reevaluating its role when it comes to global politics. Thank you so much for joining us. That was Bloomberg's global business senior reporter and Big Take Asia podcast host, Kate Wanha. And you can read the piece on the terminal now. The function for subscribers is NI Big Take. It's also out on Bloomberg.com. There's some really fantastic on-the-ground reporting. And you can also listen to Wanha discuss the story in detail with Bloomberg's very own Peter Martin in this week's Big Take Asia podcast. That's available wherever you get your podcasts. Stay with us. There's plenty more ahead. You're watching Bloomberg.
Right, welcome back. So there are a couple of markets that are standing out today across the region. So one is Australia, we're down 1.4, as you can see. There's the tariff story and the exemption that President Trump says they're not going to get. And the market is effectively now down about just over 9% now. So we are very close to entering a technical correction if this continues. That's a big if, right? One that is looking like it has entered a correction if things end this way is Malaysia. Biggest decliner in the region as a market. We're now down 11% from the peak, which effectively now puts us into a technical correction territory, if you measure that, of course, at about the 10% level. Just to tell you about those two markets. But, of course, the other focus has been really here on Hong Kong and the tech stocks and the Hang Seng Index, too.
Yeah, exactly. I mean, we had 3 days of losses, and we've had southbound flows actually retreating a little bit. This looks not that dissimilar from actually what we were seeing yesterday morning, when we
Don't
were
get
quite
your hopes up, then.
optimistic that momentum might be sustained, and I might see some of those investors trying to buy the dip here. But yeah, it does feel like a little bit of a tentative positivity coming back.
Yeah, because it has almost been unbridled optimism really going into this week, where I think if you look at some of the daily charts, there has been, you could make the argument that recently has been a period of consolidation of this, but as Mark Cranfield points out, there is a long runway likely ahead here for Chinese equities. Anyway, that's it from us here on the China Show. We'll see you all tomorrow.
गाइस 6:30 होने वाला है, सॉरी 7 PM होने वाला है, यूएस मार्केट ओपनिंग है। 6 PM का डेटा था, आ चुका है ऑलरेडी। लेट्स वेट फॉर द इन्वेंट्री फोरकास्ट देखोगे तो क्रूड ऑयल की इन्वेंट्री का जो फोरकास्ट है लास्ट टाइम के कंपैरिजन में कम एक्सपेक्ट कर रहे हैं, तो अगर फोरकास्ट के अकॉर्डिंग आया है तो बुलिश होना चाहिए, तो फोरकास्ट आप कह सकते हो इट इज़ बुलिश साइड। बाकी सीपीआई का डेटा था वो हो चुका है, अब कल रहेगा मेन डेटा पीपीआई का और अनएम्प्लॉयमेंट क्लेम्स का। बाकी तीनों ही डेटा देखोगे तीनों के तीनों नेगेटिव थे डॉलर के लिए, पॉजिटिव फॉर गोल्ड एंड सिल्वर जो इन्फ्लेशन का डेटा आया था आज। लेट्स सी यूएस मार्केट की ओपनिंग का वेट करते हैं, कुछ मोमेंटम अगर होता है तो। बाकी क्रूड ऑयल मैंने जैसा बताया ये रेंज बनी हुई है मार्केट में, प्राइस एक्शन में पहले दिखा चुका हूँ एक बार। मार्केट एक बार सेलिंग में आया, लो बनाया, फिर सेलिंग में आया, उसी लेवल से लो बनाया। मार्केट ने एक बहुत अच्छा पैटर्न बना रखा है, ब्रेक डाउन हुआ तो भी अच्छा मोमेंटम आएगा। बाकी रेंज 3 बार सपोर्ट 3 बार रेजिस्टेंस की रेंज बन चुकी है, किसी एक साइड ब्रेकआउट या ब्रेकडाउन होना ही है, तो दोनों ही लेवल ऑफ रिस्क की साइड पर हैं। ऊपर रेजिस्टेंस भी रिस्की है और सपोर्ट भी रिस्की है, क्योंकि पहली बार नहीं आ रहा है, मल्टीपल टाइम सपोर्ट और रेजिस्टेंस ले चुका है। वी डोंट नो किस साइड ब्रेकआउट या ब्रेकडाउन होगा। बेस्ट तो यही रहेगा कि अगर सेलिंग या बाइंग कर रहे हो फिर से सपोर्ट और रेजिस्टेंस एरिया से कम ही क्वांटिटी में करना, या फिर यूएस मार्केट का वेट कर लो। अगर यूएस मार्केट की ओपनिंग तक कुछ नहीं होता है, जो कि वैसे नॉर्मली 6 PM पे हो जाना चाहिए था, नहीं होता है, तो मेरे अकॉर्डिंग मार्केट साइड में जाना चाहिए यहाँ पर। एंड आफ्टर इन्वेंट्री 8 बजे के बाद शायद थोड़ा बहुत मोमेंटम आ जाएगा। नेचुरल गैस कल के लेवल थे, कल यहाँ पर एक सपोर्ट था, वहाँ से बाइंग आई थी, फिर एक एफईजी बनाया था, वहाँ से एक सेलिंग का ट्रेड था, मार्केट उसी में गैप डाउन ओपन हुआ था, वही उसका एक टारगेट मिला था। नीचे एक सपोर्ट है हमारे पास ओवर हियर, यहाँ पर देख सकते हो, यहाँ से एक बाइंग का प्लान कर सकते हैं। ऊपर जाता है तो ये रेजिस्टेंस कल वाला है, यहाँ पर भी एक रेजिस्टेंस है, और सबसे ऊपर तो ये 2 आवर टाइम फ्रेम का रेजिस्टेंस है। ये जो ब्लू कलर की लाइन रखी है ये भी एक सपोर्ट है, नॉट एग्जैक्टली लाइक इतना हैवी सपोर्ट है, बट थोड़ा बहुत है तो रुक सकता है थोड़ा बहुत। यहाँ पर अगर ट्राई कर रहे हो तो थोड़ा कम क्वांटिटी में नहीं ट्राई कर सकते हो, ऐसा बता देता हूँ कितना बनेगा। हाँ 6 PM का जो डेटा था वो पॉजिटिव था गोल्ड और सिल्वर के लिए, एक बुलिश कैंडल बनी भी थी, बट कुछ इतना खास मोमेंटम आया नहीं है। सिल्वर को देखोगे अभी भी रेजिस्टेंस पर ही है, नहीं कर पाया। फॉरेक्स का करोगे तो और बेटर है, वो MCX में गैप अप की वजह से वहाँ पर लेवल क्लियर नहीं है एक्चुअली। कैंडल फॉरेक्स में देखोगे तो ओपन इक्वल टू लो है, ओपन इक्वल टू हाई है इन नेचुरल गैस।
news when you want it with Bloomberg News Now. I'm Karen Moscow. We have the latest inflation figures in just a moment, but first, President Donald Trump's 25% tariffs on steel and aluminum imports came into force today, triggering concern across export-reliant Asia and an immediate reprisal from the European Union as the global trade war enters a rocky phase. The European Commission offered the strongest reaction so far and the most details of its next steps. We get more with Bloomberg's Rosalind Matheson.
The EU's come out pretty quickly on the back of this, and they're announcing plans to impose their own duties, all up at about 26 billion euros, 28 billion US dollars worth of American goods. This will come in a phased approach that does still allow room for negotiation. So there were existing tariffs that had been suspended on the US. Those are due to snap back, as they say, at the end of March, and it sounds like they'll just let them return.
And that's Bloomberg's Roz Matheson. The EU will target politically sensitive goods in Republican-led states, including soybeans from Louisiana, which is home to House Speaker Mike Johnson. The EU tariffs are expected to take effect next month, allowing time for further negotiations. Well, the new U.S. tariffs include 25% duties on steel and aluminum from Canada. President Trump had threatened to raise it to 50%, but backed down after Ontario walked away from a threatened surcharge on electricity it sends to the U.S. The president said he thinks the economy will boom with tariffs, but in remarks heard on Bloomberg Radio, he told the Business Roundtable the rates may still go up.
The tariffs are, they don't want to pay 25% or whatever it may be. It may go up higher, maybe go up higher.
And President Trump said the biggest win from tariffs will be if they move more production into the U.S. Meanwhile, Reuters is reporting Canada will announce almost $30 billion in retaliatory tariffs today. Now, breaking news on the inflation front. U.S. consumer prices rose at the slowest pace in 4 months in February. We get the numbers with Bloomberg's Michael McKee.
We come in with a little bit better news than everybody was expecting, with CPI on a month-over-month basis just up 0.2%, and the core is up just 0.2%. That pushes the year-over-year CPI down to 2.8% and the core down to 3.1%, suggesting that the Fed could start making a case for additional rate cuts if they wanted to.
And that's Bloomberg's Michael McKee, and futures added to gains following that report. House Republicans have approved a stopgap spending bill to avert a government shutdown at the end of the week. Now it's on to the Senate, as we hear from Bloomberg Government's Jack Fitzpatrick.
The Senate is a heavier lift. They need 60 votes at least to end the filibuster. We've only heard from one Democrat who says he's going to support it. That's John Fetterman from Pennsylvania. A lot of them have said they aren't decided, though. So it is possible that they can get this through.
And Bloomberg Government's Jack Fitzpatrick says the Senate may need 8 Democrats to get that bill through. Republican Senator Rand Paul has said he'll vote against the bill. Sources tell Bloomberg President Trump will nominate Federal Reserve Governor Michelle Bowman to be the central bank's next vice chair for supervision. That could come as soon as today. The Education Department plans to lay off more than 1,300 of its employees as part of an effort to halve the organization's staff. It's a prelude to President Trump's plan to dismantle the agency. Now to Russia, which is gearing up to respond after Ukraine agreed to a 30-day ceasefire in talks with the U.S. and Saudi Arabia. Bloomberg's Greg Sullivan has more from Dubai.
The ball is now in Russia's court. We know a few things. One is that the reaction from Russia so far has been rather muted. We'll know a lot more soon, as the U.S. envoy Steve Witkoff is expected to travel to Russia and meet with President Putin, so we might know more about their reaction from then.
And Bloomberg's Greg Sullivan reports the outline of the ceasefire deal does not meet Russia's previous demands to stop the fighting. Russian President Vladimir Putin has repeatedly brushed aside President Trump's calls for a quick end to the fighting. In Manhattan, a federal court hearing is scheduled for today in a suit challenging the detention of Mahmoud Khalil. That's the Columbia University graduate student that the Trump administration is trying to deport over his participation in pro-Palestinian protests at the school. And Tiger Woods had a less invasive surgery for a ruptured Achilles tendon yesterday. It will keep him out of the Masters and leaves in question whether he can play in any other major championship the rest of the year. Again, futures are higher this morning, adding to gains after inflation came in lower than forecast. S&P futures up 1.1%, Dow futures up 0.7%. NASDAQ futures up 1.5%, and the 10-year Treasury yield at 4.32%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
नरेंद्र गोस्वामी जी, व्हाट इज WRL एंड WSL? ओके, WRL मतलब वीक सपोर्ट लेवल एंड वीक रेजिस्टेंस लेवल। एनी टाइम कोई भी सपोर्ट या फिर रेजिस्टेंस, अगर मैं अपने अकॉर्डिंग बता रहा हूँ, ठीक है, हर किसी का अपना अपना वैल्यूएशन हो सकता है लेवल का, बट नॉर्मली मैं क्या देखता हूँ, अगर कोई लेवल एक या दो बार, फर्स्ट टाइम तो नॉर्मली हार्ड होता ही है, वो सपोर्ट या रेजिस्टेंस स्ट्रांग होता ही है। इट डजेंट मीन कि 100% एक्यूरेसी होगी, बट फिर भी कोई भी सपोर्ट रेजिस्टेंस है तो वहाँ पर एक बार बाइंग एक बार सेलिंग आती आती है, ठीक है। 99.99%, ऑब्वियसली 1% नहीं आएगी, 1% ऐसा भी जा सकता है कभी कभी कोई न्यूज़ आ गई तो, बट हम मैक्सिमम एक या दो बार ले लेते हैं, या फिर मैक्सिमम तीन बार ले लो एक ही लेवल से बाइंग या सेलिंग। दो या तीन बार के बाद वो लेवल वीक हो जाता है ऑब्वियसली, वो आपको दिख भी जाएगा लेवल को देख के। अगर प्राइस वहाँ से हायर लोज या फिर लोअर हाइज बना रहा है सपोर्ट या रेजिस्टेंस लेके, तो फिर वो लेवल थोड़े वीक हो जाते हैं। अब जैसे ये क्रूड ऑयल की बात करें, तो क्रूड ऑयल कोई पहली बार नहीं आ रहा है इस लेवल पे, राइट। एक बार सेलिंग कल आई थी, दूसरी बार फिर से आई थी, तीसरी बार आई थी, ये चौथी बार देने की कोशिश कर रहा है। तो दो तीन बार सेलिंग आ चुकी है, तो अब थोड़ा वीक है। मैं ये नहीं कह रहा हूँ कि ऐसे सेलिंग आ नहीं सकती, कई बार देखा है कि 4 से 5 बार भी लेवल होल्ड कर जाता है, राइट। बट फिर वो थोड़े से वीक हो जाते हैं, इसलिए वहाँ पर WRL या WSL लिखा हुआ है। सिमिलरली सपोर्ट की बात कर रही है, कोई पहली बार का सपोर्ट नहीं है, ठीक है। मार्केट यहाँ से आया था, एक लो यहाँ बनाया था, एक लो यहाँ बनाया था, फिर मार्केट यहाँ से आया, मार्केट ने सपोर्ट लेने की कोशिश करी, तो ये फर्स्ट सपोर्ट हो गया इधर पे, ये दूसरा सपोर्ट हो गया, ये थर्ड सपोर्ट हो गया, एक आज लिया है चौथा सपोर्ट। तो 3 से 4 बार ये भी ले चुका है सपोर्ट। अब मैं ये नहीं कह रहा हूँ कि नीचे आएगा तो सपोर्ट लेगा ही नहीं, हो सकता ले ले, बट जब दो तीन बार ले चुका है तो फिर मैं जो अपना बता रहा हूँ, मैं एक्सपेक्ट करता हूँ कि फिर लेवल ब्रेक हो जाए। लेवल ब्रेक हो जाए मतलब अगर यहाँ से बाइंग आई है तो बीच का लेवल रिमूव होकर नेक्स्ट रेजिस्टेंस तक चला जाए, सो रेंज एक बड़ी हो जाए। उससे क्या पता चलता है कि ये लेवल अभी भी बहुत ज़्यादा स्ट्रांग है, बीच का लेवल रिमूव हो गया तो एक रेंज बड़ी बन जाएगी। या फिर प्राइस जैसा मैंने बताया, ऊपर का लेवल यहाँ से सेलिंग ऐसी आ जाए कि ये लेवल ब्रेक हो जाए, उस केस में फिर ये लेवल स्ट्रांग माना जाएगा, जो नेक्स्ट सपोर्ट है वहाँ से फिर बाई करेंगे, तो फिर एक रेंज ओपन हो जाती है। नए लेवल से बाई करना, वैसे तो मैं ट्राई करता हूँ, अगर मुझसे पूछो तो एक लेवल पे एक या दो बार ही, उससे ज़्यादा बार मैं नॉर्मली पसंद नहीं करता हूँ बाई सेल करना। बट कई बार, मैं खुद बता रहा हूँ आपको, कई बार मैंने देखा है कि एक ही लेवल से 3 4 बार बाइंग या सेलिंग आ जाती है। बट बेटर है 3 4 बार एक ही लेवल से बाई सेल करने से बेटर कि कोई नया लेवल बना दे तो वहाँ से बाइंग सेलिंग करो, ठीक है। कोई नई डिमांड सप्लाई एरिया बन जाए तो वहाँ से बाइंग सेलिंग करो, इट विल बी मोर बेनिफिशियल, एंड वहाँ पर एक्यूरेसी ज़्यादा होती है, टारगेट भी बड़े मिलते हैं। बस यही है, और कुछ नहीं है। नेचुरल गैस हायर टाइम फ्रेम व्यू, लाइक 1 आवर, 4 आवर, 1 डे, 1 वीक, कितने मिनट टाइम फ्रेम का व्यू पूछ रहे हो, एक बार कंफर्म कर दो। एक बार फिर से होली की बधाई सब लोगों को, हैप्पी होली, हैप्पी हॉलीडे कह सकते हैं क्या? हैप्पी होली टू ऑल ऑफ यू इन एडवांस। 14 मार्च को है, जो लोग बनाते हैं उनको भी, जो लोग नहीं बनाते उनको भी, जिन लोगों ने बना दी है उनको भी, ठीक है। मार्केट 14 को क्लोज है, इंडियन मार्केट आपका। MCX मार्केट भी मॉर्निंग पे क्लोज है, इवनिंग पे ओपन है 14 को, ठीक है। फिर सैटरडे संडे है, तो आप कह सकते हो आज और कल दो ही दिन मेजर ट्रेडिंग सेशन रहेगा। 1 आवर टाइम फ्रेम पे देख लेते हैं हैप्पी होली। नेचुरल गैस की इन्वेंट्री कल आएगी, आज नहीं। देखो 1 आवर टाइम फ्रेम पे भी मार्केट के अगर देखोगे, ठीक है, ऊपर से मार्केट काफ़ी अच्छी प्रॉफिट बुकिंग दिखा चुका है। वैसे तो मार्केट अभी भी ऐसा ही है, अप ट्रेंड में, कोई डाउन ट्रेंड स्टार्ट नहीं हुआ है अभी भी। ठीक है, मार्केट अगर ब्रेक कर देता है अच्छा ये एमसीएक्स का चार्ट नहीं है ना, फॉरेक्स का चार्ट है, सॉरी एक सेकेंड, एमसीएक्स का चार्ट देख लेते हैं। फॉरेक्स चार्ट में फिर थोड़ा कंफ्यूजन हो जाएगा ना। ये इसी मंथ का फ्यूचर का चार्ट है। हाँ, मार्केट अभी भी अप ट्रेंड में है, कोई डाउन ट्रेंड में अभी गया नहीं है कम्प्लीटली। ठीक है, करंट मंथ का जो फ्यूचर का चार्ट देखोगे एमसीएक्स में, तो मार्केट के पास देखो जब तक 358 का सपोर्ट है तो सपोर्ट पर ही है मार्केट। 358 के नीचे अगर मार्केट कहीं क्लोजिंग बेसिस पे आता है 1 आवर टाइम फ्रेम पे, तब थोड़ी सी एक प्रॉब्लम हो सकती है डाउन ट्रेंड के लिए, क्योंकि अगर मार्केट सक्सेसफुली ब्रेकडाउन कर गया तो फिर ब्रेकडाउन रीटेस्ट में एक डाउन ट्रेंड स्टार्ट हो जाएगा 1 आवर टाइम फ्रेम के अकॉर्डिंग। अभी भी मार्केट में कोई डाउन ट्रेंड स्टार्ट नहीं हुआ है मेरे अकॉर्डिंग। 358 के नीचे थोड़ा सा बेरिस हो सकता है, फिर उसके नीचे आप एक्सपेक्ट करना इजीली 346, एंड और हालत ख़राब हुई तो अगर 324 भी आ जाएगा। तो अभी तो 1 आवर टाइम फ्रेम पे सपोर्ट रेंज पर ही है। देखें, लास्ट टाइम मार्केट ने एक हायर हाई बनाया था, 2 बार सपोर्ट ले चुका है, थर्ड टाइम आया है इस सपोर्ट एरिया पर 1 आवर टाइम फ्रेम पे। फर्स्ट टाइम जो हाई बनाया था वहाँ पर अगर देखोगे मार्केट ने आपका 393 का हाई बनाया था, दूसरे बार सपोर्ट लिया था तो रिसेंट हाई 408 का हाई बनाया था। तो अभी भी है सपोर्ट। ये देखना इंपॉर्टेंट होगा, अगर यहाँ से बाइंग आती है वापस 1 आवर टाइम फ्रेम पे, क्या ये 408.10 के ऊपर जाएगा नहीं जाएगा। नहीं गया तो फिर हेड एंड शोल्डर बन जाएगा, आपको पता ही होगा, दिख रहा होगा देखो वहाँ पर एक चार्ट में। तो अभी सपोर्ट पर ये 358 के नीचे थोड़ा सा प्रॉब्लम हो जाएगी बायर्स को। फिफ्टीन मिनट में ये देख लो, ये सपोर्ट रेंज होल्ड होना चाहिए यहाँ से। ओके, यूएस मार्केट भी ओपन होने वाला है, लाइक भी कर दो फटाफट से जिन लोगों ने लाइक नहीं किया स्ट्रीम को। डोंट फॉरगेट टू लाइक द स्ट्रीम। बाकी मैंने जैसा मॉर्निंग पे भी बताया था, किसी ने मुझे मॉर्निंग पर ही कॉल कर दी थी, मॉर्निंग पे कॉल मत कीजिए। कोई क्वेश्चन रहता है तो मेरे को व्हाट्सएप पे मैसेज छोड़ दीजिए, कॉल आप इवनिंग पे कर सकते हैं। मॉर्निंग पे मैं कॉल रिसीव नहीं करता हूँ, ठीक है। कोई क्वेश्चन भी रहता है तो व्हाट्सएप पे भेज दीजिएगा। बाकी कॉल पे बात करनी है तो इवनिंग सेशन पे कर सकते हैं, क्योंकि मॉर्निंग पे निफ्टी बैंक निफ्टी करना होता है तो वहाँ पर पॉसिबल नहीं हो पाता है।
Let's start with that EU response then. What are the details?
Well, I think the details are still a little bit hazy, Tom, but you mentioned it right there, 26 billion euros when it comes to the goods that are imported from the United States into the EU. Basically, you're opening kind of fire when it comes to those potential reciprocal tariffs. You go to look into the details, though, in terms of what the biggest trade relationship looks like between the EU and the United States. Let me walk you through a good chunk of it, because a lot of it is baked into the energy story from about 2 years ago. The biggest exports that are coming from the United States into the EU are things like energy, for example, petroleum oils, and especially LNG is going to be a big, big one. The second there is medicinal and pharmaceutical products, and then it's followed by things like engines aircrafts, and car parts. So you are really seeing a lot of these major sectors that we keep an eye on in Europe, the car sector in Germany, arguably in Spain and Italy as well. Then things like pharmaceuticals going into especially the medicinal kind of industry here in the UK is a big one. I know this is for the EU, but that's one to keep in mind in terms of the ripple effects there. And then, of course, the oil story, the energy story, the LNG story coming from the United States into Europe, really replacing a lot of those flows from Russia. That's where a lot of that trade is baked into.
As the United States are applying tariffs worth $28 billion, we are responding with countermeasures worth 26 billion euros. This matches the economic scope of the tariffs of the United States. Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs. We are ready to engage in a meaningful dialogue. I have entrusted Trade Commissioner Maroš Šefčovič to resume his talks to explore better solutions with the United States.
The measures unveiled just hours after the U.S.'s 25% tariffs on all steel and aluminum imports went into effect. President Trump defended his tariff policies in a meeting with business leaders Tuesday afternoon.
The tariffs are having a tremendously positive impact. They will have, and they are having. And ultimately, the biggest win is not the tariff. That's a big win. That's a lot of money. But the biggest win is if they move into our country and produce jobs. That's a bigger win than the tariffs themselves.
With us now to discuss, we've got Rob Casey, Signum Global Advisors Partner and Senior Analyst here. Rob, just want to go back to what we just heard in that clip here. What is the overall kind of relationship and the reaction that we're seeing between Trump's defense of tariffs versus what CEOs are navigating right now?
Yeah, well, I think you just heard it from Keith in the last clip. And first of all, Brett, it's great to be with you. CEOs today are navigating uncertainty. And as much as President Trump would like to, convince us all of a longer term story of strengthening the U.S. economy, in particular, strengthening U.S. manufacturing, in the short term, right, we are uncertain as to what the market is going to look like. There are certainly, calls for a recession now that there weren't maybe a month or two ago. And so I do think President Trump is trying to sell a long-term story. The rest of us are trying to stay above water in the short term.
And this also comes after we heard from Goldman Sachs CEO David Solomon this morning reiterating this idea that CEOs do want clarity on policy from the White House and that would allow for more capital investment and more growth. I wonder then, Rob, based on your sourcing, your conversations in D.C. with folks, what might push the Trump administration to capitulate to some of these executives and provide a little bit of that clarity? Would anything?
Well, there's been a lot of conversation about where the Trump put is, right? How much pain is the Trump administration willing to take in the markets to reverse course? We're certainly not there yet, right? Maybe it's a 10 or 15% correction, and we're getting there. But honestly, I think that the more important reaction function that we have to think about in the short term is not an economic one, it's a political one. And that's Republicans in Congress going to the president and saying, listen, you don't have to run for re-election again in 4 years, but we do, right? And many of us, everybody in the House has to run again in less than 2 years. So if we're thinking about what is going to force President Trump to either reverse course on some of the tariffs that he's already implemented, although he hasn't implemented all that many so far, or at least provide some clear certainty over the medium term.
Right.
I think it's going to be that political reaction function of Speaker Johnson, Majority Leader John Thune in the Senate, saying, listen, President Trump, we understand what you're trying to do. We also want to rebuild manufacturing in the U.S., but you have to give us a chance in the midterms.
But does Trump, I mean, Trump by his own admission doesn't care what the market is doing. He's not watching it. And then even for these politicians that you mentioned, the majority of their constituents are not even invested. So is that going to actually motivate them to go to the president and try to move the needle on these policies?
Well, it's it's true that the majority of constituents aren't looking at the markets quite as closely as we are, right? But if we're thinking about agricultural states, in particular, if we're thinking about farmers, they are represented by Republicans. The middle of this country is driven by agriculture. The middle of this country also votes for Republicans. So as we're talking about reciprocal or responsive tariffs coming from the EU, coming from China, potentially coming from Canada and Mexico, I do think that even if constituents are looking at markets, they're looking at their day-to-day operations. The tariffs are something, not only are they hitting Wall Street, they're hitting Main Streets and they're hitting farmers. And so everybody's worried about the impact of these tariffs.
And so one of the other things that we kind of think back to Trump 1.0 with is the U.S. and China's negotiations that ultimately netted out a deal, but then we had COVID, so following through on some of those elements became a little bit harder, and some of the tariffs ultimately were not kind of re-engaged with by the Biden administration. So now you have a lot of companies that have tried to figure out ways just to continue to operate, either continuing to have their own agreements with China or making sure that they can circumvent any potential risk there. How is that standing right now, especially knowing the outsized risk that some U.S. companies have to their revenue if we do see a ratcheting higher of those tensions between the U.S. and China?
Yeah, so honestly, at Signum, and our coverage of tariffs is led by our head of research, Andrew Bishop. We are very rarely accused of being bullish, right? I mean, if you look at the world of geopolitical risk and uncertainty, there's certainly a lot to worry about. We're very worried about Europe in particular. Where we're not quite as worried is in U.S.-China. And I say that for a couple of reasons. Obviously, we've seen, 10% tariff applied and then another 10% tariff applied, getting us to a 20% tariff increase over the course of the Trump administration so far. But what we haven't seen is significant retaliation from China. We've seen tit for tat, but nothing that sort of looks like a U.S.-China trade war in the short term. And we think that is essentially intentional, that neither President Trump nor Xi want to, go down this path of trade war, and rather both are willing to, or potentially eager to, sit down and have a discussion, right? We saw this in Trump 1.0, given the U.S.-China trade deal won. It's true that given COVID and after Trump left office, China did not hold up their end of the bargain, especially in terms of purchasing U.S. goods. But as a matter of fact, we think Trump is eager to, get back to the negotiating table with Xi. And that's why, at least in the short term, and, rhetorically speaking, we're seeing Trump go after American allies much more significantly than he is going after China. Now, what that looks like in the long term, we think essentially it is a relatively muted trade relationship over the course of the short term, right? Not a significant trade war. And then over the course of the long term, right? The entire Trump administration, 4 years. What we think is we see very well telegraphed, choreographed and quite high phased in tariffs, but only on key sectors focused on economic security and defensive security. So, pharma, PPE, right, tech, semiconductors, some of the defense supplies we import from China as well. Those sectors are going to get hit hard by tariffs. But it's a story about strategic decoupling. It's not a story about broad decoupling or trade war.
All right, Rob, really great overview there. Thanks so much for making time for us this morning.
Thanks.
Coming up on the morning brief, we'll count you down to the opening bell on Wall Street, plus Intel getting a boost on reports of a potential deal in the chip space. The details for you next. Also, another analyst warning on Tesla sales. We'll break down why as shares look to rebound from the latest sell-off. All that and much more on Morning Brief.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
We're taking a live look at the opening bell on Wall Street and in Midtown Manhattan, where you've got great bell ringers on both sides. There, you're taking a look at some funfetti at the NASDAQ here. And then additionally, you've also got a look at FIA ringing the opening bell at the New York Stock Exchange. Looks like that's a remote bell ceremony taking place there. So not exactly at Wall Street, but still at location TBD, and looks like they're having fun, clapping and cheering. Taking a look at the major averages as we begin today's trading session. The Dow Jones Industrial Average, that begins the day higher by about 0.5%. The NASDAQ Composite, that starts off the day up by about 1.7%. And the S&P 500, that also in the green by about 1% to start off today's trading session. Of course, after we got the February Consumer Price Index data that came out this morning. Let's also take a look at some of the sector activity out of the gate here this morning. 11 sectors on the S&P 500. We got them loaded up here for you on the screen. It's some of the trades that ultimately we saw a lot of investors kind of flowing into earlier on to start the week with some of the volatility that was playing out that are actually pulling up the caboose here today. Utilities specifically and staples, those were catching a bid earlier in the week. You're now seeing those down right now to start off today's trading session. Utilities flat just barely to the downside, but staples down by about 0.9%. You're also taking a look at healthcare down by about 0.3% right now. But leading the pack, catching a little bit of a bid out of the gate this morning, you've got technology. That's up by about 2%. Going just a little bit deeper into technology, let's look at the tech-heavy NASDAQ 100 here, as you're seeing NVIDIA up, starting off the day by about 5.5% in the green. You've also got some green movement here.
Okay guys, US market हो गया है open. US market is open and crude oil ने finally अपनी range break कर दी है. ऊपर का level आप चाहो तो remove कर सकते हो, इसकी ज़रूरत नहीं है अब. ठीक है, एक level अब break हो चुका है तो हमारे पास अब थोड़ा broader range है. Now we don't consider this level, okay? इस लेवल को अब कंसिडर नहीं करेंगे. थोड़ा ऊपर आ जाता है तो वहाँ एक सेलिंग का प्लान है. एक बार देख लेते हैं नीचे क्या वापस बाइंग मिल सकती है. थोड़ा बहुत वॉलेटिलिटी होगी, मुझे तो लगता नहीं है वैसे मोमेंटम ज़्यादा करेगा बिकॉज यूएस मार्केट की ओपनिंग भी है. लॉजिकली तो यहाँ पर देखो एक सेलिंग का ट्रेड बना सकते हैं पुल बैक के लिए, बट मेनली मुझे इशू आ रहा है यूएस मार्केट का. एक्चुअली यूएस मार्केट के वक्त मार्केट कहीं क्लियरिटी ना दे. सा ऊपर अगर यहाँ पर रहता है तो यहाँ से एक सेलिंग का प्लान रहेगा क्रूड ऑयल में. वैसे मेरे अकॉर्डिंग तो साइड में जाना चाहिए, मोमेंटम अब होना नहीं चाहिए, बट यस एक लॉजिकली देखा जाए तो यहाँ से एक सेलिंग का प्लान है. ये एक ट्रेड यहाँ पर क्रूड ऑयल में भी बनेगा सेलिंग का लाइक दिस. बाकी ध्यान रखना थोड़ा सा यूएस मार्केट का है, मुझे इशू आ रहा है, पता नहीं यूएस मार्केट एक ट्रेड रहेगा हमारे पास सेलिंग के लिए नाउ क्रूड ऑयल में. नेचुरल गैस में भी एक बाइंग का ट्रेड एक्सपेक्ट है नीचे। ओके, नेचुरल गैस में ना वो पूरा ही सपोर्ट जो होना है, थोड़ा हायर टाइम फ्रेम पे देखोगे ना, ये यहाँ से ऊपर वाली ब्लू कलर की लाइन से यहाँ तक ये पूरा ही सपोर्ट है। अब मैं उतना बड़ा सपोर्ट लगाऊंगा तो फिर वो एसएल बहुत बड़ा हो जाएगा, लाइक फायदा नहीं है। तो जितना नीचे मिले उतना बेटर, मैं तो ये कहूँगा। दिस एरिया यहाँ से लेकर यहाँ तक पूरा ही सपोर्ट है ये। बट ऑब्वियसली इतना बड़ा एसएल लगा के फिर रिस्क रिवॉर्ड कुछ खास बनता नहीं है, तो वो लॉजिकली सही भी नहीं है। मिल जाए इस लेवल पे तो वेल एंड गुड, नहीं मिलता है तो वेट करेंगे। बाकी कोई नया लेवल क्रिएट कर दे बीच में तो अलग बात है। लेट्स सी, एक कैंडल को देख लेते हैं क्लोज कहाँ होती है। 368 के ऊपर, 368 369 के ऊपर क्लोजिंग आती है करंट कैंडल की तो यहीं से कर लेंगे, नीचे तो वेट करेंगे। कैंडल पे भी डिपेंड करता है ना कि कैंडल एक्चुअली में क्लोज कहाँ पर हो रही है। अभी तो यूएस मार्केट ओपन हुआ है, थोड़ी वॉलेटिलिटी इस वजह से है। नीचे आ जाए तो बेटर ही है मेरे अकॉर्डिंग। देखो फिर भी ये कैंडल क्लोजिंग वही इसी का वेट हो रहा है। यहाँ तक आ जाता है तो बेस्ट है, नहीं तो यहाँ पर कैंडल का तो वेट करना पड़ेगा थोड़ा सा। नेचुरल गैस यहाँ पर अभी डायरेक्टली मत लेना, नीचे आ जाए तो बेस्ट, बाइंग डायरेक्टली बन जाएगी। अगर यहाँ पर बाइंग बननी है तो एटलीस्ट 368 69 के ऊपर ये करंट कैंडल क्लोज होनी बड़ी ज़रूरी है। लाइक भी करना होता है, 60 पीपल आर वॉचिंग, आधे लोगों ने अभी तक लाइक ही नहीं किया स्ट्रीम को, बताओ। यूएस मार्केट ओपन हो गया, क्रूड ऑयल की इन्वेंट्री है नेक्स्ट 50 मिनट में। नहीं, उसके अलावा और कोई डेटा नहीं है, देयर इज़ नो अदर डेटा। Okay, US market हो गया already open.
Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day, let's get you the 3 catalysts we're watching this hour. First up, we break down the market outlook following a better than expected inflation print. Plus, we'll look at how tariffs and the EU's retaliation could drive up inflation and consumer prices. And we'll check in on the chip trade amid pressure on the semiconductor sector. All those details ahead. Half an hour into the start of the U.S. trading day, let's get a check on the markets brought to you here by Tasty Trade. First, taking a look at the major averages, something we haven't seen in a few days here. Green on your screen. You've got your S&P 500 up about 0.5%, about 0.5% there. The tech-heavy NASDAQ taking up the majority of the gains, up about 1.3%. You've got your Dow under a little bit of pressure, down about 100 points this morning here. But let's flip the board over to the bond market because we're also seeing something a little bit new taking place there. Yields moving to the upside. Just a touch of a sell-off when it comes to your treasuries here. Perhaps we're seeing a little bit more of that risk-on sentiment movement into stocks off the back of that CPI print this morning, telling investors perhaps that the worst of inflation may be behind us. Investors certainly taking that as a positive when you look at the market action. But let's get our favorite risk-on, risk-off indicator in here, Bitcoin. And as you can see, it's up nearly 2%. Again, another symbol of perhaps a risk-on sentiment cementing in the market this morning. Well, President Trump downplaying recession risk despite the volatility that's rocked markets the last 3 weeks as parts of the economy begin to show cracks. Trump saying yesterday, quote, "I think the country is going to boom," and markets, quote, "don't concern me." However, our next guest says ultimately the net impact of Trump's policies on inflation will depend on whether weaker services spending outweighs higher goods prices. And in February, it's clear the disinflationary effect from softening services outweighed the uptick in goods inflation. Joining me now is Anna Wong, Bloomberg Economics chief U.S. economist and former chief international economist for the Council of Economic Advisors. Anna, you know I always love speaking with you, so thank you for making time with us this morning. I want to start on how you are thinking about the next inflation print we may be getting, which could indicate a little bit more of the inflationary impact of Trump's tariff policies.
Right. So in the next inflation print, we'll get half of March where the steel and aluminum tariffs would be in place as it came into full force today without much exemptions. And we are going to also get all these retaliation from EU and other and Canada on a whole bunch of other goods. So I think today's report kind of already gives us a flavor of what how tariffs will appear in CPI. We have seen a little bit of uptick in the prices of apparels and furnishings and things that are subjected to highly exposed to China so far. But in the next month, I think we're going to see perhaps more pressure on car prices as well. The seasonal factors for cars are not looking favorable for disinflation. So I think the story for March CPI would be that goods disinflation stalled, while services discretionary prices continue to come down as consumers pull back on spending.
Anna, what does that mean for the Fed?
Well, I think the Fed is not going to move as long as inflation expectations remain elevated. And we have seen in the inflation expectations data, there's a strong partisan divide in terms of this uptick. So I think what this means is that the Fed is going to cut only belatedly. And as a result, this tightening on financial conditions and the hurt on the real sector and the labor market will have to be far in advance before the Fed will begin to cut. This is risking a deeper downturn.
And Anna, I do just want to quickly break some news here for our audience. We have headlines coming in here that Canada's new reciprocal tariffs are going to begin at 12:01 a.m. on Thursday. Again, this continuation of the tit for tat between the U.S. and Canada. You're looking at a live shot there of a Canadian official speaking about Canada's retaliatory efforts off the back of those increased steel and aluminum tariffs. Anna, going back to you on this, I think this is indicative of part of what the market is struggling with right now, that this tit for tat for tariffs, it's unclear where and if it ends. How do you think that that impacts the economy? Do you think that that continues to lead to any slowness that could result in a recession?
Oh, so yeah, definitely retaliation by our foreign trade partner will show up as weaker economic activity in the U.S. For example, Canada's retaliation will disproportionately hurt U.S. Manufacturers. And later in the month, the EU also is about to reinstate a very large tariffs on U.S. bourbon, which will disproportionately hit Kentucky and the district under Mitch McConnell. So I think that all that will mean softer economic activities, and this is why I expect more pullback in discretionary services spending, which ultimately will be disinflationary. So in terms of recession, this R word, one important preconditions for recession is we have to see a widening of credit spreads of around 200 basis points. And so far, we are maybe a quarter. We've seen maybe less than a quarter of that. And in order for credit spreads to really widen, you need to see more panic in the stock market, a bigger sell-off in the stock market. And I think we are not there yet. So a lot of this recession talk is based on vibes, and in terms of hard data, it's not really there yet.
Well, Anna, it's a great breakdown, but to your point, we have seen a little bit of that widening in credit spreads, not to the degree that you're mentioning, of course. I wonder how you're thinking about the impact of the labor market here. It seems like in the headline numbers, things continue to be okay, but there are cracks under the surface. What do you think could potentially be the breaking point for the labor market that could then hurt the broader economic picture?
Definitely. I think the good trigger would be a government shutdown this Friday. So the House has passed the bill for a funding gap bill, and it's now in the hands of Senate. And they're playing the game of chicken where it's all up to Democrats now on whether they want to sign off on the bill. And I think the risk for a shutdown remains to be very, very elevated. And if there would be a shutdown, then that would last for another month. Then we could possibly see April's unemployment rate spike to above 4.6%.
All right, Anna, also, I lastly want to end with you just on how you're thinking about the market volatility and the selling that we are seeing as an indicator of the economy. At what point would the dip be significant enough for you to be concerned that asset prices could weigh on consumer wallets, consumer spending, and therefore the economy?
Yeah, so the sell-off will have to spread to a sustained period of elevated VIX, as well as a widening credit spreads of around 200 basis points, as I was saying. And we are not there yet. And the elevation of VIX has to also be sustained. And until that happens, then I think this temporarily confidence decline will will bounce back after they see better hard data.
Right. All right, Anna, thank you so much for breaking it down for us and reacting to that breaking news as well coming out of Canada. We really appreciate it. Well, stocks are mixed this morning following that better than expected inflation read for the month of February. But is one inflation print enough to ease market concerns about economic data and policy uncertainty? Our very own Josh Schaefer joining me now to discuss. Josh, it seems like investors think the Fed is back with a dovish vibe heading into the next meeting. Is that actually going to be the case? What are you thinking?
Yeah, so I mean, economists reacting to this report that I've been reading the research this morning sort of think this doesn't really change much for the Fed at this point, largely because you still need PPI to come tomorrow, right? So normally consumer prices and producer prices sort of equal a proper estimate for PCE, which is the Fed's preferred inflation gauge that we get at the end of the month. So you don't quite have that read through yet, but there have been some strategists, some bulls out there like Fundstrat's Tom Lee that have said the Fed put is still in and you need positive inflation data in order to have that. So the concept of the Fed put would be if we really are concerned about the economy and we see a weakening economy, the Fed would step in and cut rates, right? And the Fed would cut rates and that would help your swelling economy. The issue with that take has been, well, inflation's still well above the Fed's target. We're not seeing a lot of progress on inflation. Tariffs could be inflationary. So you combine all of that, and it sort of eliminates the Fed's ability to maybe help out the economy in that sense. So if you have positive inflation readings like this, it does bring it back into the picture. And it's definitely something that bulls are mentioning right now and bringing up as a potential case for what could help us rebound. But you just mentioned stocks now, where the market is open.
Right,
The actual indexes are mixed, right? After we just got some headlines about Canada reciprocal tariffs, and I think that speaks to perhaps the market's larger issue right now.
Yeah, it's interesting seeing that the tech names continue to kind of give us this lift this morning, but as we get these tariff headlines throughout the day, as we have started to learn, this has started to become a pattern that could start to weigh on equities. I wonder, Josh, how you're thinking about the number of price target decreases that we've started to see, the calls to go outside of the U.S. to European equities. Does the tariff picture start to matter more than the economic data points that we're getting in, or does the economic data still matter?
Yeah, so the strategists that I was speaking with yesterday in the story that's on our website right now from this morning all sort of argued it's the tariff picture, right? So there was a chart that Michael Kantrowitz from Piper Sandler had showing fiscal policy uncertainty soaring, right? So you're looking at this chart here, fiscal policy uncertainty is in green, soaring. What came right as fiscal policy uncertainty soared? Your major drawdown in the S&P 500, right? So in order for that S&P 500 to come back substantially, you'd probably need the green line to move lower. What actually moves the green line lower? Some level of understanding of what these tariffs are actually going to be, right? Something where we're not doing this every 2 hours, talking about reciprocal tariffs. Maybe we'll double these tariffs on Canada. I was just kidding about doubling the tariffs on Canada. Like, the market is really struggling with that, right?
Yeah.
And I thought one thing that Jack Manley from JP Morgan Asset Management pointed out to me yesterday is it's about figuring out how to price this in, right? And it's very hard to price in U.S. tariffs just blanket, right? If we had just talked about 25% tariffs on Canada and Mexico, that's a challenging thing to price in for equity strategists.
Right.
But the problem is, you then have to price in how are these countries going to respond? Then how would the U.S. respond to these countries?
Right.
You can see how confusing this is getting, and it basically becomes an area of price discovery for the stock market that is just very challenged. And I think that's what you've been seeing with this up and down nature of the market on a daily basis is right now we do not have enough answers. Until we have enough answers, a lot of strategists are saying maybe nibble at this dip, but they're not that confident in full-on buying the dip until we have clarity on what the rest of the year could actually look like.
Yeah, what we've heard from a lot of our interviews this morning has been just wait for the dip to go down even more because there's no sign of certainty coming anytime soon, so why not just get it at even more?
It's a tough area to be confident right now, right? I think it's overall what the take has been.
Yeah, hard to have conviction with so much uncertainty. Josh, thank you so much as always. Really appreciate it. As we head to break, I do want to take a look at some nuclear power stocks on the move as Amazon and other big tech companies vow to triple their capacity here. You can see Oklo up about 2.5%, but Vistra, the biggest winner here, up about 6%. Constellation Energy also up about 3.8%. And it's really interesting to see these moves off the back of some of the pressure that we have seen in utilities more broadly. Here you've got Amazon, Meta, and Occidental among the initial members of the large energy group users here, which is backing a global effort that was announced in 2023, again, to triple the world's nuclear capacity by 2050. All of these stocks on the rise. You've also got Talon Energy, by the way, up over 8%. Morgan Stanley initiating Talon with an overweight rating this morning. We'll have our markets action ahead right here on Catalyst, so stick around.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Chip stocks climbing today as the overall market looks to rebound from the recent sell-off. Still, the S&P semiconductor ETF down more than 15% this year, amid investor concerns about AI demand and the impact of potential chip export controls. Joining me now with more, we've got Jonathan Krinsky, BTIG's Chief Market Technician. Jonathan, great to speak with you here. Let's just start on the context for our audience. What changed in the semiconductor sector to lead to some of the pressure that we have been seeing?
Well, good to be here. If you look at the semis, really on both an equal weight and cap weighted basis, they really were in a pretty wide trading range for most of last year, despite the AI hype narrative. And so as that was happening, the relative strength versus the S&P, was beginning to deteriorate. And relative strength often precedes absolute performance, and that's clearly what happened. So you just didn't have any momentum or relative strength, and that led to a bit of a breakdown with the broad market in the last few months.
Yeah, and I know that you look at the technicals as a CMT. What might be a level or an indicator of a bottom being hit that could lead to some more movement to the upside in chips?
Yeah, so we've been looking, both in semis and across the broad market, some downside exhaustion levels. Obviously, there was a lot of eyes on the 200-day moving average for the S&P. We felt there was maybe too many eyes on that, but then the second break, we think probably is more a better buying opportunity, which is where we're at right now. You're starting to see some elevated capitulatory signals on the volume side, on the put call ratio. It's certainly not levels that we've can't go higher or can't get more oversold, but I think we're down 9 or 10% from the highs. If you're looking for an opportunity for a trade, I think this is the entry point. Bigger picture, there's probably more concerns, but I think the next 3, 4, 5% should be higher, not lower than here.
And just to stick to chips specifically, what do you think leads to more of the action that we're seeing today? Obviously, today is a little bit of a move to the upside in a lot of these chips names, but what technically are you seeing that indicates that rally is going to have legs?
Same thing. It's just, you get to a point where momentum kind of and sellers kind of exhaust themselves to the downside. And even in bear markets, and we're not saying this is a bear market, but if it does turn out to be one, or even more of a deeper correction, you do get some pretty vicious rallies. So you want to be mindful of those oversold conditions, and if nothing else, maybe wait for a bounce before looking to sell again.
And I wonder, too, if you can talk to me about what you're looking at when it comes to NVIDIA specifically. Obviously, the chip giant in the room, a lot of selling pressure that we've seen on that stock year to date. Those high earnings expectations being a challenge for them as well. What are the technicals telling you about how long a possible bounce back on NVIDIA could last?
Yeah, similar idea. It kind of traded sideways for much of last year in a trading range, and it's kind of broken below that a bit. So there's a lot of buyers that probably would like to be made whole, and so I think that's the issue. If you do get that bounce, they're back into the 2024 trading range. That's going to represent decent resistance. So. I think we'll get a bounce, but again, you got to watch the magnitude and how the bounce responds into that resistance zone. If that fails again, that's indicative of probably a more substantial, larger top.
All right, Jonathan, we got to leave it there. Thanks so much for joining us.
Thank you.
Well, energy is at the center of the U.S. and Canada trade war. Ontario Premier Doug Ford suspending the 25% tariffs on electricity exports as President Trump also declared a national energy emergency. The latest data showing the U.S. imports $2.9 billion of electricity from Canada per year and over 4 million barrels of crude oil a day. That's according to the Canada Energy Regulator and the EIA. Joining me now, we've got Bennett Gagnon. He is the CEO of Bitfarms, a crypto miner based in Canada with facilities in the U.S. And like many crypto miners, you have transitioned into more of an AI play amid that broader transition to high-performance computing. Talk to me about the runway that you see in that transition in the business.
Yeah, this is something that a lot of the industry is doing right now, because the areas where we've been investing over the last 4 or 5 years is on the hard energy infrastructure that used to power American manufacturing. And when American manufacturing was outsourced abroad, all the infrastructure was still in place and nobody really wanted it. So it provided cheap access to energy. Now, as the pendulum is swinging back towards a focus on America and onshoring, these assets that we've accumulated, are what's in high demand. And so we have what everyone wants right now. We've got a lot of megawatts. We've got them in short order. And now it's about how do you actually convert the infrastructure over from a Bitcoin mine to, more of a traditional data center. And that's something that is going to take, for most companies, maybe 12, 18, or 24 months. And you got to work with the right strategic partners and engineers, because these facilities are a lot more sophisticated and a lot different in terms of their actual operations.
And where are you at in that process?
So we're at a point where we've engaged multiple different strategic advisors and engineering firms. We're working with a variety of strategic financial partners to help finance the projects. And we are just about to close on an acquisition of 2 different power plants in Pennsylvania, which we expect to be a big opportunity for us in the HPC space.
And I wonder, too, how you are thinking about the impact of tariffs as a company that obviously has ties to Canada, but also other countries more globally. You mentioned the plants in Pennsylvania. Do you anticipate moving more towards the U.S., more towards domestic production in reaction to those tariff policies at all?
So we are moving absolutely towards the U.S., but it wouldn't be in reaction to the tariffs in particular. I mean, when we started out last year, we were only 6% in the United States. At the end of this year, we're going to be 66% in the United States. So it's a big shift for us as a company, redirecting our efforts from really an international footprint to one that's really focused on the United States. And that's because there's the most opportunity here right now. When we're looking at where's the best place for us to invest our dollars, where we're going to get the best return on invested capital, it's right here in the U.S.
And what are the factors that lead to that opportunity that make the U.S. more attractive?
I think there's a few things. One is the proximity to the markets that everyone wants to tap into on HPC. The physical infrastructure is super important. It takes a very, very long time to build out new physical infrastructure in the United States. So if you can have it already in place and you don't need to go through the backlog of going to get through permits and all the approval processes, it'll shave years off your timeline. Yeah. And it's really the timeline to energization here, which is what's so valuable. A lot of people have ability to grow things in 4 or 5 years. What people want to know is what can you grow in the next 12 to 24 months.
And I know AI infrastructure is such a key part of that, and obviously part of your desire to transition to this HPC model. Talk to me about the demand that you are seeing, because there's been obviously a lot of questions about whether or not the AI demand is really as lasting and as strong as the market initially thought it was. What are you seeing?
It's kind of an interesting situation with compute, right? Because compute is growing at such an exponential pace. But as the availability of compute supply increases exponentially, so does the demand. And what we see is that over the last, really 10, 20, 30 years, you've seen the exact same trend playing out as computers have progressed with efficiency and technology. And so as the cost of computing goes down, the demand and the applications only go up. This is what we're seeing here on the HPC side. And because there's been such a lack of investment into these hard energy infrastructure assets, that's the bottleneck to growth, right? It's not really, I think there's a lot of focus on NVIDIA and getting access to chips, but that's not really the bottleneck for growth. The bottleneck is, do you have the power to operate those NVIDIA GPUs? Right. Do you have the hard infrastructure to actually enable that? And that's where the real bottleneck is.
That makes a lot of sense. Something that we haven't talked about much is the crypto landscape under the current administration. Mm-hmm. I'm just curious, do you have Bitcoin on the balance sheet?
Yes, we do.
And what are you thinking about the runway for Bitcoin moving forward?
Well, we're very bullish on Bitcoin. I've been in Bitcoin since 2010. I'm a long-term...
Congratulations.
Thank you. I'm a long-term believer in Bitcoin, and we remain a long-term believer in Bitcoin as a company. I think... It's funny when people see Bitcoin price pulling back. I think they get a lot, pretty panicked. Somebody who's been here since 2010, this is just par for the course. Mm-hmm. I think it gets a bad rap for being volatile because of the daily price. But when you actually look at what Bitcoin is, it's actually the most stable asset on the planet. There's anyone can go out there and verify exactly how many Bitcoins exist today, how many Bitcoins are being produced, how many Bitcoins are going to be produced, 10 years down the road, 30 years down the road. Anyone can verify that. Nobody can tell you how many dollars exist today, or how many being produced, how many barrels of oil, how many tons of gold, how many tons of steel or aluminum. Nobody can tell you those things. And as the economics for those underlying commodities change, so will the supplies, right? So will the production rates. But with Bitcoin, we have an actual even greater degree of precision the further out we look. This is exactly how many is going to exist at any point in time in the future. And I think that's what's really exciting about Bitcoin, because it gives us a new unit of account to measure other things against. So long term, incredibly bullish.
Final 30 seconds. What would make you sell?
What would make me sell my Bitcoin? Yeah. There's no selling your Bitcoin.
So you're just going to...
You don't sell your Bitcoin. We as a business, we sell Bitcoin to cover operating expenses as we need to. We sell Bitcoin to invest in growth projects and offset some of the CapEx. But personally, no, I'll never sell my Bitcoin.
Hold forever. All right. Thank you so much, Ben. Really appreciate you joining us.
Thank
really
you,
great
Madison.
overview of the business as well. Coming up, what shifts in the ETF market are telling us about investor sentiment, from increased interest in Europe to outflows from tech and semis. Those details ahead.
Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time. From Yahoo Mail.
Shelter inflation showing signs of easing in the February CPI report. Our very own Danny Romero going to break down the numbers for us. Danny.
Brad, shelter remains on the disinflationary path. So let's take a look at these numbers. The government data showed that shelter costs rose 4.2% on an annual basis. That is the slowest pace in over 3 years. Now, on a monthly basis, housing costs ticked up by 0.3% last month. Now, it's very important to note that the housing component accounted for nearly half of February's overall monthly increase. Remember, there are two components that economists pay very, very close attention to and hold the biggest weight in the shelter figure. That's owner's equivalent rent, OER. That's the hypothetical rent you would earn if you were a homeowner renting out your property. OER came in at 0.3% gain last month, and rent, which lags real-time data because the government collects rent data every 6 months, which causes a lag in the index. Rents rose 0.3% in February. Now, looking ahead, some economists believe that rent growth will move lower this year, pressured by stricter immigration rules and tariffs impacting construction. Brad?
Danny, thanks so much for breaking this down for us. Appreciate it. As we head into the spring home buying season, February shelter costs were 4.2% higher than the same time a year ago, the smallest 12-month increase since December of 2021. Joel Berner, Realtor.com senior economist, joins me now to talk more about housing. Joel, good to have you here with us on the show. Just want to get your takeaway from this latest consumer price index print and the shelter component.
Yeah, just like we heard, this number tends to lag. It's a survey of actual renters who are reporting how much they're paying. And so a lot of people we're seeing stay in their homes for longer than they have in previous years in this high mortgage rate environment. Lots of would-be first-time home buyers are remaining renters for longer. And we're seeing those same home rents increase at a pace that's a lot faster than what we're seeing on the market. I'm working on right now our monthly rental report, and what's going to show that for the last 19 months, the market asking rent has actually been falling on a year-over-year basis. So this CPI readout is really just catching up to the realities of the market with what can be charged for rent right now.
And so with all of this in mind, as you're thinking about the costs that we're looking at for shelter, what are we seeing in terms of just home prices easing? Because this has been increasingly important to address the affordability crisis right now.
Yeah, price per square foot growth has really slowed down, but remains positive. What's falling right now is the median listing price, but that's more of a result of smaller homes hitting the market. So we are seeing a lot of price reductions on the market right now. In February, that reached the highest level it's been in a February since 2017. So a lot of sellers on the market are having to make adjustments to get their homes sold.
Realtor.com found that the best time to sell a home this year is the week of April 13th through April 19th. Why is that, Joel?
Well, that's a combination of several factors. So at that time of the year, prices are relatively high. There's relatively less competition from other sellers and relatively more views on homes from home shoppers than there are at other times of the year. This week of April 13th is kind of the perfect mix of those three criteria in an opportunity to sell your home at a good price when lots of people are looking and before the big surge of new homes hitting the market. So we find that historically, this kind of middle April time period is the best time to list your home.
Okay, so what does that mean for buyers? Should they also be planning for early spring purchases or making sure that they've checked their list and running through all of the properties that are out there that have caught their attention?
Well, right now in 2025, the spring is a good time for buyers. We're seeing some really buyer-friendly conditions on the market. Time on market has increased, the number of price reductions has increased, and inventory is up. So right now is a good spring for buyers, but generally, looking at historical trends, the best time to buy a home is in the fall. Just for the opposite reasons, as spring is the best time to sell a home, fall is the best time to buy a home. There's less competition from other shoppers. There are more homes on the market that have been sitting all summer and haven't sold yet, and price reductions are at a higher point than they usually are. So it's kind of a flip-flop perspective, but I will say that for 2025, it's shaping up to be a strong buying season.
What are your expectations and outlook on mortgage rates? What is the sweet spot?
Today's inflation news was really helpful. We think that that's going to give a little bit of space for mortgage rates to come down. The big fear has always been tempering inflation with how we've kept mortgage rates high and seen them kind of creep up in the last couple months. Though in the last few weeks, we've seen some relief as the 10-year Treasury yield has softened. So we expect to see mortgage rates come down just a little bit in the coming weeks, but we don't expect to see major relief, like getting into the kind of 3%, 4% range that we saw a few years ago. We're kind of expecting to end the year in the low sixes, I should say.
So is policy-related uncertainty impacting the housing market? How are buyers and sellers both kind of going about their own expectations on policy?
Uncertainty is really what's the name of the game right now. So buyers are looking around and, some of them have lost jobs. Some of them are seeing their businesses struggle due to the trade war currently going on and feeling a little reluctant to maybe jump in. And for sellers, the same is true too. Mortgage rates are remaining uncertain and remaining an unclear path as to how fast the market will be moving and how fast they'll be able to sell homes. And a third party that has a lot of stake in policy is builders. Builders are looking around and saying, my inputs are going to increase in cost because they're coming from other countries. And so we saw in the most recent new construction data a pickup in completions and a slowdown in starts. So what that means is builders are really trying to get their projects finished and are a little reluctant to start new ones because of the uncertainty they see in the market going forward.
Is that uncertainty tied to tariffs, or is there something else? As we've talked with one economist earlier today about immigration, or reverse immigration actually impacting some of the labor inputs as well.
It's both, yeah. Tariffs are a major part of it. The cost of construction inputs are going to be a burden for builders to get over. But also, we know that about a third of the construction labor force is born outside of the United States. So there's going to be a pinch on the people who are actually building these new homes. And it's going to be a little bit more difficult for builders to train and pay their employees than it was a few years ago.
Joel, thank you so much for taking the time here today, breaking all things housing, shelter down with us. Appreciate it.
Thank you for having me.
Canada announcing new 25% counter tariffs on about $21 billion worth of U.S.-made products. This comes after President Trump went ahead with 25% tariffs on all steel and aluminum imports. Canada's new levies go into effect at 12:01 a.m. Eastern Time on Thursday and affect steel, aluminum, and other U.S.-made products. We want to dive into the impact those tariffs have and they might have on U.S. consumers, and speaking specifically what it means for the U.S. autos industry. Here with more, we've got Greg Migliori, who is the editorial director at Auto Guide. Greg, great to get your insights and great to grab some time with you as always here. So what is perhaps the broad scale read here on the impact of tariffs, especially on these aluminum and steel tariffs that have been put forward between the U.S. and Canada, how that dovetails through to vehicles?
Sure. Well, thank you for having me, Brad. And I think aluminum and steel are, they're two fundamental parts of the car itself. They're structural. There's no way of getting around it. So by adding tariffs, they're simply going to raise the cost of vehicles and the cost it takes to make these vehicles, which will likely be passed along to consumers. So it's a major disruption for the automotive market, for consumers, for the automakers who are trying to figure out how they can price their vehicles competitively. And I think it definitely could cause, a pinch in sales for the rest of the year. We'll see. It all depends on if the tariffs actually go into place, if they're pulled back, and what the long-term ramifications of them would be.
What did we see last time? Because this is not our first time within the past 10 years having to run the calculus around what percentage of that cost would get passed on to consumers and how materially the prices would change for vehicles, or even for parts if you're getting your vehicle serviced.
Yeah, so last time was a bit of an outlier because during the first Trump administration, there was a lot of tariff actions and disagreements and all of that. But then what happened is we ran right into COVID, and that completely upended the supply chain. You might remember the chip shortage, which automakers found a way to navigate. And it's a serious disruption. Now, what's I think sort of unique about aluminum and steel in particular is, again, they're a fundamental part of a vehicle. With chips, as important as they are, with software, with different systems that are used, you could actually make vehicles in a different way. You could adjust, you could hold some back. It wasn't ideal, but it was doable. It was adaptable. With these two raw materials, which automakers have been sourcing for over a century, they have their ways of doing it. It's very hard for them to turn on a dime and try to figure out how to adapt to the latest sort of tariff.
And so with that in mind, what should consumers expect as they're trying to ultimately figure out what type of vehicle to buy, what's going to be more cost effective for themselves?
So it's a little bit different than, say, like the EV situation where, obviously the Trump administration is trying to pull back from those and shift the market there. With aluminum and steel, they're so ubiquitous. So there's not one type of vehicle you could say, hey, I'm going to avoid this. There's not too many carbon fiber cars out there that you can affordably swap in for your Ford Explorer or something. So it's going to be, I think the pain will be felt all around. And I think the move right now is if you're in the market, you really want to have your head sort of on a swivel and look for deals, look for any other sort of incentives that automakers or dealers might frankly put on to continue to try to move the metal. Because dealers and automakers, they don't want to start having inventory backup. They don't want a sales slump. So there could be some sort of incentives or things put on more at the manufacturer or the dealership level. If you're in the market, you just want to be extremely vigilant for the next few months and see if that deal that you're looking for is still available and how that impacts your pocketbook.
Greg, always great to get some time with you. Appreciate the breakdown here.
Thank you, Brad.
Coming up, common tax mistakes that could cost you. We've got some tips to help you avoid them and what you can do if you already filed with the mistake. That's next on Wealth.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Let's get a check of the markets as we are 2 hours into today's trading activity. This is post the consumer price index prints that we got for the month of February. The Dow Jones Industrial Average was in positive territory to start off the session. Here we'll light up this chart here just to give you a good view of what's transpired since then, as we have been in negative territory since late in the 9 a.m. hour, just after we began trade here. We were positive, but now negative by about 0.6% during today's trading activity. Also taking a look at the tech-heavy NASDAQ, we've largely held on to gains, but we have seen a little bit of slippage over the course of today. We're well off of these session highs and now holding on to gains of about 0.7%. And for the S&P 500, similar case there. That did dip into negative territory here at the start of the 11 a.m. hour, also touched it at the end of the 10 a.m. hour, we should say. Flat, just barely to the upside, holding up to about 0.1% in gains right now. Let's go under the hood just a little bit further and get you some of the sector activity. We are red across the board right now, the deepest of the decliners right now, and that's a 1 month view, so I want to give you an intraday view. This looks a little bit more accurate. Okay, this is what we've been watching throughout much of today's trading activity, and this is what we saw at the beginning of today's trading session. Consumer staples actually leading some of those declines. That's down 2%. Some of those safe haven plays that were catching a bid earlier on in the week when we did see volatility ratchet higher, and we can take a look at the VIX in a hot second for you folks at home. One of those areas that we had seen a lot of trades flow into was staples, was also healthcare, was also utilities. And so as of right now, we're seeing those leading some of the pullback, and it's technology that's catching a bit of a bid here on the day. That's up by about 1.2%, but you do have more laggards than advancers. As we're taking a look at some of those advancers here on the day, I just wanted to tab on over to the NASDAQ 100 for you just very briefly here and take a look at some of those mega cap tech stocks. NVIDIA, as of right now, you're seeing that higher on the day by about 5%. So a few of those names seeing a little bit of a bounce back. Palantir, they had their social media post that has them moving higher as they've got even more of the developments set to be announced for AIPCon. That's taking place soon, and ultimately Palantir catching a bit of action on the day as well. Okay, I mentioned VIX. I just want to quickly, I know we got to go, I want to quickly come over to that so I'm not lying to you real quick. And we're taking a look at the CBOE Volatility Index, the VIX as it's popularly known. There we're taking a look at, it's sitting at about 26 right now, and we've been at that and above that kind of 25 range here for it seems like the past 5 days. We've just been in that ballpark, so we'll continue to watch that as the fear gauge index is sitting in that ballpark. All right, now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to take a look at shares of Novo Nordisk, off roughly 5% this morning after the fellow European drug maker Roche reached a deal to develop a weight loss drug. As part of the deal, the Swiss drug maker will pay Zealand Pharma $1.6 billion in upfront cash, as well as additional development and sales-based milestone payments worth up to $3.6 billion. This deal expected to close in the second quarter of this year. Shares of Novo Nordisk, creator of weight loss treatments, Ozempic and Wegovy, it's down over 13% year to date. Next up, let's take a look at shares of Starbucks, falling hours ahead of its annual shareholder meeting. The company's investors will weigh in on CEO Brian Niccol's $96 million pay package. It also marks the first investor meeting since Kathy Smith took over as the coffee giant's chief financial officer. Shares lower by about 2.4%. Well, it is tax week on wealth, and we have everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we're talking about mistakes and how to avoid them on your tax returns. Some of the most common tax mistakes include entering information inaccurately, using the wrong filing status, messing up tax credits and deductions, and simple math errors. According to the IRS, 2.7 million returns had math errors during the 2023 tax season. Joining me now, we've got Adam Brewer, AB Tax Law Tax Attorney. So, Adam, we got to know, what are the best ways for taxpayers to avoid these common mistakes?
Yeah, good morning, Brad. The best way to do it is double, triple, quadruple check that return before you hit submit. This isn't a tax year you want to be dealing with the IRS, a lot of back and forth. trying to give them additional information or fix a problem. And so what I'm telling my clients is make sure you check those portals on your brokerage accounts, your employer email account. Make sure you check your traditional mail. We have all these tax documents that are coming in different ways now. It's not just all in the mailbox. So you really want to make sure that you're picking up all of those documents, reporting all of that income, because you don't want to be, like I said, going back and forth with the IRS trying to get a tax return process this year.
What types of penalties can you face for making a mistake on your tax return?
Yeah, so the most basic one, I think we'd see like a 25% accuracy related penalty. But keep in mind, these aren't mistakes that are often picked up day one. So you're going to pay an accuracy-related penalty. You're going to pay a late payment penalty. That's 0.5% per month, up to 25%. And then they're going to charge you interest on top of that. So if this is a mistake that they realize you made a year from now or 2 years from now, it's not unexpected to see that the amount of tax equal the amount of penalties and interest.
So if you already filed with a mistake, what can you do?
Yeah, so if you already filed, if you were proactive, you said, hey, I'm going to do the right thing, get this return in early because I'm worried about staffing cuts or because of the government shutdown potential or because you want a refund, then you have to file an amended return. And so fortunately, you can now do that electronically. And that's for taxpayers, whether they owe additional money or whether they realize, hey, I overpaid. The IRS owes me money. Either camp can file an amended return electronically.
So how does the process change if you paid too much versus if you paid too little?
Yeah, so the process is more or less the same. It's still going to be an amended return. I'd say it's the urgency side. So if you owe the IRS money, you want to get to that before they realize, hey, this taxpayer didn't report everything. Again, that minimizes the risk of penalty assessment. And that will minimize how much interest you owe them. And so those taxpayers, they want to get that amended return in as quickly as they can. Likewise, if you overpaid, better the money in your pocket than the IRS is. So you also want to get that amended return submitted. I guess there's just not that level of urgency where you realize, hey, every day I procrastinate on this, I'm going to be paying additional penalties and interest.
So what if you owe more money than you can afford to pay when you're filing?
Yeah, so it's really common, especially with all the gig economy income. A lot of these taxpayers now, they're going to have income from sources not subject to withholding. So if you're driving an Uber, driving Lyft, DoorDash, put your house on Airbnb, you're going to end up owing money in a lot of those cases. And so the one thing I tell all my clients is if you owe, don't let that fear of owing the IRS stop you from submitting the return. Look, this isn't like a soft, cuddly IRS. They're not eager to help you out necessarily, but they do have programs. So you can get on an installment agreement. You can tell them, hey, I need 180 days to pay this balance. And they'll give you that time. They're going to charge you penalties and interest. If it's an amount that's insurmountable, there is an offer and compromise program. There is hardship status. But it really depends on how much you owe and how much time you think it's going to take you to pay it.
Adam, thanks so much for taking the time. Really appreciate it. Some valuable tips
All right,
for those
thank you,
trying
Brad.
to avoid
Have a
those
great
mistakes.
day.
Thanks, you too. The number of Americans expressing confidence around their retirement prospects dropped 7% from last year, according to a new Fidelity study. We want to help address that with those tips for people who are close to or already in retirement. Joining me now on set, we've got the host of Yahoo Finance's Decoding Retirement podcast, Bob Powell. Bob, let's talk about financial planning for your golden years, particularly around taxes, since we've got that April 15th deadline coming up. We're a month and change out from it right now.
Yeah, so a couple things that are worth noting. RMDs are one of the biggest causes of taxes in retirement. And there are some things that you need to know about RMDs. Some background. First, distributions from IRAs and 401ks are required. And those required distributions are different based on your birth year. So it could be 70 and a half, could be 72, 73, 75, a little confusing. But the thing about RMDs is that they're taxable income, and when you take it, it could bump you into a higher tax rate. You could go from 12 to 22, or 22 to 24, or 24 to 32%. So there are some steps you can take to avoid these adverse effects of RMDs. So one is to start thinking about doing full or partial Roth conversion so that you reduce the RMDs when it comes time for you to take these distributions. The other is to start drawing down before you reach RMD age, and that could reduce the RMDs when you get to RMD age. And then the last thing you can do is, if you're 70 and a half and older, you can take something called qualified charitable distributions, or QCDs, which are not taxable, and those are one way that you can at least avoid the adverse effects of RMDs.
Certainly. You know, another consideration here too is your premium management, especially if you have Medicare Part B. What do people need to know about that?
All right, so if you're enrolled in Medicare Part B, you're going to pay a monthly charge. It's called it's roughly on the order of $185 per month, and about 92% of Medicare Part B beneficiaries pay that amount. But if you have what's called a modified adjusted gross income that is above a certain threshold, you may pay anywhere from $259 per month to upwards of $628.80 per month, depending on your modified adjusted gross income, or MAGI as they like to say. So there are some things that you can do to avoid paying this extra surcharge. One is, if you're doing Roth conversions, you want to be mindful of the effect not only on your taxable income rate, but also on your modified adjusted gross income, because if you push yourself into a higher MAGI, you're going to pay the surcharge. If you're pre-RMD and 63 and older, you also want to be mindful of drawing down your IRAs, because one of the things that taxable income will do will also make your MAGI higher as well. And the last thing you want to be mindful of is this notion of, if you have a severance package or a bonus, or you're selling assets, that income could push you into a higher MAGI as well, and then increase your Medicare Part B premium. One last note about this, Brad, is there's a 2-year look back on Medicare Part B premiums. So in 2025, your Medicare Part B premium is based on your 2023 tax return, and your 2026 premiums will be based on 2 years look back from there, so your 2024.
Oh, wow. Okay, so let's talk about the entire reason why you saved up this nest egg, because you want to draw upon it. How can you best prioritize how to kind of disperse those funds and make sure that the money stretches over time?
Yeah, so one thing I will start by saying is, if you have access to a health savings account and you haven't yet retired, consider contributing it to that, because it's triple tax-free. The money goes in tax-free, it grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. When you're in retirement, you want to think about drawdown strategies. So what's the most tax-efficient way to do that? Take money from your taxable accounts first, then from your tax-deferred accounts, your traditional IRA or traditional 401k, and then from your Roth accounts. And the logic is that this allows the money in your tax-deferred account and your Roth accounts to continue to grow. You also want to consider tax-efficient investments. So if you're in a mutual fund, maybe consider using an ETF. And then if you need tax-free income, municipal bonds are tax-efficient as well. And then the last thing I'd mention is, think about account location, where you put the assets, which assets go into which account. So tax-efficient investments go into your taxable account, tax-inefficient investments go into your tax-deferred accounts, and then your high-growth potential investments go into your Roth.
It's a great breakdown. Bob, thanks so much.
Pleasure.
Good to see you. Coming up, everyone, egg prices remain a problem for most Americans' wallets. I'll speak to the CEO of Pete & Jerry's next about the outlook for the industry. That's coming up.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Members of Generation X, folks born between 1965 and 1980, aren't feeling stellar about retirement. In a new study from Fidelity, only around half of Gen Xers say they feel confident that they'll be able to retire on their own terms, with a third expecting they'll need to work in retirement to keep their finances afloat. Joining me now, we've got Rita Asaf, Vice President of Retirement Offerings at Fidelity Investments. Good to have you back on Yahoo Finance with us, Rita. Just first and foremost, as we think about these numbers that we just rattled off about Gen Xers, why is that they're feeling this way right now, and what's it most prominently tied back to?
Yeah, I mean, Gen X specifically has been the sandwich generation. If you think about that, they're taking care of their children, aging parents, and that is really at the forefront of the confidence drop. So you mentioned over half are confident that they'll be able to retire on their own terms. And this remains a bit of a concern for a number of reasons. One, we're starting to see a record number of Americans expected to reach traditional retirement age. So think of age 65 over the next decade. But on top of that, how you save for retirement has changed. This is probably, the current retirees are probably the last generation to have access to pensions for savings for retirement. And so Gen X really will be the first we call 401k generation who will be using that and other individual retirement accounts such as IRAs as their primary method to draw down from.
So as people are planning for retirement, and we're taking a look at some of the average balances in retirement accounts for 401ks and IRA balances for Gen X right now, how are we seeing Gen X plan for retirement in some of the breakdown of essential costs versus discretionary costs?
Right. So, I mean, this is where having a financial plan definitely helps, especially for that Gen X group that is really coming close to it. So over the last couple of years, they've been saving in various account types and overseeing their investment mix. But at this point, they really should be working more towards how will that retirement plan really be put into action. So think about essential expenses being covered by guaranteed income sources that keep up with inflation. So think Social Security or annuities. And this is what's really important, because if you think about what's happening in the market today, having these guaranteed income sources will help you, whether any sort of investment mix. So that's one. And then secondly, you want to continue to have discretionary expenses covered by savings or investment income. And that way, if there is a market downturn, you can cut back on spending without hurting that day-to-day living expenses that you have.
Rita, you provided us with a hack here, and you mentioned HSA specifically, these health spending accounts. Why is that?
Well, the biggest costs in retirement are healthcare costs. So we in our research have found that an average individual who's retired is going to need about $165,000 for healthcare costs in retirement. And one of the best ways to combat that is not just the planning, but also HSAs. HSAs are one of the most tax efficient vehicles that are out there. The money goes in tax free, the earnings grow tax free, and then they're withdrawn tax free if used on unqualified medical expenses. So they are a very strong tool. However, you do have to be enrolled in an HSA eligible plan to take advantage of that. So it is a feature or factor to be considered as part of your larger healthcare planning in retirement.
All right, the health savings account. Who knew? Rita, you knew. Thanks so much for breaking this down for us.
Thank you.
Appreciate it. Let's do a final check of the markets here as we're taking a look at the major averages. We're still seeing the Dow down by about
News when you want it with Bloomberg News Now. I'm Nathan Hager. The stock rally has moved in reverse with trade tensions back on the front burner.
Today, I am announcing that the Government of Canada, following a dollar-for-dollar approach, will be imposing, as of 12:01 a.m. tomorrow, March 13th, 2025, 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
Canadian Finance Minister Dominic LeBlanc made that announcement on nearly $21 billion in American imports. It comes after President Trump made good on 25% duties on steel and aluminum from around the world. The European Commission announced its own retaliatory tariffs overnight. Mexico says it'll wait to retaliate until it sees what policy is unveiled on April 2nd, when President Trump has promised country-by-country reciprocal tariffs. But the retaliatory moves have taken the shine off a stock rally that followed the latest read on inflation. Consumer prices rose just 0.2% in February. Economists were looking for 0.3, so cooler than expected. But Moody's Analytics chief economist Mark Zandi says the Fed may be asking,
what do you do with the tariffs? I mean, it raises inflation, it weakens growth, so how do you respond? And they're saying, well, we don't until we get some clarity, any kind of clarity around what's going on and how it's all going to play out.
Moody's chief economist Mark Zandi was on Bloomberg Surveillance, and as it plays out, the S&P 500 right now is little change to the downside. The Dow Jones Industrial Average is lower by 0.7%. The NASDAQ Composite had been as high as 2%. Now the gain is 0.6%, and the 10-year Treasury yield is up about 2 basis points, close to 4.3%. The ball is in Russia's court. That's what Secretary of State Marco Rubio is saying after reaching a 30-day ceasefire deal with Ukraine in Saudi Arabia.
Here's what we'd like the world to look like in a few days. Neither side is shooting at each other. Not rockets, not missiles, not bullets, nothing, not artillery. The shooting stops, the fighting stops, and the talking starts.
Secretary of State Rubio says the proposal will be presented to Russia today. Sources tell Bloomberg News Russian President Vladimir Putin is likely to drag out agreeing to a ceasefire as long as he can to get the most favorable terms. Bloomberg's Greg Sullivan has more on that from Dubai.
This ceasefire deal that was agreed to between the U.S. and Ukraine does not meet any of Russia's previous demands or what they've staked out as conditions for some sort of truce.
Bloomberg's Greg Sullivan reports Putin might demand a halt to weapons supplies for Ukraine as one condition. President Trump has said he could speak to Putin about the deal as soon as this week. House Republicans have approved a stopgap spending bill to avert a government shutdown at the end of the week. Now it goes to the Senate, where Bloomberg Government's Jack Fitzpatrick reports it takes a supermajority of 60 votes to pass.
It's probably going to be close to that 60-vote threshold. There's no guarantees it goes through, but the deadline is Friday night, and there's not a viable alternative plan, at least yet. So there's a lot of pressure on Senate Democrats to get on board or to figure out how they're going to message a government shutdown.
Bloomberg Government's Jack Fitzpatrick says so far Pennsylvania Democrat John Fetterman is the only one who said he will vote yes. Another Senate Democrat has made a decision to retire. Jean Shaheen of New Hampshire says she will not run for re-election next year.
While I'm not seeking re-election, believe me, I am not retiring. I am determined to work every day over the next 2 years and beyond to continue to try and make a difference for the people of New Hampshire and this country.
Jean Shaheen posted that announcement online. She is the third Democrat to make a decision like this. Right now, the party has a 3-seat minority in the Senate. Back on Wall Street, shares of Intel are higher by 3% on a report from Reuters that Taiwan Semiconductor is pitching a joint venture to run its factories with NVIDIA, Advanced Micro Devices, and Broadcom. NVIDIA shares are higher by 5% right now. Taiwan Semi is up 3%. Tesla shares are up 6%, leading the Magnificent Seven right now. The EV maker had its biggest drop since September 2020 on Monday, wiping out its gains since President Trump's election win. And iRobot, the Roomba vacuum maker and former Amazon takeover target, is down 35%. iRobot says it's exploring its options, raising substantial doubt it can continue as a going concern. That's news when you want it with Bloomberg News Now. I'm Nathan Hager. This is Bloomberg.
Influenced by everything from geopolitics to production decisions to economic cycles. Betting on short-term moves is a losing game. Instead, the smart money follows the bigger trend. And that trend is simple. Oil isn't going anywhere. Despite the push for renewables, the world still runs on fossil fuels. AI data centers, global manufacturing, and infrastructure projects all require massive amounts of energy. The idea that demand is collapsing just isn't really supported by reality. At the same time, the U.S. is now a dominant energy producer. Every time oil prices rise too much, American producers step in, increasing supply and keeping a lid on prices. This isn't the OPEC-controlled market of the past. There are more players now, and that means more stability, more supply in the long run. So what do investors do? Stop trading oil like it's a lottery ticket. Instead of chasing price swings, focus on companies built to thrive in any market. Refiners, pipeline operators, and energy firms with diversified revenue streams. These are the names that create long-term value, not just short-term spikes. The bottom line? Oil is about understanding the structural forces at play. Build a thesis and then execute. Now, I want to introduce my next guest, Lou Bassanese. Lou is a seasoned Wall Street veteran with over 25 years of experience, spanning the gamut of private and public markets investing, research, wealth management, investment banking, and investor relations. He currently serves as the Executive Vice President of Market Strategy at Prairie Operating Company, is a NASDAQ-listed stock, PROP, and one of the country's only high-growth, low-cost, independent oil and gas companies. He's also the founder of thebigskinny.com, a no-nonsense research firm that bridges the gap, the information gap between Wall Street and everyday investors to identify the market's biggest and most profitable trends and tech investments. He frequently shares this market analysis and investment strategies with major financial outlets, including Fox Business, where I get to appear with him on occasion, Fox News, Reuters, and Yahoo Finance, and here we are in this podcast. He holds a BA from the University of Florida and an MBA from the Crummer Graduate School at Rollins College. He currently serves on the board of directors for Endra Life Sciences, another NASDAQ company, NRDA, and the Roberto Clemente Health Clinic, while also lending his expertise to the advisory board of the Headstrong Project, one of my pet projects. His diverse role reflects his commitment to both business excellence and philanthropic efforts. Please help me in welcoming Lou Bassanese to the show. Lou, it is a pleasure to have you. Thank you for joining me.
Good to be here. That intro should have just said I'm a paisan like you, and that's it. We're good to go.
Here we are at the New York Stock Exchange. Yeah. It's home for me, and so thank you for joining me.
Good to join you.
So I want to talk to you first a little bit about your history. So tell the audience, just give the audience a little bit of between research and now you're in the energy space, which is all very interesting considering that we're talking about it.
Yeah, so I've pretty much done it all. I started out in Morgan Stanley's private client group and then got into the independent research space, really focused on technology and small and micro cap companies, because I believe firmly that that's the last place where individual investors have an edge over Wall Street, right? So spent tons of years there focusing on technology, and that's underpinned by patents, and started my own research firm, built some publishing businesses, and in all that, I ended up, and like you said in your energy piece here, finding out that it's best to bet right now on the long term for oil. So I find myself at Prairie Operating Corp, which is one of the only small cap growth oil and gas companies.
All right, so talk about it. Give us tell me a little bit about it, because I don't know anything about the company.
Yeah, so this company was started by industry veterans that realized 2-3 years ago that the pendulum had to swing. It had to come back to sensible energy policy. We couldn't go 100% renewables. It's not sustainable. There is no real energy transition. It might be a rebalancing. So they started acquiring assets in the DJ Basin, which is in eastern Colorado. That basin had been largely consolidated during the last boom. So what you have is two majors. You have Chevron and Occidental, and then a lot of private, small mom and pop, small parcels that could get aggregated and rolled up. So that's exactly what they're doing.
Is it oil? Is it gas? Is it both?
It's oil. It's mostly liquid. So about 70% oil. It's direct. It's one of the cleanest molecules. It actually gets a premium down at Cushing of about $1 to $3 a barrel because of the gravity. So this is a good old-fashioned American growth story.
But is it different from where those Shell and who'd you say they're the Chevron?
So Chevron and Occidental. So we're actually adjacent to their properties here. So this is the play where we're not going out and exploring in unproven areas. We know that there's production there because of the majors.
Right. So this is what always interests me. So explain this to me. If you're here and Chevron's right next to you, right? Because you're right next to each other, and you're both drilling you're both drilling the same well?
Well, you're drilling in the same reservoir, right?
Same
the basin.
reservoir.
So, but remember, we're not just drilling down anymore, right?
Right.
We're going horizontal. And this is where people are like, why are you a tech guy now with an energy company? Well, I got news for you. Energy is all about technology.
It's all about technology.
We're going 2 to 4 miles laterally drilling using 3D imaging to steer a drill bit in ways that was never possible before.
Right.
I mean, you go back 15 years ago, the first horizontal drilling that happened, and you were really tapping maybe 2 to 3% of the reserves that were in that reservoir.
Right.
Now you're double and triple that because of the advances in technology.
And so tell me about the reserves in that reservoir.
Yeah.
What's the estimate how big they are?
I'm not sure. So we're in the middle of an acquisition that would put us at about 29 to 31,000 barrels a day of production.
Right.
The original vertical wells that were drilled in this basin were back in the 60s and 70s. So it's proven ground. It's not like expanding somewhere where the operators haven't been before.
Is that level of production, has that increased? What were they producing last year?
So this is a roll-up strategy. So right now we have 7,000 to 8,000 barrels a day, now going to 29 to 31,000 based on this acquisition. So this is about growing organically through the drill bit, but then also through acquisitions. I mean, remember the late great T. Boone Pickens? He said sometimes it's easier to drill for oil on Wall Street, right?
Yeah.
Just go acquire it instead of go drilling it all. So it's a combination of that strategy. And here's the arbitrage. We're able to pick up this latest acquisition at 2 times EBITDA. So on the cheap, and bring it public at where things are trading around 3.5 to 4 times. So it's really a value play, a growth play, which is what attracted me to it, with the tech and put all those things together.
All right, so I'm curious because I think that the average price of what it costs to produce oil in this country, or at least what I think it is, about $40 or $45 a barrel. Am I right?
You're right. It depends on the basin, right? So if you look at Permian, it's probably on the lowest end, around 42, 41. The DJ Basin's right there. It's the mid 40s to like 43 to 45.
So West Texas Intermediate has come down nearly 10%. Since Trump's been in office. Right now, not because he's been in office, it's just come down since he's been in office, but there's a lot going on. Certainly the non-OPEC producers, would be U.S., Mexico, Canada, are producing more. You've got the Saudis who, clearly can produce all they want, who are holding back.
That's the question.
Well, I don't know. Let's talk about that.
And that's the dirty rumor in the market is, do they have the actual production that they say they can? We're going to trust them, right? But it's like the old saying, like, trust your mom, but cut the deck, right? Like, we're never sure. So there's a tenuous balance because you have strong demand. There's not really an easy way to increase production. I mean, the U.S. is producing 13 million barrels a day, right? Record.
Which is a record.
Right. So,
but the Saudis, they're holding back on production. They're actually teasing about raising production in April.
But they need to hold back to keep prices stable, right? If they flood the market, I mean, they need a higher break even. They have a much higher break even than most of the U.S. operators. So I'd argue that it's a tenuous balance because, look, if President Trump wants to put sanctions on Iran, that can take 500,000 to 750,000 barrels a day off the market. Where are you going to make that up immediately? Saudis, maybe. U.S. production could get there, but that's why you're seeing the price volatility is, as you said, in one hand, it's a supply and demand, right? It's a supply threatening taking supplies off. Will you get more? Then it's demand. We go into, are we in a recessionary environment? So,
right, but tell me something, because you made a comment that I'm curious about. When you said the cost of production, I thought the Saudi cost of production was like $9.
Yeah, well, I mean, again, it's like Chinese math, right? Well, do we have transparency here? I mean, how many financial statements do you trust from China? I mean, I'm just being honest.
I trust nothing from China.
Right.
Let's just say right off the bat, I trust nothing from China.
Right. So you're trusting an organization and a country that, there's no motivation to be transparent. It's like verbal intervention from the Fed, right? It's an effective tool that the Fed's used for decades.
Right.
Saudis can use it too. OPEC can use it too. We're going to increase. We're going to pull back production. You really, where we're at right now is a sweet spot, $70 to $80 a barrel.
I would agree that is. Although the Saudis, along with Qatar and Iraq, I think they need prices to be north of 80 to just pay for their quality of life and their infrastructure and all the things that they do. Now, it's certainly not trading there at the moment. They want to see it trade there, but I don't think it's going to trade there.
I don't think so either. I mean, look, you talked about the pullback since President Trump's taken office. We're basically back where we started. Right. I mean, 2023, 2024, we saw maybe a 10, 15% rise in oil, and now we're just coming back to that.
But I don't think, it's so funny because one day the news will tell you that, it's about demand destruction and waning demand, and then the next day they're going to tell, China's back, and so demand is strong. I think demand is strong. I don't listen to any of it. I don't think demand is going away. I think it's clearly a supply issue. We have a lot of supply.
I agree. So, and I think what the balance in the market's trying to figure out, right? Like now we're realizing that this energy transition move to 100% renewables is not happening. So that's going to keep demand stable. Now we get into the question is how quickly can we bring new supplies online? And if you look what happened, the majors are in a capital discipline mode right now. They're not in rapid expansion. They're going, let's maintain the balance sheet, pay out stated dividends, because what people don't realize is when you frack a new well, it depletes those reserves 50 to 60% in the first 2 to 3 years, right? So if you start expanding, you have to commit to keep expanding to maintain that level of production.
Well, so is what you're doing in Colorado, is that fracking?
Yes, yeah, it's fracking.
It's fracking.
Yeah, so it's fracking and horizontal drilling, right? So it's what's going on in the basin and has been right now. That, like I said, that basin started being drilled in the 60s and 70s, traditional vertical drilling. Yeah. Now what you're doing is fracking and horizontal drilling.
So fracking, so because then explain to me or clear it up for the listener. Fracking versus just drilling.
Fracking, you're going to go in and split and open up the layers of shale. It's a different geology of the rock. So you're trying to get to those reservoirs, and you have to pump liquids down to open up to release,
break up the rock
to release
to
the
get
oil.
in there.
So traditionally, most basins like the Permian are very liquidy. You got to pump down a lot of water and a lot of sand to get the oil out. The DJ Basin is much less so that way. So it's minimal water and minimal sand compared to some other basins.
Right.
So again, it gets back to this is one of those areas, an untapped resource that hasn't been exploited as well as some of the, and it's not trading at premium valuations like you see in the Permian.
Okay, so are the other independent producers like prop, not so that it's it is independent.
Yeah, it is independent. Yeah.
Are there other publicly traded independent producers?
There are. There's a couple other names out there. Civitas is one that's out there. They are actually straddling both the DJ Basin and the Permian. They're actually actively and publicly looking to divest some assets to focus more on Permian. There's about 7 or other players that are in that basin that are meaningful. Not all publics, mostly private, and then you have the Chevron and Occidentals.
So is that an opportunity for if they're looking to focus more on Permian and get out of it? Is that an opportunity?
It is, right. So we have a $1 billion credit facility set up with Citi that we're leveraging now to make this $600 million acquisition. There's more capacity and there's probably more opportunity to do that. And that's why I say this is why I went long-term on oil by saying, look, this is not necessarily a refining play. This isn't a pipeline play. This is a long-term demand for oil and gas. Can you roll up? Can you grow from a small cap to a mid cap to a mid to large cap and then get taken out?
Because prop right now is a micro cap or what is it?
It's right at it's a small cap, right at that $300 million.
It's right at the
post this acquisition will be about $1 billion enterprise value. So right in the sweet spot of the small cap market.
And what's it trade at?
It's trading right around $8 per share.
$8 per share. Yeah. And so it sounds like certainly an interesting opportunity. But
look, do your own research, though.
Do your own research, right? I'm not telling anyone to go out there and buy it or sell it. You got to do your own research.
I'm heavily conflicted, which is okay. Someone told me one time conflicts of interest are a really good thing. They tell you where your allegiances lie.
Yeah, right.
It's true.
Right. So listen, let's talk about this AI conundrum. With the major tech companies spending more on big oil, during the last boom, investors are really coming up with kind of dry investing ideas outside of the usual suspects like NVIDIA and Microsoft and Palantir and all that stuff, which, by the way, are great.
They've done amazing.
They're actually on sale at the moment, but they're great names. Palantir, I think, is down again today. I have to actually I didn't look at it I heard it was lower again today coming in, but I think that's actually a long-term opportunity. Anyway, so where do you think investors need to be looking?
Look, I think everyone's captivated by AI. If you missed NVIDIA and the thousands of % run up, you're going, I want that.
Right.
Not going to happen again with NVIDIA. So I think you have to focus on a separate area of the market. If you look at NVIDIA, Palantir, even an AMD, they're pick and shovel players, right? I think you need to move, and DeepSeek showed this. That type of AI, chips and services, AI services, is a commodity.
Yeah.
It's going to be a commodity. You need to find solutions. So find companies that are going to leverage AI to improve their technologies or solutions.
Okay, but can't you, so then use that reasoning. Can't you really say that's across the sector? Because every company in every sector is using AI to improve.
Correct, but who's using it to the most, right? So I look at it this way. A good example would be drug discovery, right? A typical cancer drug takes 12 years to go from conception to approval in the market.
Yeah.
Those early studies, the first 2 to 3 years, can now be compressed into weeks in some cases by studying receptive sites for a drug, for a small molecule, by studying the chemistry of how these proteins will interact.
Yeah, but wasn't the whole point, don't you need time to actually study that?
No. So it was basically a trial and error. Hey, we think this molecule will interact this way. So now we can use machine learning and AI to say,
it'll tell you
hey,
that doesn't work.
It'll run through this. Or more importantly, there's a company out there, Lantern Pharma. It's a small cap, it's speculative. But what they've done is they've built an AI database of clinical data points, drugs, over 4 billion data points that can look and say, hey, this drug didn't look like it did well in humans, but if we separate out these two different populations and combine it with over here, this is actually an effective and safe drug. So you can use machine learning and AI to take actual human data that we have and efficacy to find drugs that we couldn't have found on a trial and error basis.
Yeah, that's interesting. And I know drugs and biotech is another area that you spent a lot of time in.
Yeah.
Right? That you did a lot of research on. Wasn't that one of your research
it's one of our focuses. I always saw that as an area that, Charles Payne always said to me, he avoids biotech because it's just too confusing.
Right.
It is, right?
Right. But you spent a lot of time.
But my background was a generalist first and then become a specialist when there's opportunity. And if you look, biotech is one of the places in the market where you can outpace inflation by multiples if you pick the right winners.
Right.
So but that's hard, right? You got to learn science.
That's why you got to do your homework.
Right. So I spent a lot of time understanding. I have a medical background coming out of pre-med, was always fascinated by it, but then got captivated by Wall Street and said, forget medical school, let me invest in medical things.
Listen, let's just take a break. Give me 1 minute. We'll be right back.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a better investor and a smarter leader. Before we get to our featured interview for today, have to do our stock of the day. Let's throw up that 1 minute timer clock. My stock of the day is in fact Tesla. Every day this company is in the news. Shares are down 45% year to date. Investors awake today to see photos floating around X/Twitter, whatever you want to call it, of President Trump getting inside of various, I think it was a red Model 3. I guess he was playing the Republican red vibe there in front of the White House with Elon Musk yesterday. There's a lot of concerns on Tesla's business. That's why ultimately the stock continues to go down. Sales overseas under pressure, sales in the U.S. under pressure. Morgan Stanley, longtime Tesla bull Adam Jonas out with a new note saying that there could be some catalysts coming up for Tesla stock, notably a potential robo-taxi day in a few weeks, a potential day where the company also talks about its Optimus robot. That's all fine and good, but I'm here to say what will get Tesla stock rocking again, or at least not going down in the tank anymore, is sales. It is that next earnings report when Tesla reports in late April. This company needs to get on that earnings call. Elon must say that sales are not going down anymore. There is stabilization. Things are getting better, especially at discounts are starting to hit on these Tesla products. Until he does that, it is very likely that Tesla shares will continue to be under pressure. And I'm out of time. That's why we have the 1 minute countdown clock. But let's keep talking about stocks and markets more broadly. Penny Pennington is here, Edward Jones, CEO. Penny, good to see you and finally meet you in person.
Thank you, Brian. Great to be here with you and your audience.
So I'm not going to ask you about Tesla, but I am going to ask you about markets, because investors are seeing, I think, a lot of turbulence that they were not used to last year. Mm-hmm. Everyone thought, well, stocks only go up and to the right. You and I both know that's not the case. What are they seeing today in markets?
Well, you were right where you started. We've had a couple of pretty sanguine years. And years where we didn't see the usual 2 or 3 pullbacks of 5 to 15%. That's a very typical thing to happen. And so in a moment where we've got uncertainty from policy and tariffs and things like that, the markets are reacting. It was to be expected. And so investors are reacting. Families who have great financial plans put together are saying, okay, do I need to flex my plan? How do I need to think about this? And that's what our financial advisors are there to do, is to help them scenario plan around this uncertainty.
What are they telling those folks, those families that are now opening up their 401ks and wait a second, this isn't what I expected. I had a great past few years in markets, and now, wow, I guess I'm worth less on paper.
Well, one of the things that we would be saying is, we told you this was probably going to happen at some point.
We didn't want to believe it.
That's exactly right. That's exactly right. So what we say to investors is, let's put in place a plan. And a good plan is better than a bad prediction. Let's put in place a plan, diversification of our investments, balancing multiple goals, ensuring that we are controlling what we can control. The way that we save, the way that we invest, what we borrow and when we borrow, and then flexing that when we need to. Right now, as it relates to investment management, we're being rewarded for diversification in this moment, where a while back, why would I own a bond?
No, you just want to own the top, the Mag 7, call it a day,
exactly.
And get your money and get your Lamborghini.
Why would I invest in European stocks? Diversification really, really works. It works in the long term, and it works in times of uncertainty. So when the market is broadening out, becoming more defensive right now, rotating very quickly from those Mag 7, the promise of diversification really plays out right now.
How does it feel like to you? We've seen various major indices correct. We've seen, I mentioned Tesla top of the show. These stocks have really had some major pullbacks. Mag 7 has lagged. Does it feel like this is a rolling correction and it can get worse, or things feel or look wiped or washed out to you?
Let's go back to where we were before this level of uncertainty began. Interest rates were actually at historic levels. A 4 handle on the 10-year Treasury is historically average. Inflation was coming down. We weren't quite at 2%. We'll find out today about the CPI report. Employment is very strong. Consumer spending is robust, and corporate leaders were ready to invest. Now, the reason that I say all that is that's a pretty sanguine view. That's a view of a fairly strong economy. What we see today is that the economy is probably downshifting just a little bit from that level of strength. This uncertainty is forestalling consumers making decisions about new home purchases or renovations or new cars. Corporate leaders are in perhaps a bit of a pause mode right now. I think everything has to do with how long that lasts. If that lasts and becomes a foregone conclusion, while we do not predict a recession, we do expect growth to be pulling back. But the key is we started from a position of strength.
Isn't it? I'm hearing a lot of folks start to talk about recession. I talked to one economist last week, and they said we are in a recession. Do you see signs that we are? Not at all.
Well, that's the thing. You never know you're in a recession until afterwards, right? We don't see that we're in a recession right now, and we don't believe that we're going into a recession. The labor market is strong. Consumers are still spending. Frankly, our investors, our clients are spending at higher rates than they were the past several years. So we see them using the wealth that's been created over the past couple of years. But beginning that pause of, well, I think I'll just wait for a few months until things calm down. And if that begins to cycle for a longer period of time, that's then what sends us into a much lower growth mode.
What have you seen clients rotate into during this turbulence?
Yeah, well, hopefully they were taking our advice all through this.
I'm sure they were. I'm sure they were.
So Brian, you know how that conversation sounds. We'll be talking with a family, and they'll say, "Why am I not making what the S&P 500 is making? Why haven't I done 20% the last 2 years?" And we remind them that when you do that, you're taking a fair amount of risk, and perhaps the risk tolerance that they shared with us and the goals that we put in place together did not require that they take that much risk. And so in this moment, our clients are saying, wow, I'm not down. I don't feel quite as bad as the headlines are trying to make me feel. I'm not down quite as much because our clients were diversified. They were diversified with fixed income, with equities, with international equities, and hopefully a broader array of equities beyond the Mag 7 here in the U.S.
Yeah, fist bump Edward Jones.
There you go.
I mean, that's some good work there. Are you surprised? You've been doing this for a bit. That everybody just owned the Mag 7, and they still do. While these investors in the Mag 7, they love these names, and they've seen them lose a large amount of value this year, they're still holding on to them. I mean, what do you tell people like this?
Well, that's part of diversification. You want to look for investments that are momentum investments that are growing with the trend. Those technology companies are leading the trend associated with technology and the promise of artificial intelligence. Those are great names to own. But Brian, before the broadcast, you and I were talking about being in this business just before the technology bubble burst in 2000. People owned the promise of the internet and the Internet of Things at that time, and they were rewarded for that promise. The issue is to over-own those things is taking far too much risk for most families and most investors.
Has a bubble burst? In the Mag 7, I mean, to see Tesla down 45%, Microsoft down double digits, or is this just these stocks letting off some steam?
You're probably better at making that assessment than I am. These are great companies who have built a franchise and have new ideas, innovative ideas, talented people. They are chasing and leading the promise of technology in intersecting with our lives, with business, in different ways than we've seen before. I wouldn't bet against them. I just wouldn't own 80% of my portfolio.
That's a good point. It's hard to bet against NVIDIA. I mean, you read their annual report. I guess you can understand what they do. I mean, but this company is like leading in chips. What do you tell, we'll talk more about this after the break, but what do you, I imagine in your position, you talk to other leaders, other high-ranking executives. What's their biggest concerns with how policy is shaking out so far in the first few days of the Trump administration?
What we have to remind ourselves first is to step back and take a breath, lower the temperature. We knew that this administration was going to pursue policies and approaches that were different, that they probably were going to pursue those rapidly, and that there would be a period of change and maybe a little uncertainty. The trick is when we get into that, we forget that we knew that that was going to happen. And so that's why we've got to slow down, step back, take a breath. We are all waiting for a little more certainty and hoping for a little more certainty around things like tariffs. We got some good news last night that it looks like we're coming to reconciliation across the houses of Congress associated with averting a government shutdown.
It's a good thing.
That's
we'll
a
take
good
it,
thing.
I guess, in this climate.
Yeah, that's exactly right. That would be one more level of uncertainty that we don't need right now.
All right, hang with us, Penny. We're going to be right back on Opening Bid.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
All right, welcome back to Opening Bid. Having a fun chat here with Penny Pennington, Edward Jones, CEO. There was a big expectation coming into this year that regulation is going to be rolled back, companies were going to do great. And I think to your position, you're on the board of FINRA. Have you heard anything about regulations let's say, in financial services being rolled back? And if not, when could these things happen? Because I think financial stocks have run in anticipation of that happening, but I haven't really seen any of that so far.
Yeah. Well, the promise of deregulation was also one that this administration put forward during the campaign season. That deregulation across a number of different industries is something that that corporate leaders and investors felt that there was promise for. We talk a lot about sequence of returns, right? The sequence associated with how the administration would pursue their policies was an important conversation. Would tariffs and cost-cutting government efficiency come first, and then later the promise of deregulation and tax cuts? Or would that be flipped and we would see the promise of deregulation impact the markets positively and a pullback that might be created by tariffs happening later in the year? It's pretty clear what the sequence is. The uncertainty associated with tariffs and cost cutting is impacting the markets more right now. So all of that is to say that deregulation is a market-friendly, a market-desirable stance for the administration to take. And that's going to occur across a number of industries. You really focused it on financial services. The financial services industry has helped Americans. We're a North American company, has helped North Americans establish, build, grow, and pass on wealth for generations. The root of that is growth and innovation, funding new ideas. Our financial services industry and the regulators who regulate that industry try to keep that in balance with protecting consumers and making sure that things don't get out of control. There are some who felt that balance was wrong for the past several years. So as it relates to financial services deregulation, take a look at banking regulation. Conversations around how our banks and financial system are regulated in a way that protects consumers and makes that a sound and safe system. As it relates to the brokerage and investment advisory business, our regulators are in conversations about things especially like cryptocurrency, who should hold that and in what forms, conversations about the innovation around AI and how it can be used for growth and innovation, but also used in sound and responsible ways that are good for the American investor.
Is it, what you mentioned crypto, and that's the one area where we've seen deregulation to some extent. Is it a sound and responsible thing that we have a Bitcoin reserve? Is it a sound and responsible thing that, Edward Jones clients could diversify into an asset that it's just out there somewhere in the sky? You can't see, feel, or touch it.
Yeah. Well, Edward Jones investors can't invest directly in crypto.
Not yet.
Not yet. Now, we said a number of months ago, we wanted to watch this. We wanted to see what was happening in terms of the development of this market. I don't see crypto as an asset class. There is not a fundamental value that stands behind crypto. However, it is becoming an innovation in our marketplace associated with blockchain innovations and that kind of thing. That is a very real thing and will have a positive impact on our industry and on investors. It's a matter of determining the right way to go into those sorts of investments. And I'll get back to the way that we talk to our clients, helping our clients understand what it is. Now, many of our clients say, I want to be a part of what's going on. I want to understand this better. That doesn't mean that you need to invest in it. But understanding it better really is a very smart thing. It's going to be with us. It's going to be part of our financial system, I believe. And it will be the root of innovation associated with things that will become more mainstream over time.
How would an Edward Jones get involved in crypto? I mean, do you see that day happening anytime soon?
I don't want to front run our product review folks and our research folks. That the work that they do for the benefit of our clients is work that I am so proud of and admire a lot. I know that they're watching this very, very carefully. They're looking for places that it does make sense, packaged in the types of products that provide an easier experience for clients. One of the things that I think we've got to be really thoughtful about is clients have an expectation of an experience in an investment management product where they know, for example, that they can get in and out very quickly. That liquidity is there for them, that the price is discoverable and somewhat predictable based on cues that they can see or movement in the market. As I described those things, Brian, you probably are ticking off crypto, for example, against that, or private equity or private credit, for example, and saying, you know, that's quite different from a client experience, liquidity, predictability, price discovery. Those experiences that clients have with a particular asset class or a particular kind of asset are something that we're very thoughtful about as well. And the reason that we're thoughtful about that is that we help clients have an easier ride in the investment markets. Now, that doesn't mean that anybody is promising up or down at a particular level, but the point is to give clients some certainty so that they can take a look at their risk appetite, at the goals that they're setting medium and long term, and have some sense of predictability about the ride they're going to have in the investment markets.
When I think Edward Jones, I think financial advisors, of course. I think longer term wealth building and investing. And that's where we are going to come up here with our hot take. We always love to ask this at the end of our interviews. How do you think the transfer of wealth from boomers to millennials, like myself, yes, I see you out there, my parents, I know you always watch Opening Bid, so this is coming at you for this. How is that going to impact markets longer term?
So the statistics say there's $124 trillion of assets that are going to transfer from the generation who owns them today to the next 2 generations over the next 20 years or so.
That's a lot of assets.
It's a lot of assets. Here's a remarkable, I love that you just shouted out your parents. Here's a remarkable piece of research. 50% of Americans, one way or another, are going to get something in this wealth transfer.
I don't think I'm getting anything, but just keep going. I'm sorry.
So they'd actually not get anything than to have to talk to their family about it.
Yeah.
This is a fraught conversation. It's awkward. Do you talk about this at the Thanksgiving table?
You're really in my head, because I was actually thinking about this a week ago. No, I don't want to have this conversation, in part because it's uncomfortable, but I don't want to know the answers. I don't want them to tell me that you're not getting anything because you didn't take out the trash at age 5. I just don't want to hear it. I don't even want to put in that position. And it's morbid, let's just be real.
So this is where a great financial advisor comes into play. They take a little emotion out of this with a family. They describe to a family, you don't have to talk about the dollars and cents, and you don't have to go all the way back to your chores when you were a teenager. What's important in the conversation today is to talk about the legacy that a family is leaving, how they develop those assets, that wealth, what they were thinking about their relationship with money. Teaching the next generation, even people my age, your age, about this is part of family legacy. And that's what we are seeking to do with our clients and our families multi-generationally. We serve 4 or 5 generations of investors at a time today, and helping them move through this process as a family is a very, very rewarding thing for us to be able to do. In fact, it's a privilege. Now, what is happening with this wealth transfer is the face of those who hold that wealth is changing dramatically. Their values, their experiences, how they develop their relationship with money, the kinds of things they want to invest in. And so firms like ours, great firms like ours, are working to stay ahead of that, to really understand what you desire, what the next 2 generations of investors expect and desire. we want to help them form great plans associated with their long-term hopes and dreams.
Well, I will just say this to my parents watching. I expect nothing. I would like some photos, and don't give me any debt. So let's leave it there. Penny Pennington, Edward Jones, CEO, really nice to see you. I mean, it's just really, look forward to staying in touch.
Thank you.
And that's it for the latest episode of Opening Bid. Continue to hit us with those 5 stars on the podcast platforms. Podcast is blowing up. I appreciate the feedback, and hit us with those thumbs up on YouTube. Appreciate the feedback there as well. I always try to answer all of your questions. We'll talk to you soon. Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Howell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app. Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Howell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Time for Yahoo Finance's Market Minute. Tech leading a rebound as the Nasdaq pops amid a better-than-expected inflation print. Shares of Crocs seen a lift as the footwear company gets an upgrade out Loop Capital. The firm raising its rating on the stock from hold to buy, citing attractive valuation and expecting growth in the Hey Dude brand moving forward. Turning to Spotify, the company noting it alone paid $10 billion in royalties in 2024, more than any single company has ever contributed in 1 year. Music publishing payouts also hitting new peaks, surpassing $4.5 billion with double-digit percentage growth from 23 to 2024. And Groupon shares surging as it provides better than expected revenue for the fourth quarter and the full year rather. Fourth quarter revenue and operating profit also topping Wall Street's expectations. That's your Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the day. Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day, let's get you the 3 catalysts we're watching this hour. First up, we break down the market outlook following a better than expected inflation print. Plus, we'll look at how tariffs and the EU's retaliation could drive up inflation and consumer prices. And we'll check in on the chip trade amid pressure on the semiconductor sector. All those details ahead. Half an hour into the start of the U.S. trading day, let's get a check on the markets brought to you here by Tasty Trade. First, taking a look at the major averages, something we haven't seen in a few days here. Green on your screen. You've got your S&P 500 up about 0.5%, about 0.5% there. The tech-heavy NASDAQ taking up the majority of the gains, up about 1.3%. You've got your Dow under a little bit of pressure, down about 100 points this morning here. But let's flip the board over to the bond market because we're also seeing something a little bit new taking place there. Yields moving to the upside. Just a touch of a sell-off when it comes to your treasuries here. Perhaps we're seeing a little bit more of that risk-on sentiment movement into stocks off the back of that CPI print this morning, telling investors perhaps that the worst of inflation may be behind us. Investors certainly taking that as a positive when you look at the market action. But let's get our favorite risk-on, risk-off indicator in here, Bitcoin. And as you can see, it's up nearly 2%. Again, another symbol of perhaps a risk-on sentiment cementing in the market this morning. Well, President Trump downplaying recession risk despite the volatility that's rocked markets the last 3 weeks as parts of the economy begin to show cracks. Trump saying yesterday, quote, "I think the country is going to boom," and markets, quote, "don't concern me." However, our next guest says ultimately the net impact of Trump's policies on inflation will depend on whether weaker services spending outweighs higher goods prices. And in February, it's clear the disinflationary effect from softening services outweighed the uptick in goods inflation. Joining me now is Anna Wong, Bloomberg Economics chief U.S. economist and former chief international economist for the Council of Economic Advisors. Anna, you know I always love speaking with you, so thank you for making time with us this morning. I want to start on how you are thinking about the next inflation print we may be getting, which could indicate a little bit more of the inflationary impact of Trump's tariff policies.
Right. So in the next inflation print, we'll get half of March where the steel and aluminum tariffs would be in place as it came into full force today without much exemptions. And we are going to also get all these retaliation from EU and other and Canada on a whole bunch of other goods. So I think today's report kind of already gives us a flavor of what how tariffs will appear in CPI. We have seen a little bit of uptick in the prices of apparels and furnishings and things that are subjected to highly exposed to China so far. But in the next month, I think we're going to see perhaps more pressure on car prices as well. The seasonal factors for cars are not looking favorable for disinflation. So I think the story for March CPI would be that goods disinflation stalled, while services discretionary prices continue to come down as consumers pull back on spending.
Anna, what does that mean for the Fed?
Well, I think the Fed is not going to move as long as inflation expectations remain elevated. And we have seen in the inflation expectations data, there's a strong partisan divide in terms of this uptick. So I think what this means is that the Fed is going to cut only belatedly. And as a result, this tightening on financial conditions and the hurt on the real sector and the labor market will have to be far in advance before the Fed will begin to cut. This is risking a deeper downturn.
And Anna, I do just want to quickly break some news here for our audience. We have headlines coming in here that Canada's new reciprocal tariffs are going to begin at 12:01 a.m. on Thursday. Again, this continuation of the tit for tat between the U.S. and Canada. You're looking at a live shot there of a Canadian official speaking about Canada's retaliatory efforts off the back of those increased steel and aluminum tariffs. Anna, going back to you on this, I think this is indicative of part of what the market is struggling with right now, that this tit for tat for tariffs, it's unclear where and if it ends. How do you think that that impacts the economy? Do you think that that continues to lead to any slowness that could result in a recession?
Oh, so yeah, definitely retaliation by our foreign trade partner will show up as weaker economic activity in the U.S. For example, Canada's retaliation will disproportionately hurt U.S. Manufacturers. And later in the month, the EU also is about to reinstate a very large tariffs on U.S. bourbon, which will disproportionately hit Kentucky and the district under Mitch McConnell. So I think that all that will mean softer economic activities, and this is why I expect more pullback in discretionary services spending, which ultimately will be disinflationary. So in terms of recession, this R word, one important precondition for recession is we have to see a widening of credit spreads of around 200 basis points. And so far, we are maybe a quarter. We've seen maybe less than a quarter of that. And in order for credit spreads to really widen, you need to see more panic in the stock market, a bigger sell-off in the stock market. And I think we are not there yet. So a lot of this recession talk is based on vibes, and in terms of hard data, it's not really there yet.
Well, Anna, it's a great breakdown, but to your point, we have seen a little bit of that widening in credit spreads, not to the degree that you're mentioning, of course. I wonder how you're thinking about the impact of the labor market here. It seems like in the headline numbers, things continue to be okay, but there are cracks under the surface. What do you think could potentially be the breaking point for the labor market that could then hurt the broader economic picture?
Definitely. I think the good trigger would be a government shutdown this Friday. So the House has passed the bill for a funding gap bill, and it's now in the hands of Senate. And they're playing the game of chicken where it's all up to Democrats now on whether they want to sign off on the bill. And I think the risk for a shutdown remains to be very, very elevated. And if there would be a shutdown, then that would last for another month. Then we could possibly see April's unemployment rate spike to above 4.6%.
All right, Anna, also I lastly want to end with you just on how you're thinking about the market volatility and the selling that we are seeing as an indicator of the economy. At what point would the dip be significant enough for you to be concerned that asset prices could weigh on consumer wallets, consumer spending, and therefore the economy?
Yeah, so the sell-off will have to spread to a sustained period of elevated VIX, as well as a widening credit spreads of around 200 basis points, as I was saying. And we are not there yet. And the elevation of VIX has to also be sustained. And until that happens, then I think this temporarily confidence decline will will bounce back after they see better hard data.
Right. All right, Anna, thank you so much for breaking it down for us and reacting to that breaking news as well coming out of Canada. We really appreciate it. Well, stocks are mixed this morning following that better than expected inflation read for the month of February. But is one inflation print enough to ease market concerns about economic data and policy uncertainty? Our very own Josh Schaefer joining me now to discuss. Josh, it seems like investors think the Fed is back with a dovish vibe heading into the next meeting. Is that actually going to be the case? What are you thinking?
Yeah, so I mean, economists reacting to this report that I've been reading the research this morning sort of think this doesn't really change much for the Fed at this point, largely because you still need PPI to come tomorrow, right? So normally consumer prices and producer prices sort of equal a proper estimate for PCE, which is the Fed's preferred inflation gauge that we get at the end of the month. So you don't quite have that read through yet, but there have been some strategists, some bulls out there like Fundstrat's Tom Lee that have said the Fed put is still in and you need positive inflation data in order to have that. So the concept of the Fed put would be if we really are concerned about the economy and we see a weakening economy, the Fed would step in and cut rates, right? And the Fed would cut rates and that would help your swelling economy. The issue with that take has been, well, inflation's still well above the Fed's target. We're not seeing a lot of progress on inflation. Tariffs could be inflationary. So you combine all of that, and it sort of eliminates the Fed's ability to maybe help out the economy in that sense. So if you have positive inflation readings like this, it does bring it back into the picture, and it's definitely something that bulls are mentioning right now and bringing up as a potential case for what could help us rebound. But you just mentioned stocks now, where the market is open.
Right,
the actual indexes are mixed, right? After we just got some headlines about Canada reciprocal tariffs, and I think that speaks to perhaps the market's larger issue right now.
Yeah, it's interesting seeing that the tech names continue to kind of give us this lift this morning, but as we get these tariff headlines throughout the day, as we have started to learn, this has started to become a pattern that could start to weigh on equities. I wonder, Josh, how you're thinking about the number of price target decreases that we've started to see, the calls to go outside of the U.S. to European equities. Does the tariff picture start to matter more than the economic data points that we're getting in, or does the economic data still matter?
Yeah, so the strategists that I was speaking with yesterday in a story that's on our website right now from this morning all sort of argued it's the tariff picture, right? So there was a chart that Michael Kantrowitz from Piper Sandler had showing fiscal policy uncertainty soaring, right? So you're looking at this chart here, fiscal policy uncertainty is in green, soaring. What came right as fiscal policy uncertainty soared? Your major drawdown in the S&P 500, right? So in order for that S&P 500 to come back substantially, you'd probably need the green line to move lower. What actually moves the green line lower? Some level of understanding of what these tariffs are actually going to be, right? Something where we're not doing this every 2 hours, talking about reciprocal tariffs. Maybe we'll double these tariffs on Canada. I was just kidding about doubling the tariffs on Canada. Like the market is really struggling with that, right?
Yeah.
And I thought one thing that Jack Manley from JP Morgan Asset Management pointed out to me yesterday is it's about figuring out how to price this in, right? And it's very hard to price in U.S. tariffs just blanket, right? If we had just talked about 25% tariffs on Canada and Mexico, that's a challenging thing to price in for equity strategists.
Right.
But the problem is, you then have to price in how are these countries going to respond? Then how would the U.S. respond to these countries?
Right.
You can see how confusing this is getting, and it basically becomes an area of price discovery for the stock market that is just very challenged. And I think that's what you've been seeing with this up and down nature of the market on a daily basis is right now we do not have enough answers. Until we have enough answers, a lot of strategists are saying maybe nibble at this dip, but they're not that confident in full-on buying the dip until we have clarity on what the rest of the year could actually look like.
Yeah, what we've heard from a lot of our interviews this morning has been just wait for the dip to go down even more because there's no sign of certainty coming anytime soon, so why not just get it at even more?
It's a tough area to be confident right now, right? I think it's overall what the take has been.
Yeah, hard to have conviction with so much uncertainty. Josh, thank you so much as always. Really appreciate it. As we head to break, I do want to take a look at some nuclear power stocks on the move as Amazon and other big tech companies vow to triple their capacity here. You can see Oklo up about 2.5%, but Vistra, the biggest winner here, up about 6%. Constellation Energy also up about 3.8%. And it's really interesting to see these moves off the back of some of the pressure that we have seen in utilities more broadly. Here you've got Amazon, Meta, and Occidental among the initial members of the large energy group users here, which is backing a global effort that was announced in 2023, again, to triple the world's nuclear capacity by 2050. All of these stocks on the rise. You've also got Talon Energy, by the way, up over 8%. Morgan Stanley initiating Talon with an overweight rating this morning. We'll have all your markets action ahead right here on Catalyst, so stick around. It's now time for some of today's trending tickers, and for that, I am joined by Yahoo Finance Executive Editor Brian Sozzi on set. For our viewers, scan that QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Apple getting a price target cut of Morgan Stanley down to $252 a share from $275. The analyst citing Series AI delays as well as tariffs as headwinds for the tech giant. And Soz, I don't know about you, but I've even wondered, when can I get my AI iPhone? It is feeling like it's a little bit slower than consumers may have wanted.
What does an AI iPhone even do? Do we even know? Can we?
I don't know, but I want it.
But that's a big problem, because if we can't figure out what Apple Intelligence does and why we need to upgrade these phones, I mean, I think it says a lot about what Apple could be producing financially over the next couple quarters. Yeah. But shout out to this analyst, because I think this was something we were all looking at Apple. We've seen the stock weakness over the past month and a half. Yeah. What is the impact to tariffs on Apple that makes 70% of their iPhones over in China? Shout out to this analyst estimating it could be a $2 billion impact. What is unclear is how Apple will mitigate that. Do they move things out of China? Whatever it is, I finally like a Wall Street analyst putting a number behind the tariff impact. Shout out Morgan Stanley. You get some award from me today. Finally
putting a number behind, because it's hard to do that, right? Yeah. It's hard to suss out the impact of these tariff policies.
It takes courage, Madison, to put this in your spreadsheet.
Well, and it's changing at the minute. You know, we've been looking at tariff headlines all morning, so certainly something to continue to monitor across our slew of investments. But we're going to get you another ticker here. Palantir hosting its 6th AIPCon tomorrow. Investors expecting something big. Palantir shares jumping after the company's X account posted a 15-second tease for the event. The company's already announced a batch of new customers for its AI products, including Walgreens, AT&T, and Delta Airlines. Palantir is one of those names that has defied the broader market sell-off the last few weeks, up over 10% year to date, and Saw's continuing those gains after this clip that you are seeing on your screen right now, which led to a huge pop.
I guess that clip is supposed to make me want to buy some Palantir software.
Yes, it is.
The only thing I care about with Palantir, kind of like the only thing I care about with Apple on tariffs, is I want to hear from Alex Karp or anybody in his sphere. Why is he continuing to dump stock? Alex Karp, co-founder, CEO, dumped $2 billion of Palantir stock last year. I wrote a story on Yahoo Finance about a week and a half ago. When I wrote that story, Madison, he at the time dumped another $45 million. Now, I don't expect Alex Karp or his sphere to come out and say, here's why we're dumping stock, because I'm concerned about the long-term future. This will probably be another rah-rah event for Palantir. Maybe the stock will get a pop, maybe it won't, not sure. But anytime I see a top leader like Karp dump his stock after a big run like we've seen in Palantir last year and the early part of this year, it's just a red flag.
Absolutely.
I just don't want to see it.
Yeah, because the question is, what do they know that we don't know? They're an insider
and they
selling.
Always do. They always know something, Madison.
Right, he's the CEO, and you've done a great job, Sozzi, of utilizing the Yahoo Finance tools where you can also monitor these insider
Love
shares.
Love me some Yahoo Finance tools, Madison.
You're an expert at them. You're an expert. You are the best at the Yahoo Finance tools, Sozzi. You teach me a lot. Another stock, though, we got to get to here. Adobe shares ticking higher ahead of results coming out after the close today. The stock suffering after the company's last 2 reports among AI monetization efforts seeming further away than investors hoped for the company. You can see shares up a bit heading into that print. Adobe holding a digital summit next week where they are expected to showcase their AI development. Saz, I think it'll be really interesting to see if there is any weakness in this print. Do they try to stay away from it being an AI depression narrative and make it about the economic uncertainty that we're seeing more broadly? What are they going to blame it on if they do see a tough?
Well, I think this Adobe earnings report may be a little bit of a snoozer in terms of what information is going to come from the company. Historically speaking, anytime, at least based on my long veteran experience of doing this, Madison, when a company has an earnings day and then a week later they want to hold a summit or an analyst day, usually on earnings day that news is not so great, and that would just continue, I would say, a year plus drumbeat of just not good news for Adobe. Missed earnings expectations, sales estimates are coming down. And the vibe on the street, Madison, is this. What in the world does Adobe stand for in AI? What are their biggest bets? And that company has not done a good job the past year articulating what it stands for in AI. Why is it an AI stock? How is it going to better compete with an upstart like Canva? Until it answers those questions, maybe they'll put it out there in their digital summit analyst day thing. But until they do that, it's going to be hard to warm up to a stock like Adobe.
And not only Canva, but all of these AI-powered editing tools tools. When I talk to content creators, they're using CapCut. They're not paying $40 a month for Adobe products, and I think that's another competitive
I
force.
still can't figure out how to use CapCut. Is it just because I'm old? I mean, you can tell me. It's fine.
I don't
Sazi, you're old.
love,
It's fine.
you know, it's the fat fingers for me make it a little bit difficult. You know what I mean? It's a little bit hard to edit.
It's confusing. I just want to edit a video and get it out there on the internet, but just CapCut doesn't let me do that.
That's why you need AI. That's why you need the AI. You need it now to help you make the editing easier. Sazi, you are going to stick with us for a really important conversation that you're bringing to our show. Coming up, we've got the CEO of Charles Schwab. He's joining us here at the desk to discuss the market volatility and the rise of the retail investor. That's next on Catalyst.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Chip stocks climbing today as the overall market looks to rebound from the recent sell-off. Still, the S&P semiconductor ETF down more than 15% this year, amid investor concerns about AI demand and the impact of potential chip export controls. Joining me now with more, we've got Jonathan Krinsky, BTIG's Chief Market Technician. Jonathan, great to speak with you here. Let's just start on the context for our audience. What changed in the semiconductor sector to lead to some of the pressure that we have been seeing?
Well, good to be here. If you look at the semis, really on both an equal weight and cap weighted basis, they really were in a pretty wide trading range for most of last year, despite the AI hype narrative. And so as that was happening, the relative strength versus the S&P was beginning to deteriorate. And, relative strength often precedes absolute performance. And that's, clearly what happened. So you just didn't have any momentum or relative strength. And that led to a bit of a breakdown, with the broad market in the last few months.
Yeah, and I know that you look at the technicals as a CMT. What might be a level or an indicator of a bottom being hit that could lead to some more movement to the upside in chips?
Yeah, so we've been looking, both in semis and across the broad market, some downside exhaustion levels. Obviously, there was a lot of eyes on the 200-day moving average for the S&P. We felt there was maybe too many eyes on that, but then the second break, we think probably is more a better buying opportunity, which is where we're at right now. You're starting to see some elevated capitulatory signals on the volume side, on the put call ratio. It's certainly not levels that we've can't go higher or can't get more oversold, but I think we're down 9 or 10% from the highs. If you're looking for an opportunity for a trade, I think this is the entry point. Bigger picture, there's probably more concerns, but I think the next 3, 4, 5% should be higher, not lower than here.
And just to stick to chips specifically, what do you think leads to more of the action that we're seeing today? Obviously, today is a little bit of a move to the upside in a lot of these chips names, but what technically are you seeing that indicates that rally is going to have legs?
Same thing. It's just, you get to a point where, momentum kind of and sellers kind of exhaust themselves to the downside. And even in bear markets, and we're not saying this is a bear market, but if it does turn out to be one or even, more of a deeper correction, you do get some pretty vicious rallies. So, you want to be mindful of those oversold conditions and, if nothing else, maybe, wait for a bounce before, looking to sell again.
And I wonder, too, if you can talk to me about what you're looking at when it comes to NVIDIA specifically. Obviously, the chip giant in the room, a lot of selling pressure that we've seen on that stock year to date. Those high earnings expectations being a challenge for them as well. What are the technicals telling you about how long a possible bounce back on NVIDIA could last?
Yeah, similar idea. It kind of traded sideways for much of last year in a trading range, and it's kind of broken below that a bit. So there's a lot of buyers that probably would like to be made whole, and so I think that's the issue. If you do get that bounce, they're back into the 2024 trading range. That's going to represent decent resistance. So. I think we'll get a bounce, but again, you got to watch the magnitude and how the bounce responds into that resistance zone. If that fails again, that's indicative of probably a more substantial, larger top.
All right, Jonathan, we got to leave it there. Thanks so much for joining us.
Thank you.
Well, energy is at the center of the U.S. and Canada trade war. Ontario Premier Doug Ford suspending the 25% tariffs on electricity exports as President Trump also declared a national energy emergency. The latest data showing the U.S. imports $2.9 billion of electricity from Canada per year and over 4 million barrels of crude oil a day. That's according to the Canada Energy Regulator and the EIA. Joining me now, we've got Bennett Gagnon. He is the CEO of Bitfarms, a crypto miner based in Canada with facilities in the U.S. and like many crypto miners, you have transitioned into more of an AI play amid that broader transition to high-performance computing. Talk to me about the runway that you see in that transition in the business.
Yeah, this is something that a lot of the industry is doing right now because
the areas where we've been investing over the last 4 or 5 years is on the hard energy infrastructure that used to power American manufacturing. And when American manufacturing was outsourced abroad, all the infrastructure was still in place and nobody really wanted it. So it provided cheap access to energy. Now, as the pendulum is swinging back towards a focus on America and onshoring, these assets that we've accumulated, are what's in high demand. And so we have what everyone wants right now. We've got a lot of megawatts. We've got them in short order. And now it's about how do you actually convert the infrastructure over from a Bitcoin mine to, more of a traditional data center. And that's something that is going to take, for most companies, maybe 12, 18, or 24 months. And you got to work with the right strategic partners and engineers, because these facilities are a lot more sophisticated and a lot different in terms of their actual operations.
And where are you at in that process?
So we're at a point where we've engaged multiple different strategic advisors and engineering firms. We're working with a variety of strategic financial partners to help finance the projects. And we are just about to close on an acquisition of 2 different power plants in Pennsylvania, which we expect to be a big opportunity for us in the HPC space.
And I wonder, too, how you are thinking about the impact of tariffs as a company that obviously has ties to Canada, but also other countries more globally. You mentioned the plants in Pennsylvania. Do you anticipate moving more towards the U.S., more towards domestic production in reaction to those tariff policies at all?
So we are moving absolutely towards the U.S., but it wouldn't be in reaction to the tariffs in particular. I mean, when we started out last year, we were only 6% in the United States. At the end of this year, we're going to be 66% in the United States. So it's a big shift for us as a company, redirecting our efforts from really an international footprint to one that's really focused on the United States. And that's because there's the most opportunity here right now. When we're looking at where's the best place for us to invest our dollars, where we're going to get the best return on invested capital, it's right here in the U.S.
And what are the factors that lead to that opportunity that make the U.S. more attractive?
I think there's a few things. One is the proximity to the markets that everyone wants to tap into on HPC. The physical infrastructure is super important. It takes a very, very long time to build out new physical infrastructure in the United States. So if you can have it already in place and you don't need to go through the backlog of going to get through permits and all the approval processes, it'll shave years off your timeline. Yeah. And it's really the timeline to energization here, which is what's so valuable. A lot of people have ability to grow things in 4 or 5 years. What people want to know is what can you grow in the next 12 to 24 months?
And I know AI infrastructure is such a key part of that, and obviously part of your desire to transition to this HPC model. Talk to me about the demand that you are seeing, because there's been obviously a lot of questions about whether or not the AI demand is really as lasting and as strong as the market initially thought it was. What are you seeing?
It's kind of an interesting situation with compute, right? Because compute is growing at such an exponential pace. But as the availability of compute supply increases exponentially, so does the demand. And what we see is that over the last, really 10, 20, 30 years, you've seen the exact same trend playing out as computers have progressed with efficiency and technology. And so as the cost of computing goes down, the demand and the applications only go up. This is what we're seeing here on the HPC side, and because there's been such a lack of investment into these hard energy infrastructure assets, that's the bottleneck to growth, right? It's not really, I think there's a lot of focus on NVIDIA and getting access to chips, but that's not really the bottleneck for growth. The bottleneck